What's up, traders? Welcome to the Trading Mindwheel virtual conference. My name is Austin Silver. I am your host. To kick us off, I'm going to bring Mike on in just a minute. We have a ton of not just talented speakers, but really engaging topics to discuss with you guys today. So we really appreciate you signing up. We really appreciate you being here. I think that we all probably understand the reason you're here, the reason I'm here speaking today, the reason this is happening is because as traders, the learning never stops. I know that's a cliche saying, but it's just so true. The traders who stop learning stop making money. They stop progressing and really cap their growth. But you, me, all of us here today don't see trading that way. We want to see that continuous improvement. We want to see where can we do better? What are we doing that maybe needs to be a point of focus going forward? And those are the things that hopefully come to the surface today. You're going to hear some really great ideas. You're going to hear some new tactics and techniques. You're probably going to even get new trading strategy ideas. So be prepared today to take a lot of notes. I would recommend you shut off Facebook, put your phone on do not disturb, put everything away, because there's going to be a lot. Now, if you're signed up here today, Mike is going to make sure you guys get a recording of this as well. So there will be a chance for you to go back and review, but engage with us today. Get in the live chat, talk with us, ask questions. Let's dive as deep as you need for us to really feel like we're making that continuous improvement, that continuous process. So you're all here because of not just the speakers, but one in particular, Mr. Mike Lamothe. Now, Mike is the author of the book, The Trading Mindwheel. This book, I highly recommend if you haven't grabbed it already, you do pick one up. Mike is a not just well-rounded trader, but just a well-rounded human being. Mike's a great guy to look up to learn from, and to be around. He will introduce you to new ideas. He'll introduce you to new people. He's a great resource for all traders. I want to just read really quick what Anthony Crudele, another speaker here today, said about Mike on the back of the book. Anthony says, the biggest misconception new traders have when learning how to trade is that their technical and fundamental strategy will be all that they need to become a successful trader. But without the proper mindset, they will never find success. The Trading Mindwheel lays out 8 essential skills that will be worth more to a trader than any technical or fundamental strategy they could ever learn. I love that Anthony said that because it's so true. This book dives into so much detail on how to master your mind, which is a lot of what we're going to discuss today. So if you're excited, if you're really excited to be here, make sure you get active in the chat with us. Make sure you shut off your trading platform if you can. Put Facebook, put your phone down, and tune in. So I'm going to bring Mike up now. He's going to kind of kick us off as we roll into the presentations today, as we roll into our first panel. Mike, if you can hear me, we're ready for you, my friend.
What?
There he is.
Austin, thank you so much for that awesome intro. I appreciate it. And thank you all so much for being with us here today. So I want to share with you guys briefly why I wrote this book, why I wrote it now, and let's dive into it. So the reason why I wrote the Trading Mind Wheel and how this idea even came up was because I struggled. I struggled mightily with trading for a long time, way too long. It was 10 years before I started to turn the corner. And then when I finally did start to turn the corner and start to make some progress, there were a variety of things that that I still needed to learn and to master. So a lot, like I learned about technical analysis. Then I started to learn a little bit about risk management and then some trade management. When I finally started to learn about the mindset part too, right? Mindset's going to be a big theme of today. Well, when I finally started to learn about mindset, that started to be the game changer, right? And at the time, I thought that mindset was just about your emotions and trying to get rid of FOMO, and that's a big part of it. But when I think of mindset, I think of beliefs and belief systems. And so in reality, every single skill, and we're going to go through all the different skills needed for trading, but mindset's a part of all of it, right? Like, is there a certain skill that beliefs are not a part of? No. So how we think about each of the different skills, like how we think about journaling, right? We're gonna get deeper into that later on, but even if you have a belief that, oh, you know what, I don't really need journaling, it's kind of boring, my broker takes care of that. Then will you be able to go off and do it, and more importantly, do it well, right? No. So our thoughts, our belief systems have everything to do with how we will be able to develop each of these skills. And that's why it's the center of the trading mind wheel. The mindset's right at the beginning. So that's that's part of why I started to come up with the concept for the trading mind wheel. But why this book? Well, I wanted to help people that were starting out, to people that were like me back then when I was trying to figure all this stuff out, because it's going to help you develop a blueprint for the types of skills that will ultimately be able to lead you towards trading mastery. Um, There's a lot of people that are going to be a part of the Trading Mindwheel conference. Austin mentioned a few of them, but there's so many experts that are here to help. And secretly, too, like I want to learn from everybody that's here on the panel as well. There's the thing with trading is that the learning never stops. And when you're going down this path, you'll start to see that the learning and the mastery, it never stops. It's similar to any kind of profession that you could think of. Whether you're going to be a doctor, a lawyer, whether you're going to be electrician, an engineer, a plumber, whatever it is, the mastery part of it doesn't stop. There's you learn in the beginning, and then there's an apprenticeship, and then you go off and you learn more skills, and you start to become expert level at those skills. That's what this concept of the trading mind wheel is. And that's how we can start to grow as traders. So I really hope that you'll enjoy this conference. I hope that you'll enjoy this book. I'm I'm unbelievably fired up for all this, but I can't wait to jump into the panels and get started. So we've got the first panel is going to officially kick off at 10:15. And our first panel is going to be about mindset, beliefs, and belief systems, emotions, and habits. And we have so many great people that are joining us live for this part of the conference here. Well, we've got one of my great friends that are going to be joining us, Adam Sarhan. If it weren't for Adam, I probably wouldn't be sitting in front of you now. I met Adam, going back more than uh, 13 years. I think he was there for the first business. He was there when I needed rescuing with that first business, all doing this stuff part time. Um, he wrote a book on psychological analysis himself. We've got Pat Walker. Pat is absolutely amazing. If you have been following Pat on Twitter, you know how awesome Pat is. Fantastic mindset. Posts so many great quotes and deep thoughts and insights. Plus, the way that his philosophy on life is so great. Austin's going to be a part of the the mindset panel too. Uh, Austin, you heard from Austin. You know like how great he is already, and man, oh man, like what a great guy, and for him to step up and do the hosting on a moment's notice, amazing, amazing. So let's kick things off. Let's get going with the panel here for mindset. Gonna bring everybody on, and let's get this going here. So we've got Austin, we've got Adam, we've got Pat.
Yo,
Welcome, guys.
thank you for having us. Good to be here.
Very excited. Very excited. It's good to meet you, Adam and Pat.
I got Likewise. my haircut for this today, you know.
There it is. That's how you know it's serious. If Pat got a haircut.
Amazing, amazing. So guys, we've got a lot of questions to go through on mindset, and so I'm thrilled to be able to one, have each of you here with us, but to be able to go through these questions. I think that we're going to be able to help a lot of people here, and also we'll be monitoring the chat as we go. So as you have questions, for each of us, have questions. Oh, and here's Anthony Crudele. Welcome.
Last but not least, Deli in the house.
What's up, guys? How are you?
There you go.
Good to see you.
Awesome. Thanks so much for being here.
Oh, thank you for having me, Michael. I'm pumped for today. I'm excited.
Yeah, Anthony has loads and loads of experience too. Futures Radio show, has interviewed so many great minds, and puts out loads of great content himself too. So definitely check out Anthony too. We've got a virtual lobby that everybody can check out as we're going through, as well during the breaks. Go to, you'll be able to check that out at tradingmindwheel.com/lobby, and you'll be able to learn more about all the speakers. You'll be able to click on their social medias, their websites, everything about them. So go check out the lobby too later on. But that said, let's get into some of these questions here. I want to see if we could bounce some ideas off of each other here. Like, it's so unique to have a group of individuals like this, all on a panel, all able to just chop it up together. So let's go through this. I'm curious to hear from each of you, what are some of the core beliefs which have led to your personal success, and how did you go about acquiring those beliefs? Well, whether it was from a book, whether it was something that you came up with on your own, seminars, or where did you come up with? What are some of these core beliefs, and where did you get them from? Let's go around the room. Austin, let's start with you.
Sure. The first one that I can think of for myself, and I'm pretty sure we would all relate to this, is you have to believe in yourself. You have to have this like unwavering self-belief, almost blind confidence, like in a way, like to the point where you could almost be tunnel vision focused. I like to look at it on your own goals, on what you need to do. Now, when you say that, you can come off as disingenuous to the people around you, your friends and your family, and you don't want to. Of course, that's not what I mean. But I mean, put yourself and your family and your goals over everything else. So when you're betting on yourself and you have that type of focus, I think you're able to really tap into your true potential. Like for myself, the path that I have walked to get to today is not the conventional path that a lot of people would say you should walk. So the only reason I've been able to make it work for myself and to grow my business is because I believed in myself, because I knew that eventually all of the stuff that I didn't enjoy doing, all of the pain and all of the losses and all of the other things that cost me money really and time, they would be worth it. They would pay off in the end. So I think it starts with that self-belief that you're going to commit to something. And if you have, good characteristics underneath that, like hard work, determination, things like that, good morals, then that self-belief can become realized. It can become brought to fruition. So I would say, first and foremost, self-belief is the basis of what the best traders I've ever worked with and the best traders I've ever studied, the basis of what they have starts there.
Is that something that you always had, or how did you go about acquiring that self-belief?
That's a good question. It's just funny. I think I've talked to you about this when we did our podcast a little bit.
Yeah.
I think it's part of how you're raised. I think your parents, of course, there's a part of this that is like your DNA, right? Like the genetic makeup of you and your biases and your beliefs. But I think your parents can encourage a lot of that. My dad really pushed me to be an entrepreneur, and he really
Yeah.
pushed me a lot to play sports. I think sports and entrepreneurship made me who I am because I learned how to lose. I learned how to work in a team. I learned how hard work gets you to the top of the table. I learned these other skills that kind of all feed self-belief. You know what I mean? So I was encouraged by my parents at a young age. You can do whatever you want. My dad always would say that. You can do whatever you want, which we've all probably said to somebody or our own children at some point, right? So when you instill that really deep self-belief, I think it can carry with that person for the rest of their lives. And like I said, I think sports is another big thing for me, at least, where belief. I know Crudele, you're a big golfer. The sports teaches you so much about, like I said, losing, hard work, teamwork, all of these things that translate right into trading. So I think to answer your question, Mike, it has been in me for a long. I mean, I'm the entrepreneur, bro. That I literally took my mom's jewelry and tried to sell it at a yard sale when I was like 9. Like I took the box and I tried to go down this, like, so I've always had this entrepreneurial self-belief kind of thing in me. You know, it's the Jewish Italian mix. Maybe it's that. I don't know, but I think it's always been in me.
That's awesome. That's awesome. Yeah, well, like that. I wish that I could go back and say that, but you know what? Everything that happens to us in life, I feel like it brings us to where we're at right now. So I was about to say like I wish that but honestly, like I don't think that I change a thing. Later on in life for me, like I didn't have that kind of upbringing. Like in the book, you've already read it. That I think that it actually started shipping out a couple of days early too. So if you have the book already in the chat, let us know. But one of the things that I talk about in the book was my early upbringing too. My parents divorced super young. I was living with my mom and my stepdad, and he lost his job. She wasn't working, and we were homeless for a couple of months. And it wasn't until later on that she decided to call up my dad and say, "Hey, I don't want Michael to live like this. Go off and live with him." That I separated from her, went off to live with my stepdad, well, with my father, and I had all kinds of negative beliefs about him, like super messy divorce. So, but to another point that I think that was wrapped in what you're saying, and I don't want to put words in your mouth, but let me correct me if I'm wrong. But your environment matters massively.
100%. I still believe in that today. I think everybody here does. I mean, like all of us here, look, we're all sitting in a location we designed. We all are sitting in an office or a home where we create that space. It starts there. So it's not even just the people in your environment. It's the stuff. It's the physical material of like, how does it make you feel? I'm not a materialistic person. I don't wear watches, but I spend a lot of money to live where I live because it makes me, I think, push for more. It helps me be motivated and strive. So in every sense of it, your environment shapes your beliefs, but it also can shape your motivation and your goals. It can completely change the perspective of reality that you're living in. So environment is everything. It's that saying, like, who are the people you surround yourself with? That's the average of who you're going to become.
Yeah.
But I would even take it a step deeper. It's like 1 to 3 people that you're around a lot that kind of shape your beliefs and who you become. So I think environment plays a huge factor in it. 100%.
Adam, I want to get your thoughts. It looks like your expression tells me that you're chomping at the bit.
Yeah, I'm a big believer. I love everything that you're saying, Austin, but I take the other side of that trade. I can't control what happens to me in life, but I can control how I react to it. And that's one of my core beliefs in life. All of us, it applies to everybody. So, Mike, you couldn't control your childhood. I couldn't control mine. Most people can't control theirs. But what you do after that is what you can control. And that determines your success in life. The other thing that's really important, a core belief, and then I want to hear from the rest of the panel as well, is in the book, my book, I talk about, Mike, and we've talked about this before, there's an infinite number of ways to make money in the market. Your job is to find one that works for you. That's one of my core beliefs. You know, in the Market Wizards books, there was several of them, which are fantastic. And Jack Schrager would interview these really great traders from decades ago. And one of the books, one of the traders, he goes back, he's like, look at this first book you wrote. This guy in that book, maybe everything he did, he went left. I did the exact opposite. I went right, and I'm still have phenomenal returns. So in life, it's like Elton John's song, "I'm Still Standing," yeah, 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 or Tarzan, pounding your chest. We all get knocked up, jabs and uppercuts and so on and so forth. But to me, it's just understanding that it's all life, markets, everything that your whole consciousness, everything has to do with your decisions, your attitude, and your own story that you tell yourself. And the beauty is you can change that story instantly. So
I
for
totally
me,
agree.
yeah,
Totally
just create that empowering story,
Yeah.
become the victor, not the victim, and move into that smart money circle, and your whole world changes.
So Adam, do you believe I'm sure you agree with this. Like, it's perspective. It's the perspective you choose to live within that then shapes the results that you get, right? Like, you would probably back the idea, if you're a positive person and you try to see the good in everything, and even in the losses, you take lessons from it, your outcome over the long term will probably be positive because you created that perspective. Is that kind of what you mean?
Yeah, so Austin, that's a really good point. So I used to think that, yes, but as
Okay.
I've gotten older and I've taken more lumps, so to speak, and I've learned,
Yeah.
I realized there are negative people that are billionaires. So if it's only positive people that win, there goes that logic, something doesn't work. So let's take a step deeper and realize, oh, wait a minute, what can I physically control? And if you really peel back the onion and you look back at what you can control really one thing and one thing only. It's what you want. It's your decisions, what you do with it, right? So I might want this and I don't want it anymore. Okay, I want that. You're free to want whatever you want and change your wants. But outside of that, you really can't control much of anything. You think there's an illusion you're in control, but you can't. So if you give me a choice of positive, negative, of course, choose positive, no question. But again, come down to what you want. Do you want to win? Do you want to lose? Do you want to be the victor or the victim? And then create that portion you talked about, Austin. Create that life you want, because you're the creator. Just like, higher power, God, whatever word you want to use, is the creator. But within all of us, we have the ability to create as well. And it's like an artist who has a white canvas, or an author. Mike, you wrote the book. You write letters, words on the page, and then bam, the book's there. So it's your story.
Who's still writing the book though, Adam? No, we're typing the books nowadays, right?
Fair enough.
Hey, one of the things that Adam that you mentioned with the market wizards, like one person doing it this way, somebody else doing it the complete opposite way, and both of them coming up with success. I remember you telling me that ages ago. And well, when I first discovered William O'Neill's book, How to Make Money in Stocks, and I was looking at that like a cookbook, and I was trying to follow it, and everything made intuitive sense, but I struggled to apply it because I didn't have the exact perspective and beliefs that Bill had when it came to risk, and I was still learning about all these things. Like, you don't know what you don't know. And when you told me that part, and you started telling me some of your story about like how you went back and you started to do the same kind of analysis and came to your own conclusions, that helped me so much, because then I was able to start to say, oh, you know what? There's multiple ways to skin the cat here. Yes, I believe what O'Neill's doing it, and not only that, I'm seeing the results, but I could also take that and apply it in a way that's going to fit me.
100%.
So,
yeah, there's no question.
No.
Yeah, Pat, go
for
it.
One of my degrees is in psychology, but you don't need a degree in psychology to get wrapped into all this. But I think it's really important. And I heard a common word here was motives or motivation. And each of us has our motives for doing this. We have to analyze ourselves. I was an IBD meetup co-leader for over 12 years, and I've met some really good investors, and for that I'm thankful. And I'll share this with you. Your best friend, our worst enemy, greets you in the mirror every morning. And it's your choice to determine who it is. I'm not saying that to be cute or cavalier. It's the truth. And these gentlemen have alluded to it. Mindset. What kind of mindset do you have? Is the glass half empty or half full? Life is choices, and we can choose which way we want to go in relation to mindset. There's a lot of things we can't choose. We can't choose if we've got hair or not. We're not going to talk about that. But the idea of, what am I going to do with what I have? We're here for a limited amount of time on this earth. What are we going to do with the time that we have, the assets that we have? And I don't just mean financial assets, I mean mental assets. And why are we even doing it? There's a big question there. A lot of people don't tackle it. Hey, why am I doing this? I'm doing this to make a lot of money. if that's your end goal, I will tell you, it can become kind of a hollow victory. There should be other stimuluses that you have that are motives for you. For me, I'll tell you what mine was. I was married and a sole supporter of a family of 6 and also helping to support my mom too. What was my motive? I had to make money to support these people. Stay-at-home wife, 4 kids in private schools at the same time. I had to figure out a way. And I did a lot of study and studied a lot of different charts and a lot of different methods. And I'll share this with you. Through years of research, that's my background through graduate school, etc. Through research, I started putting together pieces like what's going to work from a financial perspective, but also from a psychological, mental perspective. What foundations can I use that fit me in order to achieve my goals? And there was a very important 2-word phrase in that statement, fit me. Each person has to find out what fits them. I can't stress that enough. Please don't put a square peg in a round hole, all right? I'm not a day trader. I don't do any of that. I haven't looked at a 5-minute chart in years. But if you do, and it works for you, and you're happy with it, and you're successful, stay with it. We all have to blaze our own trail. But what will really help all of us is studying charts and methods of past great winners and studying tactics of past great winners, people, winning investors, and learn from them. Something that really changed my life, I'll tell you, was the great honor of sitting down with Bill O'Neill at lunch and talking with him one-on-one. That man changed my life. His book, How to Make Money in Stocks, and please, I don't work for them. I get nothing from anybody, all right? Being completely objective. Finding some methods that will work for you and stick with them. Hone those skills. But I also want to take it a step further. I think social media is a very good tool, but I also say there's a degree of it that can be somewhat self-destructive with our mindset, where we get involved in the compare game. One of the negatives for all of us is the compare game. Find a couple of viable investing tactics that work through time, not for the next week or the last month, that work through time. Own them, make them yours. Also, from a psychological perspective, I think this is important. Always be grateful and always be humble. Research has indicated for most investors, their biggest losses occur after a period of success. I'm going to say that again. Their biggest losses occur after a period of success. So control yourself, control your emotions. It will help you. We're not in this for the next week, month, year. Lord willing, we're in this for a lifetime. And hopefully it's a long time. Again, your best friend or worst enemy greets you in the mirror each morning. We can decide who. Focus on simplicity, and it will really help you. I'll take it a step further when I say simplicity. Simplicity with fundamentals, great earnings and great sales. We can quantify this, okay? Companies with great earnings and are great sales, all right, outperform other companies. Companies with a high composite rating outperform other companies, all right? Focus on that. Use that, and you will dramatically improve your results. And another key point, I'll say this, never argue with price. Never. What we think doesn't count. Price is what counts. Lean on that, and things get easier. I said this quote before, and I'll say it again. Only the still pool reflects the stars. Focus on simplicity, and life gets better. Life gets better. And I'll back off and say this. I'm not talking, oh, Pat, so you're saying just look at longer term bases and weeklies and stuff? No, I'm saying find what fits you, but make sure it is conceptually correct and simple, and stick with it. Stick with it. I love this quote. I never met a wealthy pessimist. Opportunities are there for us. They're there. And it's our job to find them and master them and own them and use them. And the last thing I'll say in relation to this, I think it's really important. Always be thankful or grateful, and always be humble, because it can all come crashing down in a short period of time. And I don't mean just financially, I also mean health-wise. Take care of yourselves. I can't stress that enough. That's the psychology background in me. take care of yourselves. It's really important. And that's
Pat's
from
on fire. So well said, Pat. So well said.
Thank you.
Yeah, I agree with everything you said. I would just throw in too. I think what's really interesting, and I totally agree with the comparison thing you said about social media. I love the quote about the still pool reflecting the stars. I'm stealing that. I'll give you credit, but that one's good. I like that.
It's not mine, just to let you know.
Okay, good. We'll keep passing it down.
There you go.
I like what you're saying about taking care of yourself, because I'm big on that, like the health and the wellness. I had situations in my family when I was younger that showed you like everybody could be healthy one day and then nope, all of a sudden it's not. Life can throw you the craziest curveballs. So if we are the lucky people who found the belief system and chose to be in this career that gives us the financial freedom and the time freedom to then have the capability to take care of yourself, you are almost obligated to do it. I tell people, I think you're obligated. If you say, oh, I'm going to trade for 30 minutes a day and be done, because, there's those 5-minute day traders, right? Like probably like Crudele or whatever, scalping on the 30-second chart or something. No, I'm just kidding. But if you want the privilege of being done in 2 hours or an hour a day, what are you doing with the rest of your day? You should be going to get healthy food. You should be being outside. You should be working out, being around people, even the social connection. I'm sure you'd agree with Pat. Like as traders, we can be very isolated. It's good to get out and get around other traders, get around other people, right? For your brain.
Got it. Oh yeah, we're social creatures.
Right.
We need that. Complimenting your sense. Okay, again, I've been involved in some very serious psychological situations trying to help people off the ledge. All right, and I mean like suicide type of stuff, talking them through stuff, and it's just really important. The biggest asset we have, folks, it's not our bank account. It's what's between our ears. We got to take care of it. I'm not saying that to be a downer. So yeah, like what Austin says, get out there and exercise. Get out there and burn it off. Burn it off. It's really good for you. It's really good for you. Meet other people, and not just in trading, in the trading environment, people in general. You'll just be better for it. And we're here, like I said, for a short time. Let's make the world better. Let's leave it better than when we found it. And you could say, that has nothing to do with investing. Actually, I think it has everything to do with investing, because investing has to do with life. And all this is life.
It's all parallel. There's so many, we could have a whole panel on that, right, Mike? The parallels between life and trading. It's everything.
Yeah, totally.
I'm sorry if I talk too long. I apologize, but it's just something that's on my heart. I'm passionate about it.
Well, hey, you're spitting fire, and you know what? Though I'm glad we started this panel a couple of minutes early, because this is fantastic. Anthony, I'd love to get some of your perspectives on this as well. You've spoken to so many great people like you, and you share so much great stuff on all your channels. Well, what do you have to add to that original question? And then, we've got a few more things to dig into as well. But the original question was, what are some of the core beliefs which have led to your success, and how did you go about acquiring those beliefs?
Well, how do I follow Austin, Adam, and Pat with that? You guys were fantastic. And I was actually sitting here taking notes. And I just want to address a few things that they talked about, just to bring it into my perspective. And I think from where I started in this industry, I started in the pit on the trading floor. And so I was actually able to witness that there was so many different personalities in the same pit making a lot of money, and really nobody was the same. And so that was one of the most interesting things that I could really say about the trading floor, was that each person was like their own walking individual business as you watch them walk around the floor with their trading jacket on, and their clerks and their crew. It's hard to explain almost what it was like, but I remember when like Luck would walk into the pit, or VXD, or all the different guys would walk in with their badges, and their whole group would follow them, right? You'd have their trade checker, a clerk, they'd have, somebody who did whatever for them. And they just all had their own businesses within the pit. And although we were all trading the same market, everybody was operating differently. And that didn't really register with me until I was actually stepped into the pit, and I started to trade for myself, and realized that just because I was surrounded by this and surrounded by people making a lot of money, that I would make money. It was really unbelievable, because I went in there with the only thought that I'm going to go in and make money. And it was because everybody around me was making money, but I never understood what it took for them to get to that point. Right.
Mm.
And so I stepped into the pit, and before you know it, I'm broke, right? And it's like, how could I be surrounded by guys making millions of dollars, and I'm trying to do the same thing that they're doing, literally watching them and almost following some guys' trades, but yet I would still lose money. And it was because I didn't understand why I was doing what I was doing, right? And they had already gone through that path of getting to that. And it goes back to doing what these guys all talked about, is building something around you that's for you. And if you don't understand why you're doing something in a trade, then you have no confidence in the execution of it. And so therefore you really have a weak hand. And that's really what I was. I was a bunch of weak hands at the time. Oh, I'll buy them here, I'll sell them there, and I would just lose money because I was doing it because I thought that was the right thing to do. So when you were developing a strategy, especially these days, people will see other people and look that they're making money, but they don't understand why they're doing things. And so part of the core beliefs to me is believing in what I'm doing. I would rather believe in a setup that only wins 2 out of 10 times than do a setup that someone told me works 8 out of 10 times. Because that those 2 times it doesn't work, I will lose 10 times what that 8 times is. And so psychologically, it's hard to really believe that, but I actually lived that, right? Where I would just do what these guys would do and win and win. And then all of a sudden I'd be in one and I'd be like, oh, what do I do with this? And I'm just losing money. And I'm just like, I'm allowing it to happen, right? I'm just, because I have no control over my strategy. So one of my beliefs is believing in what I'm doing, even if you don't think that you have the most profitable strategy or highest probability strategy. Probabilities on paper will not add to probabilities in your P&L if you do not understand the premise behind it. And so that's one of the first things, right? And then, because I know they touched on so many things and I agree with all of them. And there's just 2 other things I want to talk about is just the vision of it. When I started to lose, I was looking at myself saying, what do you really want to do? How do you really see yourself? Because if you take on a career like trading, you're only going into this most of the time for all the wrong reasons, right? You want to make money. You want to live a life of, independence. You don't want a boss. And I'm not saying those are wrong reasons, but those reasons are not going to generate what you need to be successful. Because when you go into that with that thought, you're only thinking about the outcome. And so you're thinking about how much money I can make, what I could do with my own time. And I will admit that's what I went into this business thinking. I went into it thinking that I just want to be able to make as much money as I can and do what I want. And so your mind is structured that way. And then you really, once you finally do it for a while and you lose, all of a sudden you're like, okay, well, I have to start treating this a little bit differently, right? Because I am right now on this wrong path. And so how do you get on that right path? And that right path comes to you having a vision of how you want to structure that business. And then do you want to be a scalper? What is the time frame that you want to trade in? What market? I mean, we don't talk enough about markets as well. Like some people love to trade Tesla and NASDAQ, and other people love to trade the S&P or Apple. And they're all very different in the way that they move. So you have to find something that actually resonates with you, because you're not going to be able to actually build a strategy in a market that you don't have this connection with. I mean, I know some people will say, well, it's just a chart or all stocks are the same. I personally don't believe that, because like I mostly trade futures and options. I don't really trade a lot of stocks. And it's because when I get into stocks, I feel like, wow, I'm in this world where I just don't understand like what's going on. I mean, it's the stock doesn't, I mean, I know a lot of times I'll move with the index, but it's like all of a sudden it's doing this. And I'm like, is this something that happens normally? Am I just, what is going on? You don't understand the context and nuance. And so just getting around like that vision of what you're going to do for your business is like, there's so many things that go into you actually structuring this vision. And it goes into personality of the market, what you're going to look at in creating your strategy, all these different things. And so you have to have this vision of how you see yourself conducting the business versus in the vision that you see of the outcome that may occur, right? And everybody focuses on the outcome that they think will happen versus the vision of who do you see yourself as? And my most popular tweet was, I remember when I was losing and losing and losing, and everybody around me would be like, well, why are you doing it? Why don't you just quit? And I said, well, because I don't see myself as doing anything else but being a trader. And so at that point, when my back was against the wall, I finally realized that I have to figure out how to exist in this business and stop focusing on the outcome.
Yeah.
And it changed my mind, my psychology a lot.
Yeah. Yeah.
And the last thing I'll quickly touch on is health. Austin and Mike know me. Adam and Pat, they don't know me like you guys do, but I had a heart attack at 36 years old at my trading desk.
Oh.
And my life was, at that time, I mean, obviously a massive shock. And just so everyone knows, and I'm open about this, I didn't have a blockage or anything like that. I basically had a stress-induced heart attack. And it was really eye-opening, obviously. I remember being in the room with the doctor while I had gone from my trading desk to buy a bottle of aspirin because I was having pain in my forearm and in my wrist. And I go into the hospital and I say, look, I'm 36 right now. I'm freaking out. I'm like, but I think I'm having a heart attack. And they sat me down, checked my blood pressure, everything. And they're like, you're fine. You're good, right? And I'm like, oh, okay, thank God, right? Why am I having this pain and this burning sensation? Get in there. They finally took my blood and my enzymes were off. And that's how they knew I had a heart attack. Immediately take me to a specialist, get in there with him. They go in, they check my heart. And he's like, Anthony, he's like, I got to tell you, you don't have any blockages. You look great. I don't know what to say, except you better slow things down, buddy. And I'm like, what do you mean? He's like, because we say that you had a heart attack, but physically right now where you are, you don't have heart disease. And I'm like, I don't understand. So like, how does this happen? And he's like, well, a lot of times people, if they get in a car accident or something, a coronary spasm is what they think probably happened with me. And I remember at that time in my life, I was putting so much pressure on myself to perform, not that I necessarily had to perform. And what was happening was I was really only thinking about it in that short period of time about what I wanted to do. And it goes back to kind of what Pat had said, how you have your biggest losses after your greatest success. And I was coming off an amazing run in my career. And then all of a sudden I'm really just awful. I had multiple homes. I had cars. I had, you name it, I had it. And I was like, wow, I actually thought I made it. And now I have all this pressure on me to keep up the lifestyle I had built. And I'm like, well, why did I put myself in this position? Right. And now it totally changed my outlook. I got so lean, got rid of everything. And it was just like, I took all the pressure off myself. I realized that all of the pressure I had was not the market. It was me putting pressure on myself. And so when you look at these pillars, once again, it's self-belief, it's a vision, and it's understanding where you really are, right? Be honest with yourself where you really are. I wasn't honest with myself at times where I'd finally made some money, and instead of accelerating my future and like putting more money away and doing things, I was accumulating things because I did not know what to do with money. I never had money before. And so when you finally have it, you feel a sense of like just giving it away or buying things because you just don't know what to do. I came from a family that worked 9 to 5 and their whole lives. So until they finally retired, it was like, and they lived on Social Security. So we didn't have that. And so it's understanding also too, when you make money, to finally realize that, slow things down and see where you really are. Take that breath in. For me, I just kept pushing. And it backfired. So I know there was a lot there, but
that was so well said, Anthony. I just want to throw two things in. All I heard, and I think that's very important to talk about in the panel here, and Anthony, even if you could go a little deeper on it, confidence, which we talk about being confident in the strategy. Pat talked about that as well. I'm sure people listening, where does that come from? Back testing, chart markups. How do you build that confidence is the first thing I think we should talk about. And then second thing, expectations. Because expectations, when I've been trading for 8 years, when I talk to new traders, their expectations are normally what leads to the issues they run into. They expect more, and especially in the
100%.
beginning. So I think we should talk about those two things. Anthony, do you want to speak on maybe?
I just want to say one thing about
Yeah.
that is that
Yeah.
I put this tweet out a lot, and I kind of like, it's like kind of in my tweets where we kind of go back to it and we say, oh, I think I'm going to tweet this again now because it makes sense. Because there's only so much we could say.
Of course.
But the reason why most traders fail, and everyone talks about this, 95% of traders fail, right? And I've always said it's 95% of the traders that fail. It's not because they can't make money. It's number one, because they can't make as much money as they thought they wanted to make, right? So their expectations are totally skewed because everybody thinks that they're going to turn a $5,000 in account into a millionaire. It's just ridiculous, because that's the thought process, right? And so they come into this business once again, only focusing on the outcome. And it's funny how all of us talk about always managing risk, and that's like this thing that everyone talks about, but and obviously it's extremely important, but you don't realize what that means until you've blown your account, until you lost money. Right. And so I think that expectations are what skew so many people, and it's because of the ease of access that we have in these markets. You could open up an account, and in a day you could be trading crypto, futures, options, stocks, and you have absolutely no idea who you're competing against or what you're going into, but the access is there. I had to go through it. I had to take a clerk test. I had to take a member test. I couldn't trade on the floor. I couldn't do things. And I still lost money because I went in and I was 3 years in as a clerk before I could actually do anything. So I think that expectations just totally are in such a bad,
and social media makes it
get
worse.
in trouble. Yeah.
Like Pat was saying, social media makes it worse. Anthony, because of all the stuff on Instagram and Twitter, you can Photoshop something and make people think something, and then it creates this distorted perception. Yeah.
If they made so much money, I'll write them a check and let them trade for me. I don't want to have to. Don't make me have to worry about it.
Exactly.
If you got 8 out of 10 winners, hey, just call me. Show me. I'll give you some money.
I complimenting your statements and thoughts. I agree with you completely. Something that I learned a long time ago for myself, and it reinforces what you gentlemen are saying. Each of us has to find what works for us, and we have to run our race. And the compare game is self-destructive. I should do this. I should do this. Pretty soon we lose our way. Run our race, utilizing rules and tactics backed by discipline. Don't get involved in the compare game. I should try this. I should try this. We quickly can lose our way. I always told people, I was a meetup leader for years, at IBD. We find and hone a couple of tactics, and you gentlemen have alluded to that, stated that, and own them. And always, and I heard it said in many different ways, but I'll say it just the way plain old Pat Walker says it. We should always be thankful and grateful and always be humble. If you're not humble, the market has a lot of ways to humble us. So we try to get in line with what is, but I'm listening. I'm just soaking up what you all are saying. I'm like, yeah. And you know what's really cool? This is when I can tell. These aren't people that like, I've been doing this for several months and this is what I think. No, there's no substitute for seat time.
No.
Or floor time. How about that?
Never.
On the floor.
Never.
Doing it. There's no substitute for it. There's no substitute. We can read every book on how to ride a bicycle. Eventually we have to get on the bike.
Right.
But when we do, you better have a helmet on.
See, Pat, I was worried you would judge me since I don't have as many gray hairs that I'm not trading, but I promise I've been trading. I promise.
I'm jealous though, because you have hair.
You made me think of something funny there too, Pat, because I try to think of good analogies that people can relate to. And I think trading, we can see it like we're all running in the same direction, but everybody is running on a different surface and is at a different point in the race. You know what I mean? So like I might be on a nice gravel, kind of smooth, but pretty flat path, where someone that's brand new, it's like driving a car on a cobblestone street. It's pretty bumpy. You know what I mean? So I think that's another good analogy for people to think about too.
Yeah, good points. Yeah. I'll say this and then I'll stop, but it's just, it's interesting listening to you all talk because, and I'm not saying, I know Michael, I've talked with Michael, but I know of all of you, and that's great. And y'all are good, but I just listen to you and you're speaking from your heart and you're all thankful And you're all so humble. I haven't heard anybody say, well, listen, this is what I do, and I'm going to tell you what, it's the best thing going. And if you don't do that, you're stupid. You know,
Well,
I'm
because
making a
we've
lot
all
of
been
money.
humbled. We've
I
all
don't
been
hear
humbled,
any of that.
right? Like all of us here sitting here have been in a situation where the market has humbled us more than once. So you learn, if you're going to survive, like you said, you got to learn from everybody. You got to be grateful. You got to be humble. I love that you say that all the time. I love that.
Good point.
Yeah.
I'm kind of curious about the compare game, and to get some more thoughts on the comparison game, because I think that there's a couple of different ways to slice and dice it. So, one way that I've found that the compare game can be helpful is if we're comparing ourselves to ourselves, and we're comparing our results to our results, and having that kind of evolution. There's also kind of like the positive comparing a lot, like comparing or modeling somebody else's success, and then trying to figure out, well, how am I doing in relation to that person? But there's the negative type of comparison where even like of course social media, right? A lot, like you see somebody posting something, and then you start to you might have an emotional response, envy, greed, fear that you're missing out because somebody else is making money and you're not. There's another type of comparison, and the one that strikes me that I remember. I remember earlier on, well, when I had just started to turn the corner in the trading, and I found O'Neill. I found the New York City Investors Business Daily meetup group, and I later on became a leader in that group, and I was there for about a decade. But before that, and I was sitting in the audience learning from different people, I would compare what I was doing to what they were doing, but also if I had a certain idea about a trade, like I bought this trade, and I think that it's doing well, but somebody else would come by and say, like, oh, you know what, that trade, that stock, I don't think that it's going to do very much. I forget the name of the company. If Tish, if you're in the audience, remind me of the name, because I was telling this story inside our Discord about a month or so ago, and I think I've got a mental block on the name of this ticker, but it was a company that sold credit cards for truckers. Maybe one of you guys know that company. It had IPO'd. I bought it, and I was getting ready to just hold it for the big move. Nothing wrong with it, but other people in the group that had more experience than me said, you know what, it doesn't really meet the N in Can Slim, right? Or like that it wasn't a game changer, right? Like they made credit cards for truckers. Like how far could that go? Like that's like a 20% move. So I took my 20%, and then I saw it go on later on for like a 50% move, 100% move without me. So how would you what's your thoughts on comparison or comparing yourself positively versus negatively, or is it something that you feel would be something that evolves with you over time? And maybe it's the perspective to have is I'm going into this, and I need to, one, model success, but two, understand that there's going to be an evolution, and that part of that evolution is, when we're infants learning how to walk, like we're going to fall on our face sometimes, and we'll eventually start to get better and evolve.
So
Go
I can
for
jump in, Mike. So that it's really important when you compare to understand the reason why, which Pat and Crudele and Austin's talked about as well, is understand your why. If you have a strong enough why, and you do the why for the right reasons, again, Anthony said he got into the market because he wanted to get rich. Okay, everybody did just about, right? And then what happens? You go broke because it's just not a way to function. You don't focus on the important things, which are the process. In other words, like a doctor is sitting there doing a surgery, looking at his bank account, thinking about how much money he's making, opposed to focusing on doing good surgery. So if you focus on building a process and understand money is just a byproduct of what you're doing and having a good process, risk management, so on and so forth, then all of a sudden you've got a winning strategy. Like Pat talked about, this is an infinite business. The market's not going anywhere. It's not a finite game. A lot of people focus on finite games, basketball, soccer, golf, where we have a certain amount of numbers, certain amount of players, fixed rules, a start and a finish. And then you win, you lose. The markets, by definition, they're counterintuitive, right? Because most people trade time for money. They go work, they get a paycheck. They work X hours, $1 an hour, they make X dollars. But in the market, you've got to really flip the script, and you've got to put your money to work for you and almost get out of your own way. So the comparison game, I really urge people very, very strongly to get out of that business or that mindset. Don't even sit there and compare to others. There's always going to be somebody who's, Pat, you and I have the situation, who has more hair than us, who's tall. I'm short, so who's taller than me, or who's richer than me, or who's better. It doesn't make a difference. So what? Be happy. And then that's where the internal conversation comes from. Capital comes in two forms, I believe. There's physical capital, which is your money, but there's the mental capital, which is the part that matters, right? Because the money comes and goes, but it's the mental capital that really matters. So if you focus on improving your mental capital, and Crudele, your point about, hey, the self-induced psychosomatic heart attack, where it's like, oh my God, I put all the stress on myself, it's self-induced, right? So the logic would be, hey, if I can almost cause a heart attack for myself, let's take the absolute value of that, right? And go the other direction. What kind of bliss can I create for myself and others around me? And once you get into that mindset of giving instead of taking, then your world changes, in my opinion, and you're able to put the market where it belongs, in a small piece of your world, not an over-encompassing kind of thing. I have young kids, and they like Spider-Man. They're going through the phase now. And Venom is one of the characters. So if you're familiar with Venom, the Venom like overtakes you, right? And that's what happens to a lot of people with the market, where it just consumes them. They're obsessed with it. They're almost like they just can't breathe without, they're addicted to it. It's a hardcore addiction. And understanding that you're in control of your belief system, your identity is super important. And creating that identity, and you're free to create any identity you want, an empowering one or a negative one, positive one, any way you want. But really understanding that the why is really, really going to lead to success long-term in life and in markets, and get away from the what I call the lower ROI activities and focus on the high ROI activities. And that'll help change your whole world.
That's very well said. I really like that a lot, Adam.
Yeah,
You made me think of something that I'm sure is relatable, especially like being brought up in trading around all these people on social media. That was my way into trading. Like the first thing I really saw on the internet about trading was people just talking about all their successes. But back to what I said before, the unwavering confidence, right? The core belief, the sports have taught me things. Think about like Tom Brady. Does Tom Brady have anybody that he can compare himself to? No, not really. He has to compete with himself. I think the top performers in a lot of different fields have to learn how to compete against themselves, which goes to, if you've ever read the book, and I recommend all traders read it, it's called Atomic Habits by James Clear. He talks about one of the first couple of chapters, 1% better every day is like 40% better over the course of a year, compounding. So I think if you can have the unwavering confidence to say, I am going to be Tom Brady in my field. I can't compare myself to anybody else. And honestly, then a little skepticism, cynicism, saying all this stuff I see on social media is probably not real anyway. It's probably rented cars and rented watches and all this stuff. So I'm confident in myself. I can't compete with anybody else. All my competition is probably fluffing it up to make it look like the fake it till you make it. I'm not even going to pay attention to it. I'm going to lock in on myself. So I think if you can do enough of that external searching, it gets easy, especially for like a younger guy like me, to get that tunnel vision and be like, I see what those people are doing, but I'm actually so skeptical and cynical of that. The comparison doesn't even bother me because I kind of laugh at you because I don't even know if it's true. And I think in trading, what stands out to be, I think, a constant is like, how can you know if someone is genuine and true? How long are they doing it? Is it a guy that's been trading for a few months and just trying to sell a course? Or is it somebody that's been in the game like you guys that have been in the game for a long time? And that's, I think, the groundwork where you can say, if I'm going to compare to anybody, I'm going to compare myself to Crudele because Crudele is who I want to be, And I think when that person that you want to be has the track record of the success and they don't fluff it up, that's, if anything, where you can pull motivation from the comparison. Not try to compete with Crudele. I'm never competing against Crudele, but I'm using him as motivation for my future and myself. So I think the comparison can be fuel with the right other factors already set in your mind, right? You know what I'm saying, Adam?
Yeah, no, I hear you. My kids, they have a saying, you get what you get and you don't get upset. So
Mm.
in the market, so what? Somebody's made a better trade. They're up 50%. They made $1 billion. They made $1 million. Who cares? Like, okay, I'll compare myself all day long, but it's a negative ROI to do that.
100%.
If you use it as fuel, I get that part of like, okay, I want to be Crudele, I want to be Walker, I want to be the
But
next.
find it in my own way.
Yeah, might find my own way, but be happy with what you get.
Of course.
Yeah,
Yes.
enjoy the process. A lot of
Yes.
young guys, Austin, when you're getting started 8 years into it,
Yeah.
it feels like a long time.
Right. It's not.
It goes by decades and decades and decades. So what happens is you evolve, you learn, you grow.
Right.
But really understanding that we all have tendencies to beat ourselves up and to look at the negative. I'm not good enough because this guy's got this. Do the opposite. Just enjoy it. Be blissful. Enjoy it. Take that just focus on that, and then your world changes.
Could you flip it and compare yourself? Like, Pat, I'm curious to know what you think. Could you flip it and compare and be like, I'm lucky enough, even if I'm losing in my first year, 2-3 years of trading, I'm lucky enough to have the ability to sit here and hopefully figure this out. I could be picking up trash. I could be shoveling ditches. I could be doing all this other stuff. So that goes back to what Pat says. Be grateful, and that can feed your happiness, like you're saying, Adam.
Yeah, mindset, complementing what you gentlemen are saying, mindset's so crucial. I've taught some advanced classes in a lot of different areas and had a lot of psychology background too. And I used to tell this to people, and it does relate to investing. I don't want you to think, where the heck are you going with this? Your best friend or worst enemy greets you in the mirror every morning. The beautiful part is we can choose who it is. We can choose. We can change who it is. And I'm not trying to get corny here, folks. I really mean it.
True.
We've all gone. You can say, Pat, have you ever cried about a stock getting your butt kicked? Yeah. Have I ever been so pissed off that I've walked away from the machine and said, I got to get out of here for a minute, leave the office? Yeah, definitely. It happens. We're human. We're not machines. So what do we have to do? The biggest asset we have is not our accounts, as I stated. It's what's between our ears. We need to really work on that. The quote I said, only the still pool reflects the stars. Focus on simplicity. Focus on tranquility, regardless of the techniques. Like I listen to these gentlemen, and I know they have elaborate techniques, but they're conceptually simple and applicable. And you can use that. That's good. And then when you find what works, hone it and then own it. Make it yours. And then don't play the compare game. And maybe this is heresy for saying this, but I'm going to say it. Don't get too wrapped up in social media and all this stuff. Maybe I should do that. Oh, look, they're doing this. Maybe I should do this. Find what fits you and own it. Own it.
Pat, people laugh at me because I tweet sometimes. I know, Crudele, you've seen it, where I'm like, don't believe everything you see on the internet. And then people will always reply back to me and be like, then why should I follow you? And it's like, you're right. That's exactly right. Don't believe everything I'm saying. Please, like, just because you can't nowadays. So I agree with you. You can get roped into it. And social media is, it's almost, I'll tell you this, guys, because like I really pride myself on trying to be around the best traders that have ever lived and are still walking the earth. And I'm doing my best to continue to bring them on my podcast. I got to have Adam and Pat on in the next couple of months here for sure. But there's like a whole different group of traders that exist on the internet that no one that's in a Market Wizards book, nobody that's been in a trader in the pit, nobody that's a real legitimate trader knows about. It's literally like two different realities, and I'm sitting in the middle. I kind of see what they're doing on that social media stuff, but then I'm connected with the guys like Crudele and the real people out here. It's weird. Would you agree, Anthony? Have you seen that too?
Oh,
Right, exactly.
But one thing I want to talk about the comparing game is what I have seen in my career of the amount of people that I thought were, just so wealthy. And before you know it, they're just out of the business, doing something else, or broke. The amount of that people coming from the pit, seeing some of these guys that I know made millions of dollars that walk away with nothing.
That's crazy.
Is astounding. I can't begin to tell you how many guys I know. And I remember there are guys that have had bigger days than I've had years that have nothing. And so when you look at that, and now mind you, it goes back to when they got to a point where it stopped working for them, they knew no other way but the way that got them there.
They didn't adapt.
And so when you're comparing yourself to somebody else, you just don't know at some point on their path to where they're faced with this thing that ultimately, takes them all the way back. Like Pat keeps saying, be humble, be grateful, be thankful. And when I started to see guys that I know made a lot of money, just all of a sudden they're not coming back in the business and they're, potentially driving Ubers or doing other things, you're like, wow, man, holy shit. This is like for real. So it gets, so for me, I don't compare myself to anyone because and for anybody out there, just look at it like this. I mean, look to exist in the business. I mean, that should be your only focus. Look to exist long enough and you're going to have some unbelievable moments that wow. And you don't know that wow you, and you don't even know how it happened on that day, but it just happened that day. Some of the best days of my career were days where literally nothing was going on, but I was just up. I just clicked flawlessly. Right. And you're like, well, how did I have such a great day that day? And it's just because I was mentally in the right place. Everything was just perfect for me. And so you just have to exist, and your only goal should be to exist, because the money will come in times where you don't even know it. You can't plan it. And then when you get it, realize that that was a gift. And a lot of times I look at that and say, wow, I know I did everything right here today, but don't try to force that outcome the next time around. And that's why I think a lot of times people, they see, oh, I give you an example. There's a couple guys I'd be on chats with, and I'm not going to name their names, but when I'm talking with them, I'm like, how'd you do today? And I'm like, oh, I did X. And I'm thinking to myself, there's no way that this guy did better than me today. And this one guy would just always beat me, right? And it was kind of funny. And I'm like, dude, this guy's unbelievable, right? And it's like, I find myself like trying to force a bigger outcome, right? And I wasn't really, and we're all established traders at this point, but I look at it and I'm like, this is the kind of shit that gets you in trouble, right? And so at the end of the day, when you have a good run or you're doing well, acknowledge it, understand that at that moment, things just worked out. You cannot continue to force that outcome. So don't compare yourself. Even if you had a great day and you see that someone else maybe had a better one, it doesn't matter, because that's what's going to put you in a worse spot. It's almost a guarantee the next day. It's just almost guaranteed to happen. Like I actually, even myself, a little personal about me, Friday was one of my best days of the year. Actually, I think it was my best day of the year. I carried some positions, and yesterday was my worst day of the year. Now, the positions I kept were the ones that I just trimmed, and then I turned around and gave like 70% of that day back. The old me probably would have given back that plus 100%, but I was just like, wow. I go, look at what just happened. And, so it's, you also never outgrow some of these things. Unfortunately, they still
it's true.
Creep in.
Very true. The mistakes never go away. They get smaller and they cost us less.
Yeah, that's the only thing they do. Yeah. Hopefully.
Right. Yeah, absolutely.
I think, Anthony, a really big point that you mentioned, a lot of this has to do with grace as well, or, a higher power, just gratitude, that type of thing, being aligned in the right place, harmony, whatever word you want to use. And that illusion of control we spoke about earlier, thinking that, oh, it's me doing it. So, stepping back a little bit and putting things in perspective is super, super important.
Since we're esoteric, I would share like something I think about. When I follow my rules, I'm very much not talking about the outcome, the process. When I follow the rules, I might hit a great trade like Crudele, or I might actually avoid a potential loss by following those rules. The trading universe rewards that good behavior. But the second I break my rules, even if it might be the right direction in the right asset, the market's going to stop me out, for whatever reason, and then move in my favor. And I've always felt that that's the trading universe talking to me saying, bro, just follow your rules. That wasn't meant for you. And it's taken a couple of touches of the stove over the years to learn that is important to talk. Like when you feel that power talking to you, you should be, I think, trying to pull lessons from it is kind of what I believe.
Agreed.
Mike's looking up right now. He's like, can you talk to me now? Like, should I?
Yeah, right. Yeah. Well, when we get into the journaling section, that's coming up next. That's actually a big part of it for me. Something that I believe it was Robin Sharma said. He's the guy that wrote The Monk Who Sold His Ferrari. Fantastic book.
Mm-hmm.
One of the things that he said was that journaling is like praying on paper. So that's what you would just maybe think about.
Exactly.
We are getting close to the end. I want to do like a rapid fire session, like just one thing that you would say or a takeaway for somebody that is either new to trading or perhaps has a couple of years under their belt. Maybe they started it during COVID and perhaps they're struggling now. What piece of mindset advice would you give to those individuals? Let's go around the room. If you guys are seeing it the same way I am, Austin, then Adam. Pat,
I went first last. I went first
Anthony.
last time. Let's let Pat go first. Pat, you ready?
Sure.
All
you betcha.
right, sure.
Could you restate that question one more time, Michael? I really want to be succinct in my answer. I take this seriously.
Okay. So for the person that is new to the market or perhaps is struggling, perhaps somebody that started in 2020 and is now experiencing their first bear market, maybe we're transitioning out of it now, maybe we're not. What piece of mindset related advice would you give to that person? How could they
Good.
improve?
The first thing is always be, and I'm not trying to be corny here, always be thankful and always be grateful for what you have. And I'm not trying to get spiritual, but I'll just share this with you. If you're doing this, that means you have money. If you're doing this, that means you have drive and ambition. If you're doing this, that means you have health. If you're doing this, that means you can see. You can say, that's corny ass stuff. No, years ago, I had a severe concussion and went blind for a couple of hours. I still remember it.
Wow.
So all these things we take for granted, don't take them for granted, all right? If you're doing this, you have electricity, you have a computer. There's a lot of things that you have in your favor. You have intelligence, you have drive and ambition. Most people don't even have that, but you do. You have the desire to make your life better, but hopefully make the lives of the people around you, maybe family, whatever, make their lives better. Focus on those goals, noble goals. That will really help you. And I'll say this again, please take care of yourselves. Don't make an idol out of this. I read this years ago and it's very convicting. If you don't think you don't have any idols, think about what you lose sleep over. Those are your idols. Put this in perspective. I'm not saying be cavalier or complacent. Work hard, work smart, be driven, but put it in perspective. Last statement, please focus on clean and simple entries in the charts. Whatever your pattern is, hone it, own it, master it, and turn off all the noise that's out there and don't play the compare game. That will help you. And thank you.
That was great, Pat.
Thanks, Pat.
Very well said.
Excellent.
Can I go
Who
next?
wants to go
Mike?
next?
So I would say to everybody, think long term and your short term results will get better.
Well said.
When your mindset is wrapped around the short term results as a new trader, you don't have perspective. You don't think that, or you only think that you have to perform right now. We're all competitive. And like Pat says, if you're in this business, you have money, you're in this position to compete at this moment. But this moment right now is one dot on a million dots, right? That go forward. And when I was a younger trader, I felt like I needed to make money today. I felt like I had no time. And I've entered the 25th year of my career, and I'm not, it took me literally over a decade to realize that, wow, man, you just didn't need to do the things you needed to do back then. Like now I actually am thinking more long-term than I ever have. And I'm the oldest I've ever been. And it's crazy to think that way, but
I love
that's the way it has to be, right? Because it slows me down. We talked about all of these sport people. Austin was bringing it up. Tom Brady, Tiger Woods, Michael Jordan. These guys are so great because they slow things down in the moment better than anybody else. And that's the one thing I notice about all of them. They're able to slow things down in the moment because they put the time in to get to that point. And then when they're there, they slow it down. And because these guys want to be successful and they want to win all these championships over time, and that moment, they're actually the most in control because they've prepared mentally to be in that moment. And most traders are waking up and just only searching for the day versus searching for that long-term goal of existing and being in business. And so, like I said, the last thing is think long-term and your short-term results will get better.
Well said. Yeah.
I love that. Yeah.
Thank you.
Austin, you want to go ahead?
Yeah, sure. I would say on top of both of those, because those are both really good answers. The more that you can detach from those short, so this is kind of going off Crudele a little bit. The more we detach from the short-term outcomes, I think the more you'll figure out if you're actually passionate about trading. If you got into the game 2020, 2021, even this year, 2022, 2023, like, are you sure you're passionate about trading, or are you just looking to make money? If you're sure you're passionate about trading and you love markets and you're addicted and you can't stop looking at it, then the next thing I would say is get your money right. I think too many new traders come in and just try to be full-time traders when their money, their financial situation is not in a position to do that. If you have debt, bills, other things, and you just try to trade, especially in your first couple of years, and just pull your money from that to pay those things, you trade from a very stressed out point of view, like kind of similar to what you spoke about, Crudele, but different because you set that expectations with the heart attack and stuff. But like, if you go into it in a poor financial position, you're going to struggle. If you can suck it up, keep the long-term view, like Crudele said, and maybe keep that side hustle, keep that extra job, still learn to trade while you're working, you're going to be much better off long-term. Too many people just go balls deep and think that this is just, hey, I'm going to quit my good paying benefits job and just go into trading. It's like, dude, you got to pay for your own health insurance when you're a trader. You got to do all these other things. Like, you are running a business. Do you know how much risk entrepreneurship is? So before you just go balls deep, slow down. And I have guys, like younger guys especially, they'll quit whatever job they hate, and then they'll just pick up another job that gives them the time freedom to study trading more. For example, driving for Uber or whatever on the weekends and at night so they can trade and be at the desk during the day. Sometimes they end up even making more money doing that little side hustle than they were at their job that kept them off the trading desk all day. So I think you have to be, like Pat said, very humble and respect where you're at. Just because you follow some guy on Instagram that's younger or better looking or whatever, than he has what you want, doesn't mean you could just drop and have it that day. You've got to know where you're at, have the long-term vision, stay humble, and then be willing to, as Gary Vee says, eat crap, eat S-H-I-T. You know, I don't know if we can curse here or not, Mike, but eat it, because in the short term, if you eat it, the long term, it's beautiful. You build the life you want. So I think don't rush into trading, get your money right, and then build. What millionaire has one stream of income? Even all of us as traders. I mean, look at Adam. Adam has 2 websites in his description of who he is. Like, nobody has just one thing. You know, no really wealthy person has one thing, unless you're like a tech dude and you just sold your business and you cashed out and whatever. But none of us are like that. We're regular entrepreneurs. We're grinding it out here. So build that life, build that entrepreneurial life, and make sure you have the financial ground to stand on to get into trading.
That's really, really good. So my 2 things, to be succinct, Mike, would be, number 1 is to respect risk. And we'll get to that in the afternoon session. It's the most important factor I found. I have a whole chapter in the book dedicated to just understanding risk and reward, because it's binary. There is no maybe in Wall Street. You're in, you're out, right? So you're trading risk for what? For potential reward. So understand that dynamic really, really well, risk and reward. And then I'll give you 3 things. The second thing would be understand your why you're doing this, and how you can contribute and give back. Third thing is learn and master this skill. This separates just about everybody in any endeavor that they do anywhere in the world, markets or out of markets, it doesn't matter. It's master the art and the skill and the science of making great decisions.
Yes.
If you master that skill where you can absorb information, take away 99% of it or 98% of it, or 80-20, whatever it is that you want, doesn't matter, and focus on the information that does, and then learn how to, again, you can't control what happens to you in life, but you can control how you react to it. Learn how you're going to react. The stock goes against you, you know, whatever the case may be, or it goes in your favor tremendously. You have the best day of your life on Friday, then you lose, you have a drawdown on Monday. It's constant cycles. You're always going to have drawdowns. You have new equity highs. You can have drawdowns, so on and so forth. Your biggest winners are in front of you, so are your biggest losers. Understand the rules of the infinite game that you're in, and then really just master that skill of making excellent, super elite decisions in all areas of your life. I don't mean go eat like a pig and be fat and lazy or whatever, and then I'm going to be a great trader. Treat your relationships like, garbage and, nasty, this, that, and the other. Master that skill of being a great decision maker, and then your whole entire life levels up and then levels up. And then you get that bliss and you get that grace and you get the gratitude and humility and so on and so forth. You get in a frequency.
Yeah.
And then once you get into that frequency, stay there and then keep giving and ask yourself, how can you give more and help others and yourself? Be kind, be happy. Success is a decision. Just choose it. I'll end with that.
Love that. How you do one thing is how you do everything, right, Adam?
Yeah, it's 100%. I mean, look, winners win, losers quit. It's your choice. What you want to do,
man. That's what I'm saying. 100%.
All that's beautiful, and I'm so glad that we're recording this, because like that, I can't wait to go back and make more notes from this and listen to it a few times. That's one of the ways that we can get things to go into our minds and our subconscious even deeper. One thing that I'll add is that for better or worse, we have beliefs about everything, and those beliefs are leading us to the actions that we're going to take. We have beliefs that are on a surface level, but for the most part, we've got beliefs that are in our subconscious. And so those beliefs can be driving us in one direction or another. And it's up to us to identify the beliefs that we have, so we can start to think about, well, what are the outcomes that we want, and what are the beliefs that could get us to the outcomes that we want. So the recommendation that I would have is to think about 3 sets of beliefs, and I talk about this inside the Trading Mind Wheel. It's one of the first exercises that are in there. So we want to think about the beliefs that we have about trading, the beliefs that we have about money, and the beliefs that we have about ourselves. And so what I would recommend doing is to write out as many beliefs that we could think of on each one of these things. And then we want to start questioning those beliefs, where they came from. How did they serve us in the past? How are they serving us now? And a core belief that I have is that everything is serving us, and it's up to us to figure out how. Now, that might seem maybe that sounds corny, but something that happens that's a traumatic experience, and everybody in this room has shared some form of trauma. Yeah, everybody that's in the chat, I'm sure that we've all experienced some form of trauma at one point or another. Well, how our perspective can change on these things, it could very well be something that ends up serving us. So when we start to question the beliefs that we have, one or two things can happen. We can either withdraw the energy from that belief, and it becomes weaker. Mark Douglas talks about this in his book, Trading in the Zone, another great psychology book. Or our belief starts to get strengthened because we've questioned the belief, and it's like, you know what, that's actually something that's serving me well. Great. Now, because we've taken the time to question this belief, now we have an even stronger belief. And so,
good point.
I'll leave it at that, since one of the ways that we do get to question our beliefs is in the journaling and in the post analysis.
Yeah.
So we're a few minutes over, but that's okay. We're gonna take a short 5-minute break, and then we'll come back and have the journaling and post analysis section. Guys, this was absolutely incredible. What a blessing to have each of you here with us. You're all going to be on other panels later in the day. I look forward to talking to you guys more. And thanks again. Oh, yes. And everybody that's watching, go check out the lobby. The lobby is at tradingmindwheel.com/lobby. And I'll put the link up on the screen, and we'll see you back here in about 3 to 5 minutes.
Thanks, Mike. And congrats on your book.
All right. Thank you so much, everybody. All right, welcome back, everybody.
You ready, Mike?
Hey, Austin.
I'm ready. Let's do it. Panel number 2. Here we go.
Panel number 2. So we are talking about journaling and post-analysis.
Yeah.
And for those of you that are just joining here, welcome. I'm Mike. I'm accompanied by Austin Silver. I want to give you a better intro this time. Let me read what we have in your bio. If you guys haven't checked out the lobby, well, we have a tradingmindwheel.com/lobby where we have the bios of all of our speakers, links to their social media, links to their websites. You're definitely going to want to go check out Austin because this guy's incredible. So here, I'm just going to read off your bio. And so Austin started his career as a retail trader in 2015. And even from there, from 2015, like the success that you've had already in trading, in your businesses, and everything, like it blows my mind.
Thank you.
After a rocky start, he has now built one of the largest social media followings in the trading industry behind sharing valuable content through his daily trades, being an entrepreneur. Austin has built multiple successful businesses around the strategies he uses in the Forex market. Austin's passion is rooted in helping bring value to the masses. His goal is to get as many people as possible trading actively and taking full control of their financial future.
That's it. That's well said. That's good. Yeah, I mean, like my whole thing, Mike, like, as long as we've known each other, we've built a good friendship. And like, I mean, we're both from up north in the Northeast, so we got that similarity, the same water running through our veins. But I think like you and me both have gone about it the right way, where we're like, I'm going to provide my value, my unique perspective. And some people are going to love me. Some people are not going to love me, but I want to be genuine, be honest, be transparent like that, because then when the people do love me, those people are going to stick with me forever. And that was always the idea. And that's why I've been able to build the following over the last couple of years because of that, I think. And that comes from, like I mentioned in the first panel, a lot of Gary V, bro. Like Gary Vaynerchuk, big influence on me when it comes to the online brand building and stuff. So I think that was kind of like the fuel for like, hey, you're going to build a business, you're going to do it the right way, but it's going to be, tedious. It's going to take some time. But when you give it that time, long term, you're like, oh, good thing I did it that way. I'm much more glad I built my business off the things I did rather than the Lambo and the watches and all that other stuff that you could choose to build your business off of,
100%.
Yeah.
So journaling and post-analysis.
Yeah.
Accountability and continuous improvement. So I have the chapters broken out into 2 different chapters in the book, but I put them together in there it is in this panel because they really do go hand in hand. And journaling, well, we could journal, but without the post-analysis part, it's almost like, well, I don't want to say what's the point, but we're leaving a lot on the table if we don't do the post-analysis. And if we don't have the belief of how journaling is going to help us, or that it's even important, then we're less likely to do it.
Right.
And I mentioned this when we first started too. I didn't always have this belief that journaling was important. I thought that it was a pain in the ass and a big waste of time, right? Like I could, if I wanted to see how I could do on a trade, I could just go log into my broker, look at the transactions and say, okay, what did I do there? Right. Or just look at my P&L, right? Because that's the only thing that's important. These are the kinds of things that I was thinking early on. I didn't have the formal training. It wasn't until later on that I started to learn all this stuff really the hard way. And so I want to try to get into the beliefs about journaling, beliefs about post-analysis, why they're important, and how you go about doing them, and some of the things that we look at.
Yeah.
So I'm kind of curious to hear, have you always journaled, or is this something that you didn't have those beliefs early on either?
It's a good question. I actually did not have the journaling as a core belief in my business, in my trading business, when I started. I got into trading like I mentioned on the first panel, influenced from a lot of social media stuff, right? I then transitioned and I worked for a firm in New York City. They still exist, a prop firm. And I worked there for a year and a half. And I think that was where I really started to see like what real trading was. And everybody at that firm was journaling. So that got me thinking more about like, okay, let me ask these people who have been trading more, how are you doing this? What does that mean to journal? Like, do I write my thoughts? Do I write my feelings? Do I just say like what happened? Like, what do I write? Because I'm not a writer. I don't read very much and I don't write. I'm audio. I'm a very audio and visual learner. So they kind of put me on to the idea of first thing you just should do is track your entries, track your exits, and track why you took the position and track why you exited the position where you did. Just those 4 things at first. That has now stemmed into something I'll give you more of here in a second. But that initial push was all I needed to see this is science. Trading is a science and an art, but this is the science side of your trading where we backtest, journal, document, tweak, analyze, and improve. If we don't do that, all we are really doing, I mean, let me say it like this. If we don't do that, I really believe we are walking the line of being a gambler more than a trader. A trader knows his edge. A trader knows where he's most confident. A trader knows his setup like the back of his hand. I didn't understand what those things meant when I got into trading. So if someone listening to this doesn't know those things or doesn't understand, you need more experience. You just need more chart time and try to get with people who have gone through that hurdle, and that will shortcut it for you. That's another big thing, like you mentioned in my intro, what I believe. So the journaling evolved from me just getting those 4 pieces of information, starting to track. And let me just say this too. I was the guy, Mike, believe it or not. And it's pretty easy to believe because we were all this guy, I think. I would take 4 trades, even if I was, so I had my first strategy, the A1. That was the name of the entry signal. As I was developing that, I would take like 4 trades in a day. 3 of them might be the A1, maybe 2 winners, 1 loss. But then there was these other trades, like that 4th trade or that 5th trade that I would literally not even know what I was doing, just throwing a trade around. And in the post analysis at the end of that day, I'd be like, oh, the system performed well today, 3 for 4. But those other 2 or 3 trades that I clicked, I'd be like, just it's testing. Don't worry about it. If I would have just documented those trades, Mike, I would have made so much more money already. I really, really believe, like, if I regret anything, I regret not documenting those tests, those losers, just not documenting everything, because it would have played a very important role in my learning curve, but it was ignored. I was brushing it under the rug. So if someone listening is doing that, use me and be like, hey, I'm the same as Austin. We're all the same, slightly degenerate traders out here anyway. Track everything. So that was like the first thing. Then I think you know this too, Mike. I started to actually sell a trading journal. Do you remember when I was selling those? Yeah. So I took what was working for me. I put it to paper. I got these really nice binder things made up with nice paper, and people were buying them off my website. I was shipping them from a warehouse in North Carolina. I was making a couple of bucks, like $6 profit, $7 profit per journal. We were slinging them. It was great. But then that just wasn't cutting it, because then I'm journaling on paper, but I don't have the chart there. I can't see the trade. So then over time, where it's developed to the point now is, and I know this is a long answer for your question of have you always been journaling, but now the point that I'm at now with the journaling that I do now, with the level of tracking that we'll get into in this panel, I have not been doing that since I got started. This is just the last 3 or 4 years. And like I said to you earlier this morning, changed the game for me. If you're listening to me and you're not documenting, you need to start. But I would also put into this, you need to start and do it at a high level. Don't just start it like I did and have this whole years of ramping up and getting better at journaling. No, get with someone like I didn't do. Get with someone who knows how to journal really well and learn from them. Learn what they're tracking. And you're going to learn a lot of it from me today. I'm going to share a lot today. But like, that's what I should have done. I should have gotten with somebody who was already crushing it and said, how are you documenting this? Like, what are you studying in your own trading? And that would have really helped me a lot too. So short answer, no. Long answer was all that.
Yeah, well, and that actually goes to one of the things from the mindset part, which is getting around people that know what they're doing, right? Your environment matters, and it's more than just the 4 walls. It's what you're watching, what you're reading, what you're listening
100%.
to, the people that are closest to you.
100%.
So yeah, if you're around people that actually know how to journal and journal well, then it's or any of these skills that we're going to be talking about today, it'll rub off, and you'll be able to have an external set of eyes to help guide.
Yeah.
So I'm when I started to turn the corner with my journaling too, like I started with a binder. I started with a binder. I would print out the charts.
Yep.
So there's a charting platform called MarketSmith,
Yep.
where we could. You familiar?
Of course. Everybody, like, I know you've been trading a long time when you post a MarketSmith chart. You know what I'm saying? Like, those are the old school guys. Like, I know they've been on trading since the internet was a baby. They still use that, you know, because like everybody now I think is on like the trading view kind of stuff. But like the old school guys that were taught on MarketSmith, that's what they use. So yeah, very familiar.
Yeah. Oh man. You know, if I were better prepared, I'd have the binder. But
I know
have
you should have
another
brought it
binder
because, you know,
that's
I have
here.
the
So,
same
like a
thing, Mike.
binder like this,
Right.
like printed out with all the charts on there, all the hand markups. And well, what I would do back then was I would separate out. These are my winners. These are my losers, and then try to go through them one at a time and see, well, what was common among the winners, what was common among the losers, and then you're just trying to very simply do more of what's working, less of what's not. But that's pretty surface level, right?
Yeah, but it's a good intro.
It is.
Yeah.
A very good intro.
Pattern identification, right? Like getting your eyes used to seeing patterns on a chart, which is new to a lot of people, right? And I mean, I didn't have the binder like that. I had them literally, Mike. I wish I could still find this picture. It's on my Facebook somewhere if you scroll back. I had my entire, like, my desk was in the corner of the room, like behind me, and the wall on the side and the wall over here covered in charts on both sides in the corner of my office, just covered.
Wow.
All I was the same as you. I was like, just practice the patterns. Just show me more patterns. It's like, again, to our previous panel, you look at the greatest athletes. I just am a sports guy, played sports my, so I look at how many foul shots has Michael Jordan taken, bro? Like more than anybody, right? Like probably more practice and in-game shots than anybody. So it's like, that's my charts. That's the way I look at it. Look at like a bodybuilder who's in the gym doing all these reps on a bench press. That's me printing out my chart, doing my markup, studying for patterns. That's my rep. And every chart is one rep. Who goes to the gym and does one rep? Nobody. So it takes a lot of reps, you know?
Yeah, absolutely. Absolutely. So, I'm curious to hear what data you're tracking.
Okay, so let's get into
in the new journal that you have now. Well, what data are you tracking?
Sure. So I do it now on a spreadsheet, not a physical journal, because now I can combine my text, and now with all these, like with my computer and all this other stuff, you can just talk and it types for you now. So it's even easier for somebody like me.
Oh, wow. All right.
Yeah. The new laptops have a dictation feature on the keyboard. You just hit them and it's beautiful. So I'll just hit that, start talking, and it puts the text on in my journal on my spreadsheet. The reason I do the spreadsheet now is because I can put the markups in there, but I can now, because of the guys who I work with, I have to give Tom Jackson, he's one of my partners, a lot of credit. He built this amazing spreadsheet for our mentorship program. And with this, it's all automated, which anybody can build this, but Tom made it extremely efficient. So it is like our own thing. It's not for sale unless you take our mentorship. But what it tracks in the spreadsheet is my pre-trading routine, which I can break that down in detail, the trades that I take from entry, reasoning, risk management, position sizing, how I manage that trade, and exit reasoning and P&L on that position. So it tracks all that. It also makes me do a post review, an end of day review, which, and I'll give the questions in a second because I want everybody that's listening to get these questions to start tracking for themselves. So I give the pre-trading, the during the trade, and then the post. Underneath that, I have a section where I'm marking up my ideas. As you know, Mike Bellafiore says, every great trader marks up more ideas than trades they actually take. Yeah, so absolutely. I'm a big believer. If I'm going to take a trade today, I've got to do at least 5 to 10 trade ideas. How else could I have played the market today? Where are there opportunities to make money in alignment with my system? And that has helped me become extremely advanced, extremely knowledgeable on my strategy, because I'm challenging myself to say, where's the money today? Where could I have made money today? So that bottom section of, like, we call it the idea generation section, I track the date, the time, the entry signal, which we name our entry signals, like, you know, A1, A2, all that, the pair, the direction, the time frame for entry, and this is a big one, which we can talk about in detail. I track how far the trades go on average. So what I mean by that, let's say I take a long position. My strategy for this A2 strategy says take profit at 1R, meaning I risk 10, I'm taking some profit at 10, at least 75% of the trade. I'm closing it at 1R. It's a really simple strategy. But what I want to do, as we've been developing this probably for like 2 years now, I want to know the trades that I take, not the trades from the back testing data from the computer software, the trades I take, how far are they going on average by the end of the day or before they come back to entry where my stop loss would be moved up after it goes 1R to stop me out. I want to know what's the distance, because if I'm taking these trades at 1R, and I know I'm diving in the deep end here, but I think everybody follows me. If I take these trades at 1R because that's what the strategy is built to do, in my journaling, it's very important to say, hey, could we be making these wins worth more? And the only way to do that in the journaling is to track what we call max risk reward. How far is, okay, you got 1R, Austin, you made 2% or whatever. How far did it go? Did it go 4R? And now, Mike, since I've been trading and tracking like this, let's just even reference since July. Since July, I did this last night on one of my coaching calls, so I know the July. Since July till now, April, my average trade goes almost 3R. So what that's done is it's pushed me to say, hey, the back testing says we're taking profit 1-to-1, 1R, but your eyes, my discretion is actually putting me in trades that go 3R. So I got to start to push myself to maximize these wins a little bit more. That would never even be a thing that could happen if I didn't have the data from the journaling. Does that make sense?
Right. And so because you have the data from the journaling, now you're able to review it, post-analyze it, and now you have the belief that this is actually going to work. Because if you didn't, let's say you didn't do any of that stuff, and it's just like, and somebody else told you, hey, you could do this, like
go for 3R. I'd be like, why?
But
exactly.
Like when you start to get like 2R, and then like all of a sudden, like it starts to come down, then all the stuff in the background starts to go. Exactly. And that's where people say like, oh, I'm self-sabotaging. Well, you have conflicting beliefs.
Right. Correct.
That's
or you have lack of confidence in it because it's not your data. You need your data. This is how you niche down, right? Like in trading, and any of the guys on this conference today will agree, I'm sure. Crudele could sit here and tell me his strategy. I'm still not going to do it as well as he does. You have to build confidence in what you do. And the tracking, generating more ideas than trades you actually take, detailed markups, detailed pattern identification, that builds confidence. When I got guys that want to trade one of the strategies we've backtested and that we push, I just say to them, listen, you're going to see the entry, but you're not going to feel good about taking that trade until you go mark up a bunch of these and you start to see it. And there's probably a word for it that one of the guys that is a psychology degree probably knows, but there's something when you see it with your eyes and write it with your hand that it sticks in a different part of your brain differently than if someone just tells you what to do. You know, when you earn it, when you do it yourself, it's more deep rooted in you. And I think that's part of it, you know? And with my tracking, I think beyond even the ideas that I'm tracking, the biggest piece, and we'll come into this more in a second, but the biggest piece, tracking your trading errors, tracking your habits off the charts, tracking your habits on the charts. Just like Crudele just spoke about how he had his biggest day of the year on Friday and then gave some of it back on Monday. If I was coaching him, Anthony, if you're listening, if I was coaching him, I would say, what habits did you maybe not do today or Monday that you did on Friday? Where was your head at on Friday that it wasn't on Monday? Did something happen over the weekend? Did you drink alcohol? Did you stay up late? What are these? I'm looking for little details, Mike. I'm not looking for an obvious thing when I'm tracking this stuff. I'm looking for the minute detail that could throw you off of your A game, which goes to Jared Tendler. He's a performance coach. He talks about your A game, B game, and C game. You got to be able to say, I'm not on my A game today. Well, when you track your habits and you know because of these other habits that you didn't do yesterday, it probably feeds you being in your B or C game today, and you'll make poorer decisions because of that. So I think the habit tracking and the trading error tracking is huge, because when we do our reviews with everybody, we look at this data. It's not just to track it. You need to look at it and make improvements. We'll look and say, hey, Mike, you've traded 24 days this month. Of the 24 days of trading, you've made the mistake of exiting your trade too early 6 times. So next month, that is your point of focus. For the next 4 weeks, make sure that, because it was your biggest mistake, you might still make some other ones, but because that was the most repeated mistake this month, next month, let's make to improvement. And this is Kobe Bryant, sports analogy. Kobe literally said each season, the whole season, is when he would focus on trying to make improvements on one thing: shots from the corner, layups with his left hand, dunk. For the whole season, that was his focus point. So I've taken that and kind of used it on a little bit of a smaller scale, more month on month. But I think that's another big thing. So if you want to go into detail just about the trading errors before we do the habits, I could even give the guys listening the mistakes that I track. And if you guys want, you can write them down and track them for yourself.
Yeah, let's do it.
Okay. So I'm going to say them, and then of course everybody gets this recording and you'll be able to review, but it's pretty simple. And you can always, there's a couple that you can add based on your own personal mistakes you tend to make, but these are the 13 or 14 general trading errors that all of us make. All of us are the same. Every trader thinks we're unique and we're the shit. No, we all make the same mistakes, just in a different form. Number one, I entered too soon. I entered too late. That was number one and number two. Number 3 and 4, I exited too soon or I exited too late. These are important to track. 5 and 6, I traded too small or I traded too large. Both of those are mistakes. You got to figure out which one you're making. Number 7, I didn't get out of the trade as it wasn't working for me. You check that box if you did not exit as you should. Number 8, I traded a symbol or an asset that was not on my watch list. Just pulled it out. You know, we've all had those days. You're trading your list, you're losing, and you're like, what's oil doing? Let me go see if I can get an oil trade, or whatever, Bitcoin trade or whatever. So you go off your watch list. Number 9, I moved my stop loss as the trade was working against me. You go long, trade starts dropping. You go, I should have just given it a bigger stop. Let me bump this stop. Now you just increased your percentage risk and your dollar risk for no reason. That's a clear break of strategy. Do not move your stop loss once you've taken a trade. Number 10, I was influenced to take a trade. Somebody in your group chat, somebody on Instagram, somebody on Twitter. Influence, huge thing to track. Are you, and this goes, I make everybody in our mentorship thing take a personality test. The guys who are super extroverted, they are often influenced by other sources, other people talking to them, other Twitter things. So you've got to be able to say, if you're high in extroversion and you're being influenced, you need to stop getting on social media. You need to go solo. We need to get you in your lane. So that's another good one to track. Number 11, I missed a trade. This was my most common mistake last month. Just missing trades that I should have been in with more focus. Huge mistake to track. And you got to be tough on yourself for that one, because you'll see a loser and you'll be like, I probably wouldn't have needed to be in that. I would have talked myself. No, if it's following your system, disregard the outcome. Track if you were in it or not, if it fits the system, not if it's a winner or a loser. Number 12, I took too many trades. I believe everybody should have a gist of how many trades they normally do well with on a day. If I am taking 5 trades on a day, my whole group, everybody that knows me would be like, Austin, what is going on with you, bro? So that's another one. Are you taking too many trades? 13, I traded or held my trade into news, into a high impact news event. That's a no-no for me and our strategies. So that's like a personal thing. I don't do that. And if I do it, I did it this week. I did it last week on Friday. I was long SPX through the PCE data news and I made money. I still knocked myself for the mistake. I shouldn't do that. I don't need to risk that until I have more testing to know, oh, that is a news event I can trade through. And then the last one. This is important. I didn't take profit as it moved in my favor. The reason that's important, Peter Brandt, New Market Wizards, talks about popcorn trades. You put a stop loss in, trade goes up 2 or 3R, comes up, you don't take any profits, comes all the way back down and actually goes negative, or worse, you get stopped out at even. I call that a donut trade. The donut is when it shoots up, comes right back down, you get no money because you locked your stop if you didn't take profit. So you get a big donut. The popcorn trade is it goes up, you don't take profit or move your stop loss, and it turns into a loss. So if you just avoid the popcorn and the donuts, boys, you're going to be much better off. So that's another little analogy to keep in mind. But those are the 14 mistakes. And again, everybody can rewind and everything. And I if anything I say in this whole hour, that is what I would take from this. Please track those mistakes and then pick one every week. I'm not going to do that mistake as much next week. I'm not going to, and it will get better. Your trading will improve just off of that.
That's awesome. And yeah, like I'm glad that we've got the recording going on too. Like I'm writing Fast and Furious over here, like you can see,
right.
I want
to make
notes on the side.
I'll take it one step deeper for everybody too.
Go.
This is a new thing. Okay, we're tracking your trading mistakes, Mike. I'm sitting down with you. We're talking. Mike, this month you've missed 6 trades. But we just move on from it and we say, okay, Mike, you're going to do better next month. Let's take it a step deeper. How much money did those missed trades cost you? How do we quantify that? Well, with a proper trading plan and knowing your entry and knowing how much you risk on your A setups, your B setups, your C setups, whatever, we can actually quantify how much money are you costing your business by missing trades or by any of these mistakes. So in our automated spreadsheet, once I check off the box of a trading mistake that I make, it actually prompts me in a different area to say, how much did that mistake cost you today? So let's say I traded too small. That was an issue I struggled with earlier this year, trading too small. Every day I would hit a winning trade. I had a win streak in January, 6 wins, 6 trades. It was a great January for me. But I still traded too small. I should have been up closer to 3%. In each day, I'm tracking. Yep, I risked this much. I should have been this much. Now I would have made this much today, more. And what was really insightful to me is at the end of the week, I get all that data. It automates itself into a weekly report card. And in the weekly report card, I see my P&L from all the trades over Monday to Friday. But I also see how much did my trading mistakes cost me over the week. So now I'm not just looking at P&L saying I'm profitable, I'm happy, I'm negative, and I'm sad. I'm actually saying, okay, my P&L is profitable, but I cost myself more money than I made. I missed more money than I made. That's not that great of a week. We need to improve that. Now, last week, I cost myself 0 and I made decent money last week. So that's a great week when I make more money without making mistakes than I cost myself. So those weeks where you're like, I'm doing well, I'm winning trades, you're not doing as well as you could be doing, because if you were really challenging yourself to grow, you'd be quantifying the mistakes that you are still making. We all still make mistakes, and you would be trying to minimize that cost, minimize that total amount of that you do end up costing yourself. I hope that all that makes sense, everybody.
Yeah, totally. There's so many we overlap so much in our journaling process and in the types of things that we look at. Well, when I'm doing my journaling, there's a few different things that I'm looking at and actively tracking. So one of the things that I'm actively tracking is the market health, or what I call market mood. And there's a variety of things that factor into that. Well, we'll get into market mood and market analysis. We've got a whole panel for that, but just very briefly, it's part of what the environment is doing, how my system is performing within that environment, and then what's my personal performance within it. So it's almost like if you were to picture a Venn diagram with those 3 things and the intersection in the middle where those 3 things meet, like that's helping to guide my my decision-making process.
100%. 100%. Totally.
So there's that part of the tracking. Then when I'm planning out my individual trades, right? So when I think about what trades do I want to take, and am I going to miss trades and things like that, I used to miss trades. I used to miss trades a lot. Well, why it helped me stop missing trades, and now I don't miss trades ever, really.
Awesome.
And the reason why, it has to do with the routine, and I'd like to talk to you about routines too. So part of the routine that I have is that I'm going to do my my screening and my preparation when the market is closed. So after hours, the stock market closes at 4 p.m. Eastern for me. So I'm doing my prep for the next day right after that, and also on the weekends. So I'm filtering down the entire universe of stocks down into the small handful that I want to trade. I'll take a look at those and I'll start to see, well, these ones fit my criteria, and then I've got a whole other checklist that I'll put it through. So by the time I'm done with all this, there's only maybe about 3 or 4 stocks that make it to what I call an action list, and then I'll just put orders in for all of them and allow it to execute, and I don't need to sit there and babysit the trade. So that's how I'm never missing a trade, and I'm writing out those plans. And so the plan that I wrote out becomes part of the journal, and how I'm updating the plan each day is also part of the journal. And in there too is something that I call gut feel. like how when you see a trade lot, like especially for Austin, you've been trading for a long time. For anybody that's in the audience, that if you've been trading for a while too, like how when you just see a chart pattern or you see something that you like and you get that gut feel, this one is an A plus or whatever.
100%.
I like to actively track that too. Like, so what my gut feel, so I do it based on a 5-point scale. So this is a 5, this is a 4, this is a 3.
I like that.
2s and 1s aren't even gonna
Right.
make it onto the list. So,
Right.
so I do those, and I'll actively track all those trades, and I'll actively track the score too. I'm not gonna take a trade just because my gut feel is a 5. I follow what Reagan is famously quoted as, right? Like trust but verify, which I did a little digging, and it's actually part of a Russian proverb.
There you go.
So trust but verify. So I'll track that gut feel.
Yeah.
And one of the things that will happen is that the stocks that I don't take that were 4s and 3s, like I'll only take 5s, but I'll also track the 4s and 3s.
Of course.
And over time, I'll see like how those perform. It's like, well, why did I put that one as a 3? Why did I put that one as a 4?
Right.
And in the post analysis, I'm able to start to evolve, because now I'm seeing what the 5s do, and I've got that criteria. I'm able to make tweaks based off of things that I thought were in the 4 or the 3 category, but maybe there's another way that I'm able to go and get into those trades.
Right, like your
That's actually
grading
one of the things that
system might have to change a little bit. Like the way you turn, the reason they came as 3s, maybe they should be 4s or 5s. Exactly. Totally
right.
understand.
It's actually one of the things that led to a multi-time frame analysis. So I was always doing like weekly and daily. That's what I learned from
Big Bill,
from O'Neill. That's what I learned from the IBD Advanced Master's Level courses. That's what I learned from Mark Minervini, who's wrote the foreword on the book and is going to join us later on. But something else that I learned was looking at the intraday time frame. So like drilling down into like a 30-minute time frame, and then like fine tuning different ways to get in and tightening up my entry and my stop, having a even stronger reward to risk.
Right.
And so a trade that I thought was a 4 because I didn't quite have the tightness, I was actually able to find a tighter entry on the 30-minute chart. And then that was something that was able to work. I was only able to find that out through journaling, post-analysis.
And tracking. Yep. You got to journal and track. It's about putting in the work. Like, you did not come to that conclusion sitting there smoking a cigarette, pondering what am I going to do, and just pull it out your butt. You sit at the desk and you're clocking in the hours when the wife wants to go out or the kid needs the time. But we have to sacrifice to commit to that growth that then gets you to the point now where you're like, I don't really miss trades that often that are my trades. That doesn't happen just coming up with an idea. It happens because you put in the work. Like, you were in the gym, Mike. That's what you were doing.
Exactly. What questions do you ask yourself during post-analysis?
Good question. So let's get into those. So first question, best question, the most important question. What could I have done to make more or lose less today? That is, what could I have done to make more in my trade? For me right now, something that I'm working on is adding into my winners. I want to know, how do I make my winners worth more when they present? So I document in detail, what could I have done to make more? Well, I could have added in on XYZ signal in that trade today. Stop loss would have been here. Now we document that. Do that 50 times. Now we might build some confidence to start adding into those trades. In the same side, what could I have done to lose less? Okay, I take a trade, it comes against me. What exit signals could I start to use, or am I already using, to say, let's get out of that trade? Did I follow those exits? Like, for example, I go long, it comes down against me. It does, let's just say an 8 and 21 EMA cross. That's something I use. Crosses against me, short-term cross against me. That's a sign to pull half my trade at least, if not the whole trade. If I don't do that on that trade, I'm going to knock myself for the trading mistake of I did not exit properly. And I'm also going to say, when I ask what could I have done to make more or lose less, could have followed my exit rules, I would have lost less, right? So tracking that and then seeing, holy shit, over the course of the week, I'm costing myself money because I'm just not getting out of my losers fast enough. I don't even need to add winners. I just need to cut these losers quicker. So I think that's a great question. What could I have done to make more or lose less? Another big question every day. What was the biggest trading lesson of the day? Was it on my chart? Was it something that was discussed in my Discord? Was it something I watched in a video? What is the lesson? Is it, wow, look at what the Saudis can do to the oil price? Was it, look at what this news does to SPY? What is the lesson of that day? Just doing that every day, getting the reps. That's going to help build patterns deep in your subconscious mind, in your belief system, and in your understanding of what moves markets, really. Next question, trade of the day. Every day I have to, this is standard for everybody in our Black Shirt Club, the mentorship thing. I have to have a trade of the day. Is it the trade you were in? Could be. Definitely could be. It is some days. But there's also days where you're in a trade and there's a better trade somewhere else, and you should be documenting that. Because whether you should either be in that one or be in both, you want to know that. Because again, we want to make as much money as possible with our winners. So trade of the day. And last one that I do every day is an end of the day evaluation. Not a specific question, but just how am I feeling about the day? Do I feel like I made progress? Even if I lost, could it be a good day? Even if I won, what lessons can I pull from it? You never want to write in the end of day evaluation, I had a good day. No, man, like break the onion open, crack the nut open and say, what are you feeling? Do you feel like you're moving in the right direction? Do you feel like something needs to change? Do you feel like you need new information? Like what is your gut? Back to what you said, what's your gut telling you to do? And I think as you gain more experience in trading and you document that experience, your gut, your discretion, it gets more accurate. Wouldn't you agree?
Yeah, absolutely.
Right. So I think those are the main questions I would ask myself, that I do ask myself every single day. I don't go much deeper than that. On a weekly review, let me pull up my weekly report card. I can give you a few more questions here.
All right.
Weekly review questions. How well has your week gone? Work to do, good or great, and then elaborate. Biggest lesson of the week, biggest trading lesson of the whole week. So take all those daily lessons. What's the big thing you can pull from the week? Also, how much did you cost your trading business this week? Through misses, through mistakes, quantify the errors. Don't just say, oh, I got out of my trades too early. Quantify it, put a number. It's going to motivate you to make that change even more. Like I said, when you start to see you're costing yourself even more than you're making, you know something's got to change. Another one I like to ask myself, best trade of the week, worst trade of the week. Then at the end of the month, compare them over the course of those 4 weeks. It's really insightful. Your best trades normally look the same for the most part. I also noticed for myself last week, I noticed my best trades always go right into profit. I don't take a lot of drawdown on my best trades. So even right there, you can learn. If I start taking on drawdown, my study tells me, my journaling tells me this might not be a great trade, On the weekly review as well, what's your main focus for next week? What of the mistakes, what of the lessons, what of everything we just spoke about on that weekly review, what are you going to focus on, that one point of focus for the next week? And that, I think, is a great perspective to have because like we said earlier, trading is not a one and done. Oh, Mike, guess what? You solved the mistake of getting out of your trades too early. Congratulations, you're a perfect trader. It's never like that. It's, oh, Mike, guess what? We fixed the issue of you getting out of your trades too early, and now you're oversizing. So now we cracked one layer back, and we opened up another mistake of you oversizing. Now we need to fix that. When we fix that, then what happens? Then do we have to go fix something? You know what I'm saying? So it's layers to it. So I think that's why the focus of each week makes it easy to identify within those layers, what are you trying to improve slowly, rather than, because it can be overwhelming to try to do it all at once.
Yeah. Absolutely. Well, like how we journal, how we're going through that, like it gives us the tools necessary to be able to quantify what we need to course correct.
100%.
So one of the things that I did in a post analysis, and I was going through all my trades. I want to say that I was doing this in 21.
Okay.
I wanted to find out how I could exit losers faster.
Okay.
Right, like exit my losses faster. Well, without having to like you cut a loss faster, but then all of a sudden like you end up cutting off the winner that goes up 100%.
Right.
So I wanted to find out how I could do this, and because I was tracking all my trades in a spreadsheet, it made it very easy for me to do.
Yep.
You could probably do the same thing if you're doing it in a binder or whatever methodology you're using to journal it. And I want to say this too. The most important thing for any kind of journaling is that we start, like you said, well, we want to start well, but building the habit, I think, is one of the most important things. And also understanding that our journal will evolve. My journal's evolved. It's still evolving to this day. Could you say the same?
100%. I think that if it's not evolving, you end up stagnant. And none of us want to be stagnant. We're not open to new ways of making money at that point. This review, this study, like, it doesn't have to be, someone asked in the chat, how long does it take? It doesn't have to be super time consuming. It's about consistently doing it every day. You don't need to sit and study for 3 hours every day. It's hard for some people to do that, but it's much more impactful, I think, to do 30 minutes of review at the end of your day, an hour at the end of your day, and do some markups and do some pattern identification practice every day, and then see that benefit over the long term, over the year, rather than try to be like, all right, let me just do my 5 hours for the week on Monday and then I'm good. No, every day has lessons. Every day has important things to pull from it. So I think a little bit of time each day is better than a bunch of time all at once. So
this is a great question that I saw come in.
Yeah.
Jurek started for us. How long does the whole process take you during the day or weekend? This was one of the things that really deterred me from wanting to journal early on too. It's just like, this shit's gonna take forever.
Right. Right. Like, I worked all week, and now you want me to sit here on Saturday or Sunday and be more at the desk? Like, I've been staring at charts for 5 days. Like, come on. But I mean, I could give you so many motivational quotes. Like, there's this guy, he says, men who go to the gym, they don't want to train. They have to train. You've got to train. You've got to do that as a man. Okay. How about the trader who wants to be $1 million trader or a multi-million dollar trader? Does that just happen? Just like the guy who's a bodybuilder? Does that just, no, it's because he's at that gym at 9 o'clock at night on a Friday. He's willing to sacrifice and eat the short-term crap to get to the longer-term goal, like we spoke about earlier too. So I think it is like, there's a piece of it where you have to love it, but you have to, like, and that is what will motivate you to come to the desk and sacrifice those things. Miss a kid's game, miss a birthday, whatever it is, whatever point you're at, to get to that point of confidence. I think that's the big thing everybody listening should take from this. Mike and I and everybody here are not journaling because we love to look at our own handwriting or we like to look at it. We do it because we know it builds confidence in our actions in the chart, on the chart the next day. That's the only reason to do it. So if you feel like you have no confidence, it's normally, like 9 times out of 10, directly correlated even more to journaling than it is to lack of strategy. Because journaling will start to help you develop your own strategy. Even if you have none, you'll start to see patterns. That is the beginning of a strategy, a thesis. So it's worth it. It's just worth the work. I'm sure, Mike, you've got, I mean, in a book you talk about some, but you could probably share some now, like stories where you've had to sacrifice what personal things, family things to grind and grow your business and grow your knowledge. But it's worth it now, right? Family doesn't say questions about it now when you're going to Disney or when you're doing whatever, right?
That there's a fine balance to that too. Well, one of the stories that I shared in the book, it was that I was so focused to get the book done,
Yeah.
and to trade and to run Mara, was that I was going to sacrifice going to Sesame Place with my daughter and with my goddaughter. It was like the first time that they were going to go off and do a trip like that together, and it's just like, no, I can't do that. I'm going to go and do this, and I was I felt horrible about that to the point where I started to cry because I felt like I wasn't giving myself permission to be able to do those kinds of things, that I needed to continue to grind, that I need to get things done. But there's also a part where it's just what difference is an extra 30 pages going to make? It's being able to, and everybody's going to have their own priorities while you're going to, like, there isn't a right or wrong here.
No.
I just learned a lesson of what's going to be more important for me in that moment. And in that moment, I chose to go and be a part of this vacation and make those memories. Like for both kids, because at that age, it's important for
That's
me.
the why. That's the why, right?
Yeah, the why.
The why.
Yeah, exactly. It comes back to the why. So
let me throw one more thing in there, Mike, if I can, really quick, because I know we got to bounce for our next panel. But
Oh yeah, that's right.
I know, because you and me can just get talking, bro. I got to keep an eye on the clock, but it's you and me.
Yeah, I appreciate it.
I want to throw this in because I think this is super important. We talked about financial and mental capital on the first panel. I think Adam and Pat both did a really good job talking about that. You can burn yourself out in trading, and it can be nasty, especially when it comes to the journaling. There is value in taking time away from the chart. There is value in you going on that vacation. There is value in a break from the gym after you've just ripped up your muscles for a week. I was off. I didn't work out from Sunday last week till Thursday because I tweaked my knee. Thursday, I went in the gym. I had a nice energy drink to kick me up with some caffeine, but I was lifting really heavy weight because I was off for 4 days. Everybody in the gym, like all the guys I work out, were like, bro, you're on it today. You're on. I'm like, yeah, because I'm off for 4 days. I'm coming in hot today. Same thing happens with trading. If you do the good work and then give yourself the rest and let it soak into your brain, maybe sprinkle some trading podcasts like mine or yours on top of it on the weekends, you take that break, do the work, then take the break. Let the muscles repair, then go rip them up again the next week. Find the lessons, find the points of improvement, and then let it rest. So in routine, which we talked about a little bit here, routine needs breaks. If you just go, you're going to burn out for sure, either mentally or financially, probably mentally first. And your family's going to be pissed. It's just not why we got into this business. So you have to find a balance.
Right. Well, we're high performance race cars.
Yes.
And race cars need pit stops.
Yes.
Right. Like they're able to go at like 200 miles an hour around the track 100 times.
Right.
Not because they're just going to try to do that the entire time. They pull off, they get the quick pit stop, and then they're able to go. We need quick pit stops too.
100%.
So
great.
Yeah. Well, man, there's so much more that we could go into. They say that you need to leave them wanting more, right?
Yeah. I think we do a good job at that, especially when you got a talker like me on the panel today. I could just, you know me, Mike, I'll just go. I would say if I throw one more thing in, because I know we got to go, the routine, you have to be flexible in your routine, but disciplined. So what does that mean? It means flexible to say, hey, I'm off my routine today. I was up late last night, had my girlfriend's birthday or whatever, and we were out drinking, and I'm going to sleep in tomorrow and not trade. I don't have FOMO. I'll be all right to miss a day of trading. Market ain't going anywhere. Rather than not be flexible and be like, I went to the party and now I need to wake up and make good decisions. It's like, no, be flexible, be generous, give yourself the grace, like Adam was talking about. But then when you can be focused, when you're locked in, you got to stay on that routine, that disciplined routine. And I think the big thing too, Mike, because a lot of this audience is men. If you're not getting outside and getting in the sun and then also sweating, whether it's in a sauna or working out or whatever, you're building chemicals up in your body, everybody to a different degree. Guys like me, it's going to blow. And you don't want it to blow when it comes out on your trading desk. You want to get that steam off, like Crudele said, somewhere else. Go get it out and then come back. So the routine should include things that are not just trading beneficial, but mindful and physical benefits to you as well.
Mm-hmm. Couldn't agree more with all that. I want to answer Bob's question directly.
Yeah.
About how long does it take me to do my my process? So during the day, I probably spend about half an hour to an hour during the day. And maybe it's about 2 hours or so on the weekend. And that's if I'm doing it only for myself. If I'm not running a program, it's a lot quicker. But because I'm typing up notes and I'm sharing things with people, it takes a bit longer. But it on most days to fill out a trading journal, like I could fill out a trading journal in 5 or 10 minutes.
Right. And it gets
right?
faster over time, right? Like you weren't fast with it before. So some people are intimidated in the beginning. Just give yourself a week or 2 or a month of doing it every day. You'll get faster.
Right, exactly. And there's certain core things to track. Again, like I talk about all the things that I believe are core things to track in the book, and then all the extra niceties that I started to add on. All that's in the book too. But we do have another panel. I see everybody is hopping on in the background already. So we'll take a quick 5-minute break and we will be right back.
Sounds good. Thanks, Mike.
All right. All right, everybody, welcome back. Let me know that you could hear me all right. All right, cool. So this next panel, I'm going to be joined by a few great friends here. We've got Austin coming back, who we had in the last two panels. We've got Akil Stokes, and I'll introduce Akil. Welcome, Akil.
There you go.
Akil,
Works if I'm unmuted.
there you go. Welcome,
Austin?
welcome.
Good to see you, bro.
Glad to see you, buddy. So Akil is I'm going to just read everybody's bios because I think that works better. Akil is an investor, Forex trader, and coach. He is the co-founder of Tier 1 Trading. He has been featured in Forbes as one of the leaders in trading education. He is the host of the Trading Coach podcast and a proud husband and a great dad. Akil, welcome.
Nice to be here, man. I've listened to the whole thing so far. Amazing. I'm taking notes as well, man. So I love it. Love the info.
Awesome, awesome. And we've got Pat Walker that's coming back on. Pat has been trading for over 30 years. His goal is to help speed up your learning curve with proven systems and analysis. He is an investor, swing trader, educator, IBD meetup leader, and is the founder of missionwinners.com.
Yeah.
Pat, welcome back.
Good to be back. Thank you. Thanks for having me, Michael. I appreciate it. Good buddy.
Absolutely. And last but certainly not least is our very own Stuart Chalmers. Stu was one of the first elite program members back in 2021. He joined the Mara team as a coach. Stu has about 15 years of trading experiences. His key influences over that time have been Mark Minervini, William O'Neill, Jesse Stein, Mike Bellafiore, and a little bit from yours truly here. Stuart is absolutely phenomenal. I've learned so much from Stu over the past couple of years too. The student has really become the master, and ultra blessed to have him as part of the team and here on this panel. Stu, thanks for being here with us.
Yeah, thanks for inviting me, Mike. Yeah, it's a great pleasure to be here.
Yeah, absolutely. So, market and trade analysis. So, I'm of the mindset that our beliefs are what give us our perspective on the world. So, how we view markets and how we trade, how we place trades. So, how we deem things that are important to analyze and what's not important to analyze. So, it's kind of like how if somebody thinks that, oh, you know what, well, like I don't need a setup per se, or I don't have a setup, I'm just going to analyze. Well, everybody has a setup in my if you think about it this way. So let's say that the person that doesn't think that setups are important, well, if you get an idea from somewhere, crosses your desk, you take action on that, then in essence, that's your setup. It doesn't mean that it's a great setup. It doesn't mean that it's one that's going to provide you with an edge, but you got some idea from somewhere, you took action on it, then that's the thing that's causing you to take action. Well, we can do a lot better than that, right? I'm sure that everybody here everybody's nodding their head. Everybody in the audience you guys are probably nodding your heads right along too. So how can we do that better? I believe that we can analyze the thing, the trade that we want to take, and we could also analyze the environment that the trade is in. So an example, and one of the examples that I talk about in the Trading Mind Wheel is picture that you're going to buy a brand new car. Let's say that you're going to go get that Ferrari, right? You go into the showroom, floors are gleaming. A salesperson in a nice suit comes over to you, walks you through, explains all the details, and great experience overall. Next, you find that same car, but it's in a vacant lot. there's like some stray cats walking around, some overturned garbage bins, and like somebody in a plaid suit like comes over to you and like gives you this crooked smile, like, "Hey, you want half off?" Right? Like it's very different experience. So the environment matters. So I like to talk to you guys and get your feel, and just like in the other panels too. We could go around the room, but it's also meant for us to bounce ideas off of one another, right? Like how often do you get a group like this all in the same space, and we could all kind of rip off of one another, right? So we'll go around the room about how do you gauge market conditions, what do you consider and why, and do you limit what enters into your analysis? I'll let let's do it on a volunteer basis. Who would like to go first?
I can kick it off, or Pat. Yeah, Pat, you go, because I was just talking. Pat, you kick it off.
No, I didn't mean to interrupt. I'm sorry.
No, you're good. You're good. Promise. You go first. I'll follow up on you.
Doing these things, I'm overall very shy, so this helps me get out of my shell.
Listen, Pat, I'm a talker, so I told Mike, I was like, Mike, I'm passing the microphone, because otherwise I'm just gonna by nature.
No, I just didn't want to interrupt you, Austin. If you'd like to run it, I'll. No.
You go first. I promise. I'll follow you.
Okay. Well, thank you, sir. First off, I'd like to thank you all for being here. And one of the things they talk about is, they say, "Hey, don't steal. What thou shalt not steal." There's a lot of things we can steal. One of the things we can steal is people's time. We're not going to waste your time here. What Michael's done is put these groups together, and we're striving to convey knowledge, information, rules, tactics, and discipline to speed up the learning curve. When I started, there was no internet. I drew charts by hand sometimes. I still have some of them, all right? And that's from 5 moves in different houses through years. So the moral of this is very important. If you want to get better in the context of what this conversation is about right here, one of the best things you can do is study past winners. You can say, what do you mean? Take a look at the charts, print them out, mark them up on your computer. Take a look at the chart, study it, look for nuances in the charts. This is something very important. We don't operate in a vacuum, folks. We want to focus on chart setups. We're just talking charts now, not fundamentals. We can address that later. We're looking for chart setups that everybody can see, right? Let's flip that coin. Years ago, I had somebody call me up from California. A trader says, "You won't believe it, man. I found a chart pattern that is awesome. We're going to make money on this." I said, "Well, tell me about it." He tells me about it. I said, "Well, does anybody know about it, do you think?" "No, just you and me. That's it." And I said, "Well, yeah, I hear the people laughing." I was like, "Well, if we're the only people that know about it, do you think other people are going to buy it?" And he gets really quiet on the phone. He goes, "No." I said, "Yeah, we have to find and own a couple of," that's a true story, by the way. "Find and own, make it yours, a couple simple chart patterns." I'm not saying, just the cup and a handle. That's great too. Okay. Find a couple of simple chart patterns, refine it, own it, make it yours, and say, "This is what I'm going to do," and be committed to it. The problem a lot of investors have, and I hate to use the word traders, but I can say traders or investors, is they like switch from one thing to another. "Well, I'm going to do this. Oh, look, I see this. I'm going to do this." And you can become literally a jack of all trades, but you're not a master of anything. Mm-hmm. All right. So I'll circle back and say this. Find a couple of simple chart patterns that are repeatable, that happen frequently. We don't want to find a chart pattern that happens once a year. You'll starve to death. All right. Find several chart patterns that are consistently, statistically reliable. Hone your skills on that. Train it. Print out the charts. Mark them up. Put them on the wall next to your computer if you have to, and say, write it on the chart. "This is what I'm looking for. And do this, and turn off all the noise that's out there." I'm speaking from my heart. I have a couple of setups that I use, and I'm not saying, this is all the best things in the world. No, I'm not saying that at all, but they work for me. They've worked for me for decades, and that's what I do. And again, I'll say this last phrase. I turn off the news. You can say, "What the heck do you mean by news?" I don't even have cable TV going on in my office. I don't have it on during the day. I'm not knocking cable TV, nothing like that. It's just, there's too many inputs. Most of the information that you need, I'm speaking from my heart, is in the chart. Price and volume. Price and volume. Stocks advancing on a pickup in volume. People talk with their mouths and vote with their pocketbooks. Go where they're voting. How is that represented, reflected in the chart? Good price action backed by volume. No volume means other people don't see it, so they're not buying it. Don't impose your will on it. Leave it alone. Leave it alone. It works. I'm speaking from my heart. It works. Now, if you have a different way that works for you, good. I'm happy for you. This is what's worked for me for a long time, and that's what I do.
I'm kind of curious to hear about price and volume in the world of Forex. Well, we've got Austin, we've got Akil. You guys are the Forex guys. I've seen price and volume work well for me. Well, when I've traded crypto, right? I'm curious how it works in Forex. Is it similar? Is it a factor? Is it not a factor? Akil, let's hear from you.
Yeah, sure thing. Similar, but not exactly the same. I remember having this conversation years ago with Mike Bellafiore about Forex volume, because the difference is, because there's no real central exchange for Forex, there's no true volume. The volume that's represented is through the individual data provider. And I remember for years, I was highly against volume in Forex because, I was of the mindset like, well, if this isn't a real number that doesn't represent everything out there, how can I trust it, right? I'm a numbers person. You guys talked earlier about journaling and tracking. Like, numbers are everything, right? They're black and white. It's yes or no. So the fact that I could be getting this volume number, but it only represents kind of volume over here, but something completely different could be going on over there, was something I was always against. I never felt comfortable buying into it. And what has happened is, over the years, kind of, Forex started off as kind of like the wild, wild west when I first started trading, like 2007. So it was brand new, and it's calmed down after that. A lot of the kind of the scammy brokers and whatnot are gone, and there's only a handful of really data providers that you can actually trade with. And although the actual numerical value of the volume in Forex is meaningless, in my opinion, what isn't meaningless is the comparison that you can make. So when I look at volume in the Forex market, it's not necessarily looking for a specific number to be hit. It's looking for a comparison between, hey, how's the volume now? Volume spread analysis, something like that. How's the volume now based on the candlestick we see compared to the volume in the past in a similar candlestick, or a smaller candlestick with high volume, looking for those discrepancies. So big candle, high momentum candle, low volume, that's not lining up, right? Low momentum candle, high volume, there may be something there. So it's more about making the comparisons, which you can certainly do, even if you're not looking for, an exact historical number. I would say this too, the one thing that a lot of people overlook with volume in Forex is, let's say you're trading on like an intermediate time frame, like an hourly chart. Well, Forex is 24 hours, right? There are different sessions. There's London, there's New York, there's the Asia session, right? Typically, London and the New York session is going to be your most popular sessions, where most of the traders are interested. So you're automatically going to see higher volume on average during those sessions versus what you see in the Asia session. So if you're not taking into account what the sessions are, and you're simply looking at maybe the volume bars at the bottom of your chart, you're going to see this natural ebb and flow where it's always high volume, then it goes down, then it's up and down and up and down. And if you're not aware of why that is, you may be looking at a time and thinking something is low volume when it's really just a low volume session, or thinking something is high volume when it's really just a high volume session. So you got to be careful. It's definitely usable. You just have to, like any tool, you have to know how to use it the correct way, in my opinion.
Yeah, I totally agree with Akil. I was in the same boat. I always thought like volume with Forex didn't matter. It definitely plays a factor. I haven't traded a Forex pair since November of last year. So I've really been trading SPY and Bitcoin. Now this year, just SPY. I'm not trading Bitcoin anymore, only because the spreads with my broker have not allowed me to. But in seeing really 3 different markets now in the last 12 months specifically, what I think people who want to trade Forex and use volume should check out is actually a volume profile indicator. A volume indicator on its own is just showing you volume based on time. I'm telling you, with Forex, look at volume based on price, which is volume profile. And I think you can find really solid information in that indicator more than a time-based volume indicator. So take that for what it would be,
I agree 100%. It's funny not to get too mouthy, but like when I went off, I think 3 years ago, I went off on this big exploration of volume. Like after I, growth mindset, let's be open to different opinions and started studying it. And that's what I came away from is like, that's what I use now in my trading, that volume profile, because it will basically work the same as like support and resistance, where you can see instead of the actual candles, which again is only has so much relevance in the Forex market, you can see the price points that are interested or people are interested in it. And that has helped massively. So
everything's about
100%.
I think no matter what, like, look, I trade a lot of SPY now. When you look at SPX, I'm looking at 4,000, 4,100, 4,150, 40, these key price levels. I want to know, is there a lot of buyers and sellers there? I got to give a shout out to a guy on Twitter. His name is Jake. He helps run the company TrendSpider. He posts great charts on Twitter that show the volume profile being used. So anyone listening, go check out Jake's page. I actually just had him on the podcast. He does a really good explanation of how to use that on any market. He'll show it in Bitcoin, on a Forex pair, on a stock, on an index. Volume profile can be very helpful. I would just want to throw into what Pat said too, if I could. Having an entry signal, whether it's with volume profile, with an EMA, with any indicator, a MACD, whatever, putting your own, I think people should be more aggressive or more willing to put their own name to an entry. When you have a list of rules that you look to be, a list of parameters that you look to be filled, that's your thing. Call it a Pat 1. Call it an Austin 1. You put your own name to it. You do all those markups like Pat was saying about getting the reps in, what we talked about in the last panel too, Mike. Now you're building confidence in your own niche with your own set of indicators, with your own set of thing. And then take it a step further. You can pay someone or do it yourself to code it and then back test it over a longer period of time, over different time frames, all around that thing you do well. What is Austin's A1 entry? That's what we call it's his candle formation off a specific EMA with this other thing happening and this happening. And at this point, if all that is met, now duplicate that. That is getting niched down rather than just being like, I trade the 8 and 21 EMA cross. It's like, geez, bro, that's really, really not that specific. So you got to narrow it down, niche it down.
Good points.
Yeah, absolutely. Stu, I'd like to hear your take on volume, and then we'll move on to the next topic, because something that I started to learn from you was dollar volume, which is has a slight difference.
Yeah, I mean, I use dollar volume rather than specific volume, but that's kind of a stock market thing, really. But that's because I trade a lot of stocks that are on the thinner side and on the smaller side. So I need something that, rather than whether it's 100,000 shares or 200,000 shares, I'm interested in how much money is changing hands. Because what I'm looking for is traces of the institutions buying. That's where I'm wanting to enter my stock. I'm looking for, where are the big institutions starting to create positions and build positions for themselves? And I just want to ride their coattails until they start selling. And that's how I trade. So, and the way kind of builds on what Pat said, actually. When I started out doing this, I created a watch list of, I think it was about 600 names. I went back and looked at all the names that had moved more than 100% in the last year. And then I started filtering them down to the ones that have moved 100% in the last 6 months. And just started going through, and I had no indicators on a chart at all, absolutely nothing. And I went through every chart and said, where would I want to enter on an ideal world? Where was my entry and where's my exit? And I'm looking at the full chart. And I did that for all of them. Then I went and started overlaying indicators on and going, is there anything in common? And it kind of goes to what Austin said here about creating your own name for things, because it did. And you just kind of go and you start building up, like my dinosaurs and things like that. So I looked at these kind of patterns, and what have they all got in common? And then you start to build up, because what I was looking for was, I want to put my money in the stocks that I've got the highest potential to move the furthest in the shortest period of time.
Right.
And that's what I was looking for. And I'm not interested in anything else. So, but you've got to put the legwork in, and it took a long time, and then refine it and so on. But the basis of what I did there is still absolutely the basis of how I trade right now. So, and that was all those years ago.
Can I interject here also for a second?
Yeah, go for it, Pat.
As I stated, I've got a degree in psychology. It's one of my backgrounds. Let's pull back a little bit, and this complements what these gentlemen are saying. Charts are a reflection of human emotions. I want you all to think about this. I'm really serious. This isn't cute. It isn't funny. Fear, greed, panic, complacency. It's all reflected in the charts. All right. Study, as the gentleman said, study the price and volume actions. And you can see, and I say this all the time, people talk with their mouths and vote with their pocketbooks. Go where they're voting. When a stock is pushing up through a clean and simple base, you should look for some volume coming into it. Look at the volume pickup on this part. I could show you a bunch of charts, but I won't. But look for that. I'm not saying buy this now, by the way, but you will see that volume coming into it. Volume tells us people see what we see and they're buying it. That's what we want. We don't want to be the lone wolf out there saying, I guess I'm the only one in the world that saw that setup. Focus on those simple patterns and look for the volume surges, not just on the daily, but as the stock is hitting the pivot, narrow it down to an hourly, 30-minute, even down to a 10-minute chart. I don't do 5-minute charts, okay? And if you see that volume surge, it's telling you, hey, others see what I see, and by gum, they're buying it. That's confirmation to buy. If you don't see any volume, that means, I guess I'm the only person in the world that sees this. I better not buy it. That will really help you. It has helped me through the years. The volume, price talks, volume really talks. And we'll keep on. I'll back off and say this. That's what I'm doing. I'm not imposing it on anybody else, but it's what works for me consistently.
Well, how did you get those beliefs, Pat? Because they're strong and you have a lot of conviction, and obviously they work. So, but how did you acquire those beliefs?
Good question. As I stated, I was a sole supporter of a family of 6. I had to get this right. I didn't have a choice. My dad was dead. I don't have any wealthy relatives. I had to make this happen. So I had to study. And what I did, and I credit Bill O'Neill for a lot of this. I met him twice. The man changed my life. I will tell you, I'll give credit where credit's due. Studying price and volume, looking at the nuances of it, and you can see the vast majority, and there's an edge right there. The vast majority. Isn't that what we're looking for? If it works more times than not, there is an edge that we can use. Focusing on that volume, it's just confirmation that others see it and they're buying. I will love it. And team, I will share this. Team, that's what I call my group at Mission Winners. When you're going through, you will see that on daily, weekly, but narrow it down to that hourly or 30-minute. You'll see as it's hitting the pivot, you'll go, holy cow, look at the volume coming into this. I'll also share this. I'm a stock guy, okay? I don't do anything else, and I'm not saying anything else is wrong. No, just for me, I'm a stock guy. I do stocks, and I don't day trade or anything like that, and I don't scalp. And I'm going to share the reason why. Emotions. Nothing is more maddening than buying a stock and it goes up a couple of points. Like this is lifting off right here, fixed. Oh, look at the volume, man. It's pretty good. Look at this. Dag nabbit, I'm up 8 points. I'm taking the gain. And the thing goes up another 30 freaking points or 20 points. Don't do that to yourself. I used to do that. And I go, I'm sabotaging myself. You sell some, and this is psychology. You sell some into strength. And I'm going to stop because we're going off on a tangent. Sell some into strength. That guarantees a profit. That tactic guarantees a profit. If the rest of those shares come back to your buy price, you sell the rest, but you still made money. But by only selling a portion, if it keeps going up in price, you're still in it. It works. It relieves psychological stress, which leads to clearer thinking and allows us to let them work for a longer period of time. And I've had stocks, I don't even have them on my front page. I don't look at them. I've got an alert set, but I don't look at them. That's learn from my mistakes. Because everything you think that, gosh, what a stupid idea, I probably did it.
That's great advice.
So thank you.
Yeah, absolutely. I want to ask the group about quality trades. Like, how do you go about defining what a quality trade is. And by quality, like are you what are you considering? Like, are you considering things fundamentally, technically, time frame wise? Are there certain things like qualities that you're looking for in the trade? Are you looking for a certain is reward to risk a factor? Is the amount of risk in the trade a factor? Is trend a factor? Well, what sort of things make for a high quality trade, and what are some of the general things that everybody that's listening can start to figure out? Well, if I'm going to define my setup, these are the types of boxes that I want to make sure that I'm filling out. So that way we can be clear, right? Because clarity yields better performance, or one of the things that helps to lead to better performance.
Yeah. I could throw a quick one in that's
Go
been
for
like
it.
a new thought to me over the last couple of weeks. I spoke with Boris Schlossberg on my podcast, and he has been trading for a long time. He's a day trader, like a scalper, trades US 30. And he said one of the biggest things that traders should figure out is, are you looking to trade in continuation with trend, or are you looking to reverse trend? Just breaking it down on a simple level like that. Is this a trending trade or a reversal trade? So we could, I'm sure all five of us could speak to a strategy that we have, because we've all been trading for some time, and what that strategy looks like. But that would take 15 minutes, I think, for each one of us to break it down. What indicators are you looking at? What is this happening? What's the higher time? So I think the first thing, simple thing that anybody can think about is, are you trading in trend or are you trading continuation? And if you trade something like, for me, trading SPX, I want to know what the Fed is doing. I know Pat mentioned a little bit how we're going to get into fundamentals, but like, I don't fight the Fed. I think that's something that's been impressed on me from the beginning.
Amen.
Right. And we all just saw what the Fed did in the last month. What did they do? They cut their QT and went back to QE, and they cut 2/3 of their tightening back. So the Fed is now buying assets. What is that going to do to SPX? Probably not send it much lower. So that will build the fundamental basis to then feed the technical idea. So I think it comes together in both ways. And for me to have like that A+ trade, it's when technicals and fundamentals line up. Deeper than that, it's when I get my because I trade in trend. I love trading a break and retest of a significant price zone. I love to look for a good pullback and find a trade on that retest. So if I can find technicals and fundamentals that fit and match in a bias, long or short, if I can then go in there on a lower time frame, 15-minute, 5-minute, find my breakout and retest for my day trade, that's my high quality trade right now. And that could change. If markets change, especially because I trade SPX, we have to adapt. Like if we go into full bull run again, everything's going to go different, So I think you've got to skirt the line. But to your question, Mike, I think a lot of traders should just ask themselves, are you a continuation or a reversal trader? Is this trade a continuation or a reversal trade? You could do both, but which one do you do better? And I think that goes back, like Pat had mentioned, your beliefs, your initial knowledge about money and markets and all these things that are imprinted upon us throughout our lives, on which way you'll play that better.
Interesting.
Good point.
Yeah,
Akil? Stuart, you were about to...
Yeah, I was going to say there's three things that really, for me, determine whether it's an A trade or not. Really, the first is the cleanliness of the pattern. So how well does it conform to what your model pattern actually is? And none of them are absolutely perfect, but how close is it to that? The second one is probably around the position on the chart, because you will see that you often have patterns, but they're just out of position within a chart, or something that breaks them or whatever. So I look for that, and then that has all the different boosters and all these things that would go along with that. Is it in a good group or whatever? But the last thing for me really is the risk reward asymmetric in my favor. And I look for something that's going to give me at least 5-1. So is this got potential 25% plus move, and is my stop less than 5%? And with all those things come together, then that to me is an A+ trade. It doesn't mean to say I would take it, because it may be something that stops me that I don't particularly like about it or whatever. But that's what would get it through those filters to say I'm considering this one. And if I have 2 or 3 of those, then I'll be looking at which one of those is the highest probability bet.
I like that.
Yeah, me too. Akil?
Yeah, so I'm a firm believer in rules-based trading. So we'll make this as simple as possible. How I define a good trade or a quality trade, it's either black or white. It is either a trade that meets all of my rules to take, or it doesn't. So we want to eliminate any gray area. I believe that if you ever look at a chart and and I have to look at a chart and think about, should I be taking this, yes or no? The answer is no. So I am a price action trader. I'm a discretionary trader, which there is going to be some subjectivity in that. And I like the art form of that. Trading is an art and a science. And I do like the ability to interpret. But kind of like Pat said, there are some very specific patterns. There are some very specific setups or specific signals that you should be defining. You should be writing out what they are, when they occur, how you trade them. What are your stop loss rules for it? What are your targets for it? And there is some flexibility in that. But when it comes down to the decision of, should I take this trade or shouldn't I take this trade? We need to take our emotion out of the equation, right? We spoke about fear and greed earlier. And man, if you think it's hard just sitting here hearing about it, like try it when you're looking at a chart. Try it when there's real money on the line. Like, typically our previous result will have a massive impact on how we view our next trade, right? If our last trade was a loser, maybe we're a little fearful to get into this one. It has nothing to do with the present setup, but we're holding on to the baggage from the past setup, or maybe we want revenge and we got to make that trade back. So we start doing dumb stuff with our position size, right? We want to be as mechanical as possible. We want to, again, take the human emotion out of it. Now, all of that stuff is done beforehand, and the testing, and you're tracking it in the journaling or whatnot. But when it comes down to the chart, we need to be mechanical. So have clearly defined rules. I like using an if-then syntax. So it's kind of like I'm programming something, right? If this, then that, if this, then that. So it's basically like a checklist I can go through. If I complete the checklist, then boom, it's a good trade. I fire it off. If there is one box that can't be checked, then I can't take the trade. And there will be setups that I really want to take. But some I can't do it if they're not all checked off. So I think we eventually want to have our trading set up like that. Now, I would follow up on what Austin said earlier, which I like, just speaking about, I call them home run trades, but like your grade AA trades is if you are knowledgeable about the fundamental environment or the overall environment of your market, and you see a specific instance where maybe your technicals are lining up with a bigger technical play, or your technicals are lining up with a bigger fundamental play, those are the opportunities. And I would say only for experienced traders. Newer traders, just like stick to your plan, do not deviate. But those are the opportunities for experienced traders to go for a little bit more, where it's like, hey, I'm going to hold on to a partial position in case this goes higher, or I'm going to do this. And obviously we're managing on the back end. But I think that's what you see with your bigger and your best results is, we chip away at these normal trades, chip. And then every once in a while we get an opportunity to kind of hit that home run trade, and we take advantage of it without kind of adding the extra risk on the back end. So yeah, that's how I view it. Black or white, rules-based trading. Either it does meet your rules or it doesn't. If it does, you take it. If it doesn't, you leave it alone. You can always evaluate. And if it's something that doesn't meet the rules fully, you evaluate, you track, you take notes, and then maybe one day it gets added to your repertoire.
Yep. That's exactly what I was just going to say. You took the words out of my mouth. That journaling, that documentation of it will eventually either build confidence in it or tell you you're crazy and you should stop doing this immediately. You know what I'm saying? So absolutely, I totally agree with that, Akil. And I think in general, being a rules-based trader means you're more attached to the process than the outcome.
Yep.
I love when I get the thumbs up. Pat, I'm on it with Pat. Pat's like, yes, I love it. Yeah, that makes me. I know I'm talking the good stuff.
I was looking at Pat's screen the whole time, just waiting.
I know, right? I'm like, all right, Pat's reacting. Like what I'm saying, or no.
Okay, I'll keep going.
But you know what? This is really hard for traders to get into their thick skull. Sometimes it's like, hey, you could have the perfect setup. I had guys in my group 2 weeks ago on EuroCAD waiting for this long. It presents, they take it, and it was great setup. It literally, for some reason, no news, just stopped them out within like the fastest stop out within 2 minutes, extremely quick. Beautiful setup. But if you attach yourself to that outcome, you're going to question your rules. You're going to question your back testing. You're going to question everything. But if you instead peel that back and say, well, what was the process? Has that process been winning more times than not in the past? I'm going to do it again. I'm going to go at that again, because I know from my back testing and my confidence there, this is maybe 1 of 3 out of 10 losses, or 4 out of 10, whatever it is. It's still probabilistic in my favor. So it's tough to do. But when you get, and this is like kind of tying a lot of our points together today, but like when you get to the point of you're not trading because you need the money, you're trading because you want to trade well and you want to scale and grow a business, the outcomes are irrelevant. Like Crudele said, they're one data point on a data plot that is infinite almost. So you should see it like that. And I think that helps you also. If you think about them as data points, you think about the individual trades, even if they're great setups, that you start to say, even if it's a great setup, because I know the outcome is unknown, I don't need to put more than appropriate risk on this. That's where you get into gambling. Now you're trying to pick one anomaly, one statistic out of a bucket of statistics, which normally, back to my trading universe comment earlier today, it's going to be like, oh, good try, buddy, and smack you down. You know what I'm saying? So I think rules-based, I think every trader should be that way, in the mindset also of process over outcome. If you get a good process, long-term, it will pay your bills. If you get short-term outcomes, just like the people who win the lottery, they still end up broke.
Yeah.
I would add this real quick. Oh, sorry, go ahead, Stu.
Oh, yeah.
I was going to say the ultimate goal is consistency, so that you do every single trade exactly the same.
Exactly. Yes.
I would say this, we often hear about the term like trading intuition, and you get a lot of new traders. I'm trading off of my gut feel. I feel like this one's going to win. And like, that is complete BS, right? Yes. Especially as a newer trader, because your gut is just the gambling gut.
Yeah.
And there is a difference. So experienced traders, we do have intuition. Stu mentioned this earlier. He has different setups perhaps. And, maybe one shows this edge that another one doesn't see or doesn't have. But the difference between an experienced trader trading off of intuition is this. Our intuition is based off of something. It's not just like, it's Tuesday, I feel like today's going to run, right? It's based off something we've seen in the past. And maybe we don't recognize it at first, but we're smart enough and professional enough to go back and dive in and be like, what is this? How come this type of trade, like always these seems to pop? And then we go into detective mode and we find it. And then once we find it and we test it and we realize like, hey, this does increase my edge, or maybe when this happens, I shouldn't take a trade. That's when we add it, we make it rules based, and we add it to our equation. So it's this feeling, but it's just not trading off this feeling or this intuition. The intuition is based off something we've seen repeatedly. We just don't know what it is. And instead of rushing to trade it, we're going to go find what that thing is, research it, make sure it really does what we kind of think it does. And if it does, then we can add it, and that takes our trading to the next level. So for you guys out there that you think you have intuition, there's nothing wrong with that, but just don't go trading it right away.
Right.
Find out what that is, see if it's real or if you're just making it up. If it's real, you trade it. If it's made up, you leave it alone.
You're approaching it like you're a scientist.
Exactly. But I think the new trader, like you said, Akil, their gut intuition, I don't want to say this because it's not a certainty, but it's like tends to be wrong. The new trader will see things rising and try to sell. The new trader will see things go hit a level. This is the time it's going to break through this level. Things like that, where you as an experienced trader, that isn't the way it's probably going to work. Of course, nothing is certain in trading. It's always the word probably, but like the new trader is actually normally wrong. And I think that's in when they follow intuition. And I think that's why you see so many people say 90% of traders fail. It's because they come in trying to be intuition traders, gut feel, because they think for some reason that would make sense rather than being rules-based. So I think new traders come in rules-based, develop the discretion, like you said, Akil, develop it over time through markups, through practice, through chart time, through desk time, then start to feel your way around. And I also would, from my own personal experience, I would say you cannot even talk to me about discretion until you understand fundamentals. Technicals is not discretionary. Technicals is half of the picture. If you're going to be discretionary, you need to have a bigger picture of what's going on fundamentally with the market you're trading, whether it's the Fed and SPX or the Bank of Canada when you're trading EuroCAD. Doesn't matter. You got to know the fundamentals that are driving that market if you're going to try to feel your way through it.
Can I, complementing these statements, and I'm not trying to sell you on something here, but something that really helped me was when I read Bill O'Neill's book, How to Make Money in Stocks. The man changed my life. I got to tell you this, and I'm not trying to get you to subscribe to anything. That's not the motive here at all. But tied in, complementing what these gentlemen are saying, rules-based, having foundations. You should be able to get to this point where a stranger could come up to you and say, what do you look for fundamentally in the stock that you're considering buy? And what do you look for technically and why? You should be able to document that. And I'll share this with you. And again, these are things that I've talked about for a long time. This is from a book called 40 Great Stock Market Winners. These were stocks that made huge moves. This is research from Bill O'Neill and company. And I just want to share this. These are facts, okay? Facts. These, again, they were up 20%. No, I'm talking stocks went up 100, 200, 300% over the course of their run. Wow. 87% of these stocks, by the way, that's a statistically valid number. 87%, basically what I'm saying, almost 9 out of 10 of these stocks that made these moves had these constraints. 9 out of 10, I'll go to the bank on 9 out of 10, all right? 87% of these stocks had earnings up 30% or more before they broke out. Basically, 9 out of 10 had earnings up 30% or more before they broke out. 7 out of 10 had earnings up 50% or more before they broke out. Wow. Now, all of a sudden, what are you doing? You're quantifying things and you're narrowing your universe, saying, I'm going to look for this stuff and the heck with everything else. So there's the earnings numbers. Let's go sales. Here we go. 86% of these stocks that made huge moves had sales up 30% or higher. 86. Folks, that's an edge you could go to the casino on, but we're not gamblers, okay? We're investors. Use those numbers. 86%. 63% of them had sales up 50% or higher prior to their breaking out. Wow. You can use those numbers in development of your screens and say, when you finally get to the point where you get so mad and say, the heck with it, I'm only going to look at stocks the last quarter's earnings were up 30% or higher, or last quarter sales were up 30% or higher. I'm going to dramatically improve my investing results. That's an edge you can use that will make you money. Also, the last point I'll make related to this, I'm going to read this to you. This is important. This is research that this changed my life, okay? Stock market history shows, I'm not going to read too much, don't worry, okay? That gets up. Stock market history shows that the best stocks to watch often have a composite rating of 95 or higher, okay? Composite rating is a number I use. And again, please, I'm not trying to get you to subscribe to anything. You can develop these own filters yourself in your software. Focus, I'm going to be brutally blunt. Focus on stocks in leading groups. Focus on stocks that have either great earnings and or great sales, over 30% or higher. Focus on stocks with a high composite rating. Focus on stocks with an accumulation distribution of A or B. Focus on stocks in the top 40 groups. Focus on stocks within 20% of 52-week highs. For me, that's it. I'll put that up against anything I've ever seen. I need to say this, though. I'm not a day trader. I'm not a scalper. If you are, great. I'm an individual that tries to buy it and let it work for as long as possible. Last point I'm going to make related to that. You get one and it's running for you. You want to sell some, but don't sell it all. Don't limit your profits, limit your losses. If you sell all of it and it keeps going up, you're missing out. Let some work for you. But by selling some from a psychological perspective, you've relieved that stress and tension. You know you're going to make money, which allows you to let these other shares work longer. Right. Don't get sloppy with them, but it works.
That's a great point. Because what are you going to do? Pat, what are you going to do? Sell it and close the position full and then get in at that now worse price?
Right.
No.
Yeah, drive you nuts. Oh, and then tied it. That's great. I'm glad you said this, Austin. And then there's the other thing. It's like you sell it all and you go, oh God, it's still going. Geez, right. What am I going to do? And you buy it and you buy near the top. You go, what did I just do to myself? I just beat myself up. And true confession, I used to do that.
We all did.
Same here.
Yeah.
I mean, it's don't sabotage yourself.
Yeah.
Don't sabotage yourself.
Agreed.
Leave it.
Yeah. The funny thing is, with all of us, we all have to touch the stove. Every good trader that I've ever met, You can't, you could have never sat them down and told them what to do exactly. They need to go touch the stove on a couple of different issues, and everybody's issues are different. They need to feel that heat a couple of times before they go, yep. I get it. They were right. I get it. Like, I always have this story. My dad, I was dating this girl in high school, and in my head, when you're dating your first girl in high school, we're all the same way. You're like, I'm marrying this girl. This is it. Like, I'm locked in, you know? And then dad comes in and dad's like, listen, brother, you might think that now, but probably not. And I'd be like, no, you don't know what you're talking about. Well, my dad was right. You know what I'm saying? Because throughout that experience, he had been trying to tell me what was going to happen, but I had to touch the stove myself. I had to learn myself. So I think that is a character. Good traders are a little stubborn, right? Yeah.
Can be, for sure.
Yeah.
To share what my process was like, because my process is very similar to Pat's. It's actually fairly similar to a lot of what Akil had mentioned, as far as black or white, like clearly defined setups, and of course a lot from Stu too. Like, I've taken a lot. So here's how I've kind of integrated different things. So I start out with the universalist, like, well, what we were talking about earlier, right? Like, Austin has the universalist too. So screening based off of, and I'm trading stocks. I'm mostly trading stocks. So I don't want to trade all 10,000 stocks. I want to narrow the list down as much as I can to roughly about, there's 300 stocks in my quote unquote universe right now. And the way that I'm doing it, I'm running the same screens all the time. So I'll run the same screens on the weekend and build the universe list. And it's fundamentally based. There's some technical criteria in there. And I share all the nuts and bolts in the book. And I post a lot on the free newsletter. Like, there's so much stuff that's out there for free. And like, I'm sharing all that stuff out. It's not just like, oh, go buy the book. Like, that book is great. But that's not what I'm trying to say here. So we want to filter down into a universe. So that way it's saving us time. And one of the important things about saving time, especially like if you're just starting out, like you're new, you're part-time, you've got the day job, you're doing all kinds of things, you've got the family, you've got kids, you need to save time. And that's one of the things that allowed me to trade part-time and eventually get to a point where I was having consistent success. And now this is the full-time thing. I wasn't always full-time. Like, I started out trading part-time for years and years. And it was really only about 5, maybe 6 years ago that I had finally built up the capital and the cushion that from having traded consistently well to transition to, okay, now I'm going to do this business full-time. So narrowing down the universe and only trading a small handful of stocks, fundamentally, technically. But the important thing in there, it's not what Mike's criteria is. It's having your set of criteria and doing it consistently. When you're doing it consistently, that's when you start to see all the little nuances pop out at you. So there's that part of the universe. Then I'm looking for the setups that I've defined. And I like to define setups in a couple of different ways. I'm looking at the depth of the pattern. I'm looking at how long the pattern is. Personally, I like to swing trade. So my average holding period tends to be about 20 days on a winner. The reason why I know that is because of the journaling and post-analysis that we talked about in the earlier panel. So average winner is held for about 20 days. So I know what I'm looking for in this particular pattern. I want it to have a certain depth. I want it to have a certain length. I want it to have a certain depth and length around the pivot. The pivot is where price is going to break out. So I want to have that part clearly defined. And I want that to be a certain length and depth too. And it's slightly different depending on the pattern. On average, say about 5% on average. That's what it happens to be for me. Then for the pattern itself, and what we're talking about so far are those black and white criteria. If it makes this, great, then it's eligible for the next step. If it doesn't make this, then as much as I like it, I'm kicking it to the curb, just like what Akil was saying. So then I'm looking at the overall characteristics of the pattern. Depending on the type of pattern, the criteria might change. So a couple that you might know of, like a high tight flag has certain characteristics versus a cup with handle looks a bit different. And so how would you describe those kinds of things? Once I get through all that, and also the other part of it too has to do with the environment. So where is the trade in the trend, and how's the overall environment for this thing itself? Is it good for this type of setup? Is it not? Where is it placed within its own trend? Because for those of you that might be familiar with Stan Weinstein and his work, How to Make Profits in Bull and Bear Markets, he does this whole trend analysis, and it was the first place where I heard this, where you have a stage 1, a stage 2, that's when you're in an uptrend, stage 3 you're topping out, stage 4 now you're in decline. We only want to focus, or I only want to focus in stocks that are in stage 2 uptrends, because that's what's going to help give me the best probability for success. Great, so I've got all that stuff all baked in. Then from Stu, I started to learn about, well, you could add on all these other boosters to the trade, right? Like start to pick up on the subtle nuances. And the only way that we're going to learn about these nuances is if we're using something consistently. So if you're doing indicators, if you have a certain indicator that you're using, whether it's price and volume, like I think about all these things as indicators, but like if you're using a stochastics, if you're using relative strength, whatever it is that you happen to use, if you're using those things consistently, then you'll start to pick up on, oh, well, when this trade breaks out and it works, it tends to have these certain characteristics. Well, with the price and the volume, with the indicators that I'm looking at, all these different things. Great. So that's what's giving me back to the gut feel part, right? I think it was Akil that mentioned gut feel, like having like a different gut feel. And if you're new, like don't really trust your gut. If you're experienced, maybe you trust it a little bit more. I'm not like I track my gut feel, but I want to not let it be the be all end all of what I'm going to do. So like it counts, but it's just like this much, right? A small portion for gut feel. Then after that, right? So, and checking, verifying all that stuff, it goes faster to do it than it does to explain it. The last part of it, like once I find this level 5 trade, this potential A-level trade, then I run it through what I call the trade gauntlet. Like I make it run the gauntlet to see if it's something that I actually want to put my money to. This is a tool that I came up. It's actually available for free on marrowwealth.com, and I talk about it in the book too. But basically, I have it go through all the different things that I'm interested in. Does it have the earnings and sales and the projections? Does it have the high probability, high reward to low risk setup and clearly defining the entry and the stop and the targets? How many confluences are around all those different things? Is it a growth? Does it have the game changers? Is it a leader in its group? And what's the environment? All that stuff produces a score. And then if the score is above a 7, then I'm automatically putting an order for it. If it's below a 7, even if it's like a 6.99, I'm not. And the reason why all has to do with the prior panel. When Austin and I were talking about journaling and post-analysis, because I went through all my prior trades and I saw that all of the best ones, not 99%, but all of them scored above a 7. So great. Now I'm just going to eliminate all the ones that score below a 7. Some of them went, some of them didn't. But because of the post-analysis and the journaling, take 7s.
Yep. Love that.
So anyway, the end of the rant there. But yeah, so we could go check that stuff out. I want to make sure that we have enough time to hear the answer to this question from everybody in detail. We've got about 15 minutes left for this panel. If you were starting from scratch or are working full time and wanted to give this trading thing a go, what would you analyze and how would you gather the data?
It's like far as markets or analyze
Yeah,
like
that's
specific
that's a very vague
yeah, what's
question.
is there a
I would say
So
I would just find a good mentor. There's so many good mentors out there. Like start testing the waters. Test out Akil, test out Pat, test people out. People that jive with me might not jive with Joe down the street. You find a mentor, it'll change the game. That's what I did. Like I didn't reinvent the wheel. You find good mentors. And of course, you want to consistently find mentors, but like to just show up to a chart and be like, how do I want to make this? There's so many options, man. You could trade with indicators, without indicators, like what time frame, like what do you, so many options. I would not just drop in like that. I would study someone who already has what you want and duplicate, tweak and duplicate.
Yeah, I think I'd agree with that follow up. I think the first thing you would analyze is just either a mentor, or coach, something like that, or just analyze the market in general. Just like take some time to familiarize yourself with what the market is, especially if you're brand new, different types of markets, different, strategies, trend continuation, counter trend, indicator, price action, fundamentals. Like take some time to kind of just get a very base knowledge of what the financial markets are in general. And then I always believe in starting with a strong foundation and building up from there. So it's a very tough question because we don't know if it's specific markets, specific strategies, but I think the first thing is like, don't jump right in, right? The last thing you should do is fund an account and even think about trading live, right? You should maybe write out a plan where it's like, hey, I want to start doing this a year and a half from now, a year from now. Give yourself a lot of time, because if you give yourself time, there's no rush to trade. You can focus more on learning. So like if I were to start today and I would get, what is this, April, and I said, hey, I want to start, let's just say January 1, 2024 or whatever like that. What that does is it takes away any temptation to trade, or removes most of the temptation to trade. And I can fully start planning out, okay, I have this many months to do this. I'm going to spend this many months looking for a mentor. I'm going to spend this many months doing this many months doing that. And that finish line may and probably will change as the journey goes on. But, give yourself time to kind of learn the basics, whether it's about the markets, whether it's about, what mentor or, what type of strategy you want to trade, but give yourself time.
Yeah.
There's wisdom, wisdom in that statement. I am tied in with what Akil said too. Here's the analogy. You want to learn how to swim. Okay, let's go to the swimming pool. Oh, I'm going to go jump in the deep end. What? No, don't do that. Please don't do that. Go in the shallow end. Go smaller. Refine your skills. I used to tell this to people at the IBD meetups for years. Okay, if you're not making money with 100 shares or 10 shares, you're not going to make money with 1,000 shares. Start small, refine. And again, that's what these gentlemen alluded to, and they're spot on. By the way, this is great. This is a great panel you got going here, Michael. And here's why. These folks right here, they do it for a living. It's not like, well, it's kind of what I think about. No, they're in the trenches. All right. They're living off of it. Okay. Yeah, I'm living off. So the idea of start small, refine your skills, observe, study, take notes, print out the chart and write your thoughts on the chart, what the market was doing at that time, why you did what you did. Own it, make it yours, and then go back and periodically study it. Yeah. Study those charts and say, yeah, I was right on this, or no, I'm not doing this right. Be truthful with yourself. Yeah. I'm going to pull all this together right here for this part. I like to focus on simple patterns that everybody can see. Okay, it doesn't need to be the cup and a handle. Simple patterns that everybody can see. Why? It increases the probabilities that A, they see it, and B, they'll buy. And then what do I look for? Say it again. When it's pushing through that line, look for volume confirmation. Volume means that other people see it and they're acting. Also, this is important. Charts are a reflection of human emotions: fear, greed, panic, complacency. And you can see it all in the charts. Has anybody here ever really thought about why a double top forms? Most people, they don't even think about it. No, we need to know this stuff. It'll make us better decision makers. What happens? I don't know if I could find one right now because this one pushed through. But frequently a stock will run up, pulls back, and it runs back up to the top here, and it backs off. Why? Think about this. The people that bought it here and watched it drop to here and come back to their price, go, thank God I'm near my price, I'm selling. The people that bought it down here see it runs back up to old highs and they say, I got a decent profit. That's normally where it stops. I'm selling. And folks, normally that happens and then it forms a little handle. That's why the cup and a handle formation is such a powerful formation. From a psychological perspective, that little handle gets rid of the last of the sellers. When the last of the sellers are gone, any buyers are going to push it off. I'll back off this and say, if we focus on a couple, be a master of 2 or 3 setups. And that's it. Forget everything else. Master those, own those, never argue with price. All right. And the last point I'll make, then I'm going to stop. Always be humble. Always be humble. I'll say it again. If you're not humble, the market has a lot of ways to humble you. And I have had grown men call me up crying, saying, I don't know what the, and you know what word, I don't know what the F I'm doing here. All right. We don't want to get to that point. That's to me the usefulness of what Michael did here to help speed up the curve. And I have to share this with you. All right. I've read a lot of books. I thank God for this. I've met some great investors through the years. I've met Martin Zweig and talked with him a couple of times. All right. I've met Ed Sekoda. All right. And did he challenge me? Every time I said something, he would look at me and tilt his head back and say, why do you think that is? Always challenging. He had an impact on me. Bill O'Neill's another one. Mike Webster's another one. Great investors that challenged me and had me thinking about things that'll make a difference. The last point I'm going to make, and by the way, this is from Pat Walker. Okay. This isn't anything else. There's no subtle subterfuge related to this. This is, Michael sent me this book. Okay. I don't know if you can all see it. Let's see. Is that working? Anyway,
Yeah.
Good read.
I got this book. And again, please, he didn't ask me to say anything. All right. And if he did, I probably wouldn't say anything. But the trading Mindwheel, myself and my business partner, Owen, both have read this book. This is a good book. And here's why. I'll share this with you. And again, Michael, on the Bible, Michael didn't ask me to say this. Okay. Nobody did. This is from Pat Walker. It talks about analyzing yourself. It talks a lot about psychology. Folks, if this isn't screwed on straight, you're not going to make any money. All right. That's a fact. He addresses that in the book, but he also talks about technicals and fundamentals. It is a good book. Okay. And I'm not lying to you. All right. That would be immoral. I don't do that. It's a good book. I recommend it. It's worth the money. You'll make money from it. It'll speed up your learning curve with the time you have. We all have the same amount of time. There's nobody here that has more time than anybody else, but it's how we use the time that counts. Invest in yourself, invest in research, find out what works, statistically valid sample sizes, and say, I'm going to do this, and I'm turning off the noise, and I'm not doing anything else. And that's not being arrogant. That's just being forthright with yourself. Always be thankful and always be humble. Always. All right. I'm speaking from my heart. Always be humble. I just had to share that with you. But this is a good book. This is a good book. So anyway, and again, Michael didn't ask me. I'll say it again. If he had asked me, I wouldn't have said anything because I don't do that. You can't.
I appreciate that, Pat. Thank you. Yes. Hey, Akil, I saw you chomping at the bit earlier.
No, we're good. I'll save it for a later session. Yeah.
Stu?
I'm sorry if I talked too much. I apologize.
No. Pat, listen. You spit fire and you talk gold. So anything that you have to say is very much appreciated by me, the panel, and everyone here.
Thank you.
Stu, did you have anything to add? If we do have time, I'd like to get to some
just
of the
really
to
kind of follow up on what Pat said. Because what I was going to say is you really need to analyze your situation and yourself and how much time you can actually invest in this this venture. Because most people underestimate just how much there is to learn and just how long a journey it can be. You will often get success early doors, but it's the consistency of that success. And to go from not having traded to be a full-time trader think is a fairly large commitment that a lot of people, underestimate.
Good point. It takes
Great point.
time.
Yeah.
There's no substitute for seat time. That's the truth.
Totally agree.
The chat is starting to blow up. I'd like to get to at least a couple of these questions if we can. Maybe we could do them rapid fire. Here's a question from Daniel. When your core strategy doesn't work as well in certain market condition over a period of time, or you rarely find any stocks that fit it, what would you do? Go for it, Pat.
Stop.
Yeah.
I'm not trying to sound like a smarty pants. Stop. It's that market action is not conducive to what you want to do. And again, I know that you could say that came across really crass how you said that, Pat. I apologize. I didn't mean it that way. If it's not working, don't force it. Don't force it. Get in line with, if you can get in line with the markets and have the wisdom and the discipline to know when to back off and not do anything, you'll be better for it. You'll be much better. You'll live longer. Okay? You'll live longer. Don't impose your will on the markets. I'll say this again. If you focus on the leading groups and the leading stocks in those groups, you will dramatically improve your investing results, leading both fundamentally and technically, and looking for clean and simple basis. But when the market's bad, you could hold a gun to me and said, make money. I can't. I can't. So I'll wait. So just because the market's open for business doesn't mean we have to do business. I said that for years at the meetups. We wait. Anyway, that's all.
100%. Develop sit-out power, like Mark Minervini likes to say. Mark's coming on later on.
Yeah.
Anybody else have anything to add to this?
Let's say you could go fishing like Jesse Livermore recommended as well,
Right.
Fun fishing.
Yep.
Call it a golf day, man. It's a golf day.
But I think the big thing is the adapt. You got to adapt. If you're like, oh, it's not working today, and then that continues to happen, something's up. And normally to adapt, I don't think I'm not a rocket scientist. I'm not going to just think of the adaptation and then go test it and see if it works. I'm going to just take in some new information. I'm going to go look to someone, look to a trusted source, look to something to give me new knowledge, and then make the adaptation. So,
yeah. So I'll add that, we need to know our system inside and out and what it produces. And for any system to work well, it needs to meet these three things. It needs to meet our goals, whatever our goals happen to be, financial goals, lifestyle goals, all those kinds of goals. It needs to align with our beliefs. If it doesn't align with our beliefs, then we won't be able to execute it at all. And the third part is that we actually have to be able to execute this thing. So we could believe that a system works, but let's say that the system needs to be executed for day trading or scalping, and I'm working while the market is open, that I might not be able to execute that system well. So we need to make sure that the system meets those three things: our beliefs, our goals, and our ability to execute. And so if one system is not meeting our goals, and we know the system inside and out, then we might need to find either a different system or a different way to use that system. One of the things that I actually spoke about in the book was how I took my swing trading strategy and started to apply to day trading, because I noticed that a lot of the patterns on the higher time frames work on the smaller time frames, and that gave me another way to use the same system or a very similar version of it in another way. So hopefully that helps. Let's take one more if you guys are all right with it. We're a couple minutes over here. All right, let's see. We'll do one more here. Yeah, I think that this might be a good one to end on. And we'll answer every question is going to be answered. If we don't answer it right here on the stream, because we've got so many people joining us live, we'll answer it by email after the conference is over by the end of the week. the last question before we wrap things up. Any advice for part-timers who are like me, just building up their accounts along with the 9-to-5 jobs?
Yeah, sure. Focus on the process. I think we've all been preaching that the entire time. I think the biggest mistake that a lot of traders make is trying to do it too soon. Like I said, seeing the money, and I have to make this amount of money this quickly. I have to take this, $1,000 account and turn it into 50,000 in the end of the year. And you understand that it's a consistent process. Like the money will come. If you understand the power of compounding and how money works, you shouldn't be worried about how much money you're making. Just worry about the execution and that average percentage gain, right? If you're making 40% a year with a $100 account, right? If you execute the same way, you can make that 40% a year with a larger account by not really doing too much differently. So you have to think of a big picture. You're starting at a smaller moment right here, and it's going to be an investment in years. But if you master your process and you keep doing the same thing repeatedly, and you keep, refining your edge, and maybe it allows you to get even a little bit riskier with money management and position sizing, you're going to be able to one day make the gains that you initially wanted. It just takes time because it's about the process of executing the trade. The actual money or the profit is based off of your account size. So don't be in a rush to kind of blow your account by trying to grow your account, I guess you can say.
Great advice.
All right. Wants to go next?
I could stem off of that. I think we've talked a lot about expectations, so Akil kind of hits it right on the head there. I think for me, success in trading, just like in sport, comes down to how bad do you want it. So if it's passion met with hard work and dedication, I think anybody can make this work. So if you control your expectations, you meet it with passion, you meet it with an open mind. Akil said this, and we did not talk about it enough, just growth mindset versus fixed mindset. You meet it with that open mind, that growth mindset. I think anybody can make this work. So that would be that would probably be my answer, is keep that growth mindset at the forefront of everything that you do. And I think it actually, and I know Akil believes this because I know Akil is a great coach off the trading desk as well as on the trading desk. But like when you start to look at life from the growth mindset, not the fixed mindset, the world is your oyster. Possibilities are endless, and you actually become a better person. You become more optimistic. You become more positive. So I think that would be my little sprinkle on that.
Yeah, absolutely. Yeah, in there, I kind of heard your why. Like, what's your why, and that mattering too.
Well, yeah, because like Mike, if you have a 9-to-5 job, do you want to come home and hang out with your kid, or do you want to hang out and do charts? How bad do you want it? Where's your hard work, your determination, your passion for trading, your confidence, and your growth mindset? Where if those are all in the right place, it will get done, even with a job. I've seen it happen. I was that guy. So, I mean, I'm sure a lot of people were that had to transition from working into building their own business. So it's just a matter, are you going to make those sacrifices, which is not a question of ability. It's a question of passion.
Yeah, totally. I was doing a lot of the work on the commute, on the railroad.
The train. Yep. 100%.
It reminds me of the quote.
There's some great opportunities just now to use the technology that's out there to do a lot of the heavy lifting for you. So if you have, spend some time, put some good scans in. There's lots of automated scanning engines out there that will do that for you. They will automatically run it for you, build watch lists, etc., and filter things down for you so that you can, focus on the things that you need to focus on in the limited time that you have, considering you've got a 9-to-5 and a family. But use the technology to your advantage as well. So have a good look at what's out there that you can actually use. We don't all have to do it all by hand like Pat used to do back in the day, or Mike, or whatever, So.
Like that.
Beautiful. Good stuff.
All right. Well,
can I share a quote?
Yeah, Pat, go for it.
This is for everybody because I hear a common theme in the statements, and it's a good one. And this isn't my quote, but I do like it. He, you could say she, he who has a why to live for can bear almost any how. Each of you listening, you have a why. I know it. If you didn't, you wouldn't be here. You'd be doing something else, but you have a why and you want to get better. You know what your why is. Okay. It may be a family. All right. Something like you want to get a new house, whatever. Supporting a family, supporting a parent. You have that why. Now work hard, and work on your how. How am I going to do this? All right. And that comes through study and perseverance. This is a great quote. It's by perseverance that the snail reached the ark. Okay. Don't quit. Don't stop. Your best friend, our biggest enemy, greets you in the mirror every morning. And the best part is you get to choose who it is. You get to choose it and keep pushing forward. I have to share that with you. So
I love it. Pat, you're the man.
Amen. Amen, Pat.
Thank you.
All right. So we're already 10 minutes over on the panel. I know that it's time for lunch, and then we're starting the risk, reward, and position sizing panel. That's starting at 2 p.m. Eastern, right? So I know that we've got people logging in from all over the world. So 2 p.m. Eastern. So it's about 20 minutes from now. We're going to start that risk, reward, and position sizing panel. You guys are tearing the roof off of this thing. There's been so much value packed in, and we're not even halfway done. So this has been incredible. Thank you all so much for being here. Austin, Akil, Stu, Pat, you guys are amazing.
Thank you.
Thank you all for being here and your great questions and participating. We're going to take a quick lunch break, about 20 minutes. In the meantime, go to tradingmindwheel.com/lobby, and you'll get to learn more about Austin and Akil and Stu and Pat. You could go and follow their social medias. And one of the great things that I love about all these guys is that they're so engaging. And they'll answer your questions. So go there, follow their social medias, and make new relationships. And we'll see you in about 20 minutes.
Awesome. See you, everybody.
All right. Take care. Hello, everybody, and welcome back. We are getting ready to kick off the risk, reward, and the position sizing panel for this afternoon. For those of you that have been with us from the start, thanks so much for being here. Type into the chat, let us know where you're from. And for those of you that are just joining now, welcome. We've got a great panel for you already. Let's introduce a few of the people that are joining us that are here. First, I'd like to introduce Anthony Crudele. Anthony was with us on the first panel, the mindset panel. Welcome back, Anthony.
Thanks for having me back, Michael.
I want to do a better job here of introducing you. So I'm just going to read your bio here. So Anthony, you spoke about this earlier too. You heart attack survivor. You put that in your bio. The stress of being a trader too. It's that stress inducing that put that that caused that that trauma. Well, you know what? Tell it. Well, can you tell us why, like that, like you put that up front in your thing? Like it seems like,
Why is it in my bio? Well, because
yeah.
it's massively impacted my life, and it changed really who I was as a person, because I take health obviously much more seriously. When you're in your 20s, 30s, I'm in my 40s now. I mean, you get checked by the doctor, you get sick, you think you're pretty much, this is not going to happen to me type attitude. What's ever happened to anyone else? And so your mind you don't really focus a lot of energy on preventative type stuff. Now you might eat well, you might do some things, but in the same token, at least for me, mentally, you don't feel much different from your 20s or your teens. I mean, obviously you've grown as a person, but you still feel that you can do anything, right? As each day goes by, I talk to some of my friends that are in their 60s or 70s, they're like, I still feel the same mentally, like I could do some things, but the body doesn't let you, right? And so I put that in my bio because it represents who I am and what I represent. I represent, putting the amount of time necessary as a preventative measure, not only for my health, but putting the time to be a better trader, be a better person. I look a much longer term now. I'm not as reactive. Like even myself as a trader, I was much more of a reactive person where you come in the morning, I do a little bit of prep and I would just react to the day and I would just scalp and do whatever. But I put a lot more time now into preventative and like pre-market routine. Everything now is more like that. I'm much more balanced when it comes to that. I think people think that they're balanced because, I do this one thing and then I go work out and then I do this and they feel like they're actually creating balance. But really they're probably still keeping a lot of pressure on themselves. And they're probably not doing things to actually have the opposite effect on the body and the mind, right? People think that, let me spend all day at the screen sitting there trading, and then you go work out heavy, you do that, and that keeps a level of intensity up the whole time. And you're really not actually releasing, you're not going back. There's that saying, work hard, play hard. I actually live differently. I say work hard, play easy, because I don't want to constantly put that type of pressure on myself or that strain on myself, because I saw how it impacted me. And so that's why it's in my bio, because like I said, it represents who I am and what I believe in.
Thank you for sharing that with us, Anthony. And you're also one of the first traders to trade the E-mini S&P 500, 23-year futures trader, or one of the youngest in the CME group history. And of course, the host of the Futures Radio Show podcast and Develop Your Edge. Yep.
And I recently started a network on daily options, which is called placeyourtrades.com. And so I started that. And yeah, I mean, the CME thing was, when the E-mini S&P was first launched in 1997, I think it was the end of the year. I was actually in 1998. I started dabbling with it a little bit, and I was working actually with the people at CME Group as they were trying to bring forth this product that was really competing with the pit, although I was in the pit. And at the time I was going through membership in 1998. And so at that time, really nobody was trading electronic futures in the States. Most of it was being done overseas. And then, you know, I was 20 years old when I went through membership at the Chicago Mercantile Exchange. And you really, there was very few people. The only people that were really my age or maybe even younger, I was definitely not the youngest, but I was one of the younger ones by far. And it was just people that would hand it down from generation to generation, you know. And so I take a lot of pride in that. I was able to achieve that going through membership at 20 years old.
Oh, very good. Well, thanks, Anthony. And it's awesome to have you back here, particularly on this panel for risk and reward and position sizing.
Oh yeah, this is my stuff right here, man. I mean, to me, what really makes or breaks your career, I think, as a trader, is understanding that not every trade is the same. That's the way I believe. If every trade was the same, I would just automate my strategy. So I think that position sizing and understanding the context of the situation, you know, it is so important, because nobody has a linear path of success, and nobody has a linear path when you look at your P&L. Now, you might have one for a period of time, but overall, there's going to be a lot of this. And so ultimately, position sizing is so key, because you have to recognize times to when your strategy is giving you really something that is at its highest level, like an A setup, and the context of the situation is also set up there, and that you take advantage of it, because the market's going to take advantage of you in other times. So I know we're going to dig into that.
Absolutely. I'd like to welcome Jim Roppel to the panel. Hey, Jim.
How are
It's been
you?
a while.
How are you?
Doing well. So for those of you that don't know Jim is a hedge fund manager who has built his career mastering the art of buying and holding monster stocks. Jim was profiled in 2 books, Monster Stocks and How Legendary Traders Made Millions, both of them by John Boyk. He's seen wars, currency crashes, everything in between, and studied under William O'Neill. Some of us have heard about him.
You're funny. You said mastered. I don't think anyone ever masters the market. I think you learn to deal with it, but no one masters it. No one. It's not masterable in my opinion.
Possible, Jim. And great to meet you, by the way, Jim. I saw you on some Trader Alliance stuff a bunch of times in the past, so it's great to be able to be on a panel with you today.
I'll apologize now for the losses I'm sure I caused you.
And we'll bring on Adam Sarhan. I've known Adam for a very long time. Welcome back, Adam.
Thank you for having me.
For those of you that are just hopping on, Adam, I'll read Adam's bio here. So Adam is best-selling author of The Psychological Analysis, a book right there, right behind him. He believes fundamental and technical analysis are not enough to beat the market, and that psychological analysis is key to winning on Wall Street. His personal account is up over 1,000% since 2016. He is a contributor to Forbes and Zero Hedge, and hosts the SmartMoneyCircle.com show, where he interviews large money managers and CEOs of publicly traded companies for timeless advice, and also runs FindLeadingStocks.com.
Thank you so much, Mike, for having me on. Hi, Jim, and hi, Anthony. It's great to see you guys again.
All right, and we'll bring on Stu. Stu Chalmers was one of the first Mara Elite Program members. Welcome back, Stu. So in 2021, so Stu joined the Mara Elite program back in 2020. In 2021, he became part of the Mara team as one of the coaches. Stu has about 15 years of trading experience. He is some of his key trading influences have been William O'Neill, Mark Minervini, Jesse Stein, Mike Bellafiore, and myself. Stu has mastered the art of momentum and base swing trading, and since 2020 is up about 1,000%. So welcome, Stu.
Thank you, Mike. Hi, everybody.
And Pat is going to join us for this session too. I see you there, Pat. Well, let's bring Pat Walker back in. Pat, welcome.
Good to see you again, Michael. Good to see everybody again. We're like old friends, you know?
Yeah, I know.
I'm coming over for barbecue.
Yeah, right. That's the next thing. So, risk, reward, and position sizing, they're all parts of the trading mind wheel, and that can either, when we do them well, it could help us to roll down the path of success. Done poorly, and it's a thing that'll cause us to veer off the path of success and crash into a bush. So, this panel is there's a lot of wisdom to be learned here from each of these gentlemen, and so I don't want to waste any time. I want to get right into the questions that we have here. So let's dig into the different parts of a risk and a risk tolerance. I'm curious to first hear, how did you become aware of the different levels of risk tolerance that you have, and how would you recommend that other people go about figuring out, well, what are they actually, what's their real risk tolerance, right? Because it's one thing to think about, oh yeah, like I'll sit and hold through a base, right? Like so for those all of us here, I think are familiar with William O'Neill's work. I thought that I would start out with O'Neill as a cookbook, and that I would follow exactly what Bill did and try to trade exactly how Bill did, and I tried to do that and hold through bases, and I found out that I am not comfortable with this. So that led me to more of a swing trading path. But I'm curious to hear, how would you, is there a better way to go about doing that and figuring out what's your risk tolerance and what you're really able to tolerate versus learning the hard way?
Who wants to begin?
I'll take it.
Sure, Anthony.
All right, Pat.
I was muted. I said I'll take a stab at it, but I'm happy to go whenever you tell me.
No, you go ahead, good buddy. Anthony, it's all yours.
So the one thing that I first of all, I'm not actually familiar with the Bill O'Neill. I'm a futures and options trader, and I really don't trade stocks, so I'm kind of a little, I don't know exactly much about that method at all, to be quite honest with you. But so for me, understanding my risk, let's start from the very baseline of it. The beginning was, and I felt when I first put out my risk per day, my risk per week, my risk per month, it all looked good on paper, but emotionally, how attached I was to it after it actually happened changed things. And so I think that was really the first step, was, okay, what can I heal from quickly? And it didn't matter how much money I had in my account. It was just a matter of what I felt comfortable with, because psychologically, if I felt damage from a day that I was willing to accept going in and I wasn't healing from it mentally, it just kept setting me back, because I was going off of what other traders were saying. If you got X amount in your account, this is how much you can risk. And so I learned that I had to actually deal with risk by what I was comfortable with, and not necessarily based upon initially how much money I had, because I felt like, even though I started out with $25,000 in my first account, and I was risking $500 a day, and I was like, okay, that means that I could risk $2,500 in a week, but in a month I only want to lose $5,000. Well, the first month I lost $5,000, and I'm like, wait a minute, this is not good, because now I'm looking at it going, I'm not comfortable with this, even though I felt like in the days were okay. I don't see how I make that back right now, So I was put myself in a weak spot. And so what I started to do was, okay, I had to actually go through and physically feel the emotion to where my risk was and where my tolerance was. And one of the things I want to talk about with this is that, a lot of people say, well, it's easy. If you can make $200 a day, then you can make $2,000 a day. And I would say that's really not true, because I'm not saying that you can't, but it doesn't scale the same way. The bigger I got, the harder it was to deal with the losses, right? And so it was like, okay, I was making $250 a day. And then all of a sudden I'm like, you know what? I'm going to risk more and I'm going to try and make more. But now if you have an immediate drawdown, you're like, oh my gosh, I haven't even achieved this at first. So how do I even get to that point now? So it's just like a constant setback with risk. So what I started to do on a personal level was test myself. And so what I started to do was the days I was making money, I would just keep staying and try to press as much as I could. And I would be able to trade a little bit bigger on the days I was already up. So if I gave back that day or a big portion of that day, I was able to test myself in that moment to see how I felt about that actual loss, right? Because I'm not someone who looks at it as, well, if you're up 1,500 for the day and then you give back 1,000, you still made 500 for the day. I was like, well, I gave back that 1,000, right? And so I started feeling how I could deal with bigger numbers and loss. And so that's how I started to deal with risk, was testing myself in the moments of where I was doing well and push myself and then see how that felt. And then that's how I was able to say, okay, I can deal with this. And then I would try to make that back in that day. So I would be dealing with it in a day where I was up money or I was trading well, versus just like putting a number on it, where I still to this day don't do that, because there's sometimes I'm just trading terribly, kind of like right now in some ways. But I look at it and I go, you just can't afford to risk this much, even though I can afford to, I can't mentally afford, because I'm looking at too much to make back. And so I look a lot of risk, and I know people will say, you got to take the emotion out of it, and you do that. I don't really believe in that. I believe that there's just certain amount that sometimes I just feel I can sense what's happening in the market. I know for new people, maybe that's not going to be the case, but don't put yourself in a weak position. Try to constantly keep myself in a position of strength so I have a stronger hand in the market when I go back, because risk to me will affect you mentally, even if on paper you feel you can afford to risk it. And that's the way I approach it.
All right. Yeah, thanks. Who'd like to go next? And by the way, too, everybody that's here on the panel, like, feel free to rip off of each other a lot, like add on to somebody else's comment. Like, go for it. Who wants to go next?
I'll give you an answer. I think, well, in John Wooden's book, winningest coach ever in NCAA history, basketball, he said, I don't let my team revel in victory for more than a day and wallow in loss for more than a day. And I have a very unique ability to take enormous losses. And my wife says, you're not fit for public consumption. Go hit the treadmill before dinner. But it just doesn't bother me the next day. No matter, I've had some, as everyone here has had, monster losses. So I have this unique ability to take them. But I also feel that I size them in relation to what I perceive as opportunity. So if the market is really not yielding gains, I'm not willing to take hardly any losses. Mm-hmm. But if there's I think gold right now looks very asymmetric. I think you risk very little to have an enormous gain. So I'm willing to take a big position, a really, really big position. But, in your book, you talk about awareness, situational fluency. You have to understand the possibilities of what can go wrong and be prepared for them. And if you're really new, you think you understand what can happen, but knowing what the real possibilities are, and then knowing that the liquidity is there to absorb you getting out. Like, the first thing I mean, because I'm trading a fund and the dollar size is probably bigger than most individuals, liquidity's average daily dollar volume is the first thing I'm looking at.
Yeah.
And, Anthony's a futures trader. I want to tell you about, everyone goes Druckenmiller, because he is the man for so many reasons. But what he does is he says, I'm a pig when I see a monster opportunity. Mm-hmm. But what he's not, you have to read into it. When you're trading bond futures in euro dollars, the liquidity is endless. So he can put on $1 billion or $2 billion position and get out in 3 minutes. Yep. You go take $1 billion position in any equity, you're not getting out in, you're just not getting his. This is the longest answer in the world. Equities for him is the smallest part of his business. It's de minimis to him. And when he's in equities, he's in Google. He's in Tesla. He is not in, whatever, ONON. Like, and if he is, it's small. So anyway, that's a 20-minute answer to the question.
I just want to say, I think it's a great point that Jim brings up, because we're in different worlds. So you're going to get in a different perspective, and, for me coming from the futures and option side, I trade S&P futures. It's like, I can't get bigger than that book. I mean, the minute I want to get out of anything, I just take it out. I mean, it gets me out. I mean, you're going to get some slippage maybe if you're really big, but it's like, they keep that. It's just a very different thought process versus like trading in some of those stocks.
All the guys we read about in Market Wizards are global macro predominantly, and they're trading futures. I mean, the big game is futures. That is the big game. So you got to delineate between, I think most of the people listening to this are stock traders, but they're not aware. I have this really smart ass friend. He goes, that guy's so situationally not fluent. It's like the guy who's in a rush hour and the whole highway, 4-lane highway's going down to 1 lane. And he's like on his phone, stopping to check his gas. And there's like behind him is a million people. You have to be situationally fluent or you are going to get wiped.
Yep. Yeah, I fully agree. I would also add, in my mind, I keep everything really simple. It's almost binary. There's risk and there's reward. Everything in life, every decision is a trade in my mind. So am I going to cross the street? Am I going to go do this? Whatever the case may be. And there's an element of risk and there's an element of reward. And you've got to be able to measure the risk and measure the potential reward. And like Jim just said, with gold, the asymmetric to the upside, he can stop out for a very small amount right now if he's wrong. And if he's right, he's going to double up or triple up or even more. So that's a great trade. So understanding that everything comes down to risk and reward is really, really, really crucial. And another great thing someone told me was phenomenal. He goes, Adam, I don't trade stocks. I don't trade futures. And neither do you. So I'm thinking to myself, I'm like, what's this guy talking about? And very successful man. And he goes, we all trade risk. We buy and sell risk all day long. And when he told me that, it was like the little emoji with the iPhone where your head explodes. And my head explodes. Wow, that is so profoundly smart. Was like, that's next level, because if you really think about it, you're trading options, Anthony, or futures or Jim stocks or whatever the case may be. It's the same thing, right? You're going to risk money with the anticipation or the hope or the expectation to hopefully have a reward. But most trades are going to fail. So what do you do in that environment? So I think that's really just really understanding that risk reward and then measuring each side is super important.
All right.
Yeah, I think I kind of go along with Crudele there. I think my risk tolerance fluctuates depending on how my performance is doing. It's not an on-off thing. It's kind of continuum. So if I've had a big run of success, then I'm prepared to tolerate a much bigger loss than if I've had 10 losers in a row. And so I've built kind of systems around that. But yeah, I think it's very much based on my current performance and how in tune I am with any particular market, or whether or not the market's actually in tune with me. It could go either way. So I think it's a sliding scale for me, and I don't think it's a fixed. This is your maximum tolerance at any one point. The other thing I would say is that my account has grown. My overall risk tolerance has actually shrunk probably. And maybe that's me just going into protection mode or not. I'm not sure, but it's certainly a few percentage points down from where it was when I started.
Mm-hmm. It's funny you say that, Stu, because it's the same with me. I was a worse risk manager with less money than I was with more money, and it's odd that is the case. But I think that for me, at least, I find times where I feel like I'm picking my times better. I feel like I have a stronger hand in the position. So therefore, it kind of goes back to what Jim said. It comes down to the situation. Like if you look at gold and you think it's relatively cheap there, I could put on or not cheap, but however you want to look at it, you could go in and buy. I'll step in with a really regular large size position, but I am not about to let that go much against me versus when I'm smaller. Sometimes I'll take a smaller to medium position, and as it starts to drip against me, I'm actually losing more trading smaller. And it's just like, well, because I'm just allowing it to happen. And so that's why my risk does fluctuate, because like you said, it depends on the situation, where I'm at mentally, where am I coming out of winners, and things like that.
I think it's so important. A word that is constantly used in this conversation, and it's so appropriate, is risk. Measuring risk and controlling risk. And for those that are new, you'll find that if you don't have a clearly defined entry point, you therefore by default don't have a clearly defined exit point. And so you'll stay with it. And always remember this: every big loss started out as a small one. And a big loss is very, very bad for two important reasons. It's bad financially, but it's also bad psychologically or mentally. And the biggest asset, the best asset we have, folks, it's not your account. It's what's up here. And if that's not running smoothly, your thought processes, it's going to be very difficult to make good investing decisions. And if you suffer a couple of big losses, you'll become afraid. You'll become nervous. And those two emotions are not conducive to good decision making and good investing decisions. And so so that's easy for you to say, Pat. Oh no, I've gotten killed before a couple of times, years ago, on more than a couple of times, arguing with price. Opinions don't pay, forecasts don't pay, pundits don't pay, newsletters don't pay. One thing pays: price pays. Find a clearly defined entry point, regardless of the time frame that you use, day trading, weekly, monthly, whatever. Have a clearly defined entry point, and by default, that clearly defined entry point will give you a clearly defined exit point for a much smaller loss. The last statement I'll make is, but now this is just me, all right? Day trading, I've only met one successful day trader. I know there's others, okay, but just know you're really tied into the machine when you're doing that, and that's fine. But I'd rather buy something and just let it work. Let it work. And trends pay more than all the decisions that we're going to make. So, and again, I'm not a scalper or a day trader, and that's fine if you are, but which leads to another very important point for everybody. And this is probably the most serious thing I'll say today. Find a methodology that fits you. Not me, not any of these other panelists. They're all great. Find what fits you and hone those skills. Don't try to be something that you're not. It's just not conducive to good decision making. Anyway, I just wanted to share that.
A while back, Stu had given me a really interesting perspective on risk. And it was looking at risk instead of using the word risk, using the word cost. Right? Like, well, what are we willing to pay to see if this trade is going to work? And it gave me a perspective shift because it implies that there's a certain cost to put on every single trade. It's not where like you take a trade and the trade is automatically going to be a win, and then like the risk is like maybe you might lose, maybe you're not. But if you put on the trade and you're looking at it like, okay, the difference between my entry and my stop, or where I'll exit the trade if it's wrong, that's what it's going to cost. So how much am I willing to pay to see if this trade is going to be right? And then how quickly can we reduce our cost?
I like that.
I
You got
to be really
that
careful.
was a very important shift. Yes, do it.
Because
I was going to say, because the whole point of that is that you've committed, whatever it is, $100, say, to that's the cost of that trade, and as soon as you put that stop in the market, that's the cost. So if it drops down, that's what's going to cost you. But if you can move that up bit by bit or as quickly as you can, if you can take that cost down to $50, that's $50 that's straight on your profit account. Because remember, in the end of the year, we're taking all our profits less all our losses. So if we can shift the $50 from one side to the other, that's a straight lift onto your profit. It goes straight on the bottom line. And that's the way I was looking at it from a sort of business sense, if you like. That if we can move that out of the cost column into the plus column, then it's a win-win for me. And it's So, but it's the mindset in your head, I guess. But yeah.
Yeah, absolutely. How many times have we heard the saying that it's what's between our ears, right? Like Pat, it's hey, I don't want to botch the quote. Well, what's the quote, Pat?
The most important part of investing is not what's before our eyes, it's what's between our ears. And if it's not set right, making good decisions won't happen. Which I got to go off on a tangent here and share. If you're going through a rough time in life, all right, I'd encourage you pull back. Years ago, my dad died, and I was only in my 20s. I had to stop investing. All right, my best friend died of cancer. When he was going through it, and I was with him, I had to quit. I'm not trying to be melodramatic, but we all face those situations in life. It's part of living. And so when you have a really tumultuous situation going on, I'm not telling you what to do, okay? But just when it is a strong suggestion, back off a little bit. The market will be here next week. It will be here next month. Don't think that we have to be doing something all the time, especially if what's up here isn't smooth. I want to share that.
I think you really got to look at like position risk and portfolio risk. Because if you're in all stocks and you're in all growth stocks, you're in highly, highly correlated assets. So you think, hey, if my one stock blows up 20% in one day, I can take that hit to overall equity. But the reality is Tesla's an auto stock, and you have a semiconductor stock. They're all growth stocks. And if one of them gets smashed 20%, the other high beta growth names are probably going to go down 3 and 4. So you have you have portfolio risk and position risk and in highly correlated assets, which is why futures are better again. I mean, again, correlations which you may be leaning into break. So you have to be, again, aware of what's possible. I'll leave it at that.
I want to say something about the risk aspect of it. The first thing I was taught as a trader, because I learned how to trade in the S&P 500 pit, was know where you're getting out before you're getting in. We called it second trade first. And the reason why was because during those times when it was just the pit and the computers weren't there, if you bought or sold something, you had to know that you had a lien. We called it a lien, right? And so I learned when I moved to the computer was look at where I'm getting out and how close that is or far that is to my entry. And that's really my range of execution. And that would determine how many contracts I would trade. So I don't really look at entries as much as I look at where is the price where this trade just no longer works. It's really the only thing that matters to me, because once I find that area, then I will accumulate as many contracts or as few contracts as I can to stay within my own risk parameters, because that's the line, right? The entry to me, I don't actually look. I mean, you look for entries, of course, but I look for it more of like, okay, where does this no longer work? And so that's how I adjust my position size and ultimately manage my risk, because if it's really far away, I have to be smaller or decide if I want to participate. If it's really close, like kind of going back to what Jim is saying about maybe possibly with gold right now, well, if I think the risk price is relatively close, then that's a trade I could trade with large size and really not risking more than I would on maybe a position that had a wide stop. And so that's how I adjust my contract size. I don't trade the same size for every one. And so I just wanted to kind of talk about that when we're talking about position sizing.
I love that. So Anthony, this is the first day we're meeting today. In my book, in my process, I've got 3 things questions people should ask with respect to risk. And there's a whole chapter on it, but basically where you can enter before you enter the trade, where you're going to exit before you enter the trade, and then how much are you going to risk if you're wrong. And then understand most trades are going to fail, and that's okay. So it's just like I observe nature. This is a law of nature. Most relationships fail. That's okay. You can still meet your wife. If you have an apple seed, most seeds fail. That's okay. You just need one to grow into a new tree. And so most trades fail. In baseball, you're going to strike out 7 times. You hit 3 times. You're one of the best baseball players ever. In trading, it's about the same thing too. So going into it with the expectation that most trades are going to fail, and that's okay, is a big expectation setter with reprogramming your mind, and then understanding most trades fail. That's okay. What's the cost of that trade, like Stu said, or what's my risk? So if I'm going to enter here, I'm going to exit there. And then what Jim said, I think is just brilliant, is understand what the implication are. What are the consequences to your portfolio? You get stopped out, you put a stop. When I first learned Can Slim, and this is the basic of it, is that you enter, you put a stop 7 or 8% below your entry. So I put my entire all my money, let's say I had $1,000, I put $1,000 on every trade. I went all in on one trade, and I put my stop 8% below my entry. Well, that's fine, but then I got tagged. I just lost 8% of my entire portfolio. And then I did it again, and I lost another 8%. And the third time, I'm down over 20% in 3 trades. And I'm like, what is going on? Of course, I bankrupted that account and then came back again. But I learned very quickly that's not a good way to do it. So understanding the entry to exit on the trade, and then, of course, what the impact is on your portfolio, that's super, super, super profound and super, super important.
You know, I got to make a point. Pat said he doesn't know, or I'm going to paraphrase, he doesn't know any long-term day traders. I'll tell you this. If you talk to a 20, 30, 40, 50-year trader, every single one of them, not some of them, every one of them takes less risk. This is not fun. Okay. Day trading doesn't really work over a long period. I mean, for very few, it does. This is not fun for the guy who's trying to build his account up. But day trading and fast money historically doesn't work long-term. And you find that the young guys who are just getting in, or people are just getting in, are taking the biggest risks. You talk to a guy who's been trading anything for 30, 40 years, I guarantee you they're taking the smallest risk now that they've ever in their whole career.
You bet.
And that varies with market conditions on top of that. So, you know, don't learn from your mistakes, learn from ours. It's really hard to do. If you're not touching the burner and feeling the pain, that's how you know your risk tolerance. But just listen to what I said. There's not a single person I know, and I've been doing this since 1985, that takes more risk now than when they started. It's all the kids, it's all the rookies.
Yep.
That are taking a big risk.
Good point.
I'd like to riff off of that for a second, if I might. Well, one of the things that I experienced was that when I was trading too small, I started to get reckless. So I had this test account that I had set up. I talk about it a little bit in the book. And this test account, I wanted to start to play well with some option strategies, like iron condors and broken butterflies and all the exotic insects and animals in the options world. So I kept on doing that. And the account was super tiny, just a few grand, but enough to test this out. So I just kept on testing away. And I allowed the account to go down, I think it was either 97 or 98% before I said, you know what, this isn't really working. Let me try something else. And it was, well, when I started to switch the mindset to like, okay, I'm going to actually start to care about the trade, focus on the press, and like regardless of the size of the account or not, I'm just going to focus on process. That's when I was able to dig myself out of that hole in that account. So
I think that happens to everybody, Mike. I think if you're objective and you learn from your mistakes and you adjust, that's what being flexible. Jim, you taught me this on growthstockmentor.com, which I think it is absolutely just brilliant. It's being flexible and being able to adjust. Things are going to change, right? The ocean's not going to always be calm. Sometimes you get big waves, you get small waves, and Jim, you like to ride the waves. So it's the same thing with the market. You've got to be able to adjust your risk and adjust your trading accordingly. But find something, again, like what Pat said, that works for you. That's critical. And making sure you're comfortable with that risk is so, so, so important. Because like I think Pat or somebody had said earlier, where you've got to be comfortable with the methodology that you're using, the system that you create. And if you have to tweak it, by all means, tweak it. There's no rules that say you have to do a certain thing. As long as it works for you, that works for me.
I want to go and tell you, Michael, when you take, I take a lot of positions that are so irrelevant to P&L to test the market in a bear market. But in like 2020, I'm all cavalier and bulled up. And I was like, first trade, everything I enter is a 10% of equity of the whole account. So it's awareness of the market you're in. And so a lot of times I'm taking positions with no intention of making money. I'm just trying to find out, is the market going to give me traction? Is it going to support breakouts or whatever? So I am totally okay. I mean, look, if Bill O'Neill could trade a lot of 100 lots, then it's just fine for everybody listening to trade 100 lots. Okay. The amount of money I'm making or losing, I would keep that risk management just rock solid no matter what it is. I mean, I want a string of wins before I'm sizing up. So I'm not really trying to make money, and I don't care how big or small it is. I just want to test the market. So there's a lot of ways to look at it. That's all I have.
Yeah, well, Jim, I'm with you. You know, it's for me, like I said, more on the future side. We always say, man, it's amazing how much you learn from having a one lot on, you know, and that would be like your guy's 100 lot, you know, and it's because once you're into that trade, the feedback you're getting from the market, it really does. It helps you see things so much more clearly. And I could buy one S&P or buy a bond, you know, at 10-year, and it's like the minute you're in it, it's like it tells you so much about it. And which is why equities right now are so difficult. Because the minute I even get it in a one lot, I'm kind of like, man, I don't even want to be in this thing.
Well, Anthony, I got to tell you something. It's amazing the tiny positions I'm taking and how much trouble I can get in.
How much you can
with
get
a tiny little something I would consider irrelevant. And I'm like, did I just lose that much money? It's the condition of the market. It is soft. At this minute, it is soft. It's not robust. So even small positions can chop you can lose a lot of money with a small position.
Yeah. I want to make a comment on the day trading thing too, because that's the background that I came from. And this is my 25th year in this business. And I will tell you that I don't day trade very, very often anymore. And I made a majority of the money of my career day trading, you know, in my 20s and my 30s. And then I had to learn that, number one, I learned that it wasn't a sustainable way to make a living because physically, mentally, it's just too difficult. Talk about the young guys. It's just too hard. I mean, at some point you wake up, you're like, man, I cannot believe I have to come in here and do this again. You're burnt, you know? And I think that day trading is one of those things where if a lot of people out there are interested in it, it's one of those things where maybe it gets you a start to where you understand the markets that you're trading because you're active, and sometimes you almost have to burn that out a little bit just to see how it does work for you. But over time, that is not the path to prosperity, right? It's one of those things where I look in COVID, I was day trading a lot because I didn't want to keep anything overnight, and a lot of the positions I was looking at were like, man, it was like going back what Pat says, price pays. It's telling me to get in and get out. I have to get out during the day, but those environments are so few and far between. And talking about what Jim is talking about right now, it's like day trading futures. It's difficult right now because every day is almost like a new kind of a climate out there. You're like, you know, the S&P could be strong as can be, and then the next day it's just like you can't even hold a bid on, you know, you can't make a tick to the upside, and you're like, what's going on here? And that's you learn that from the small position. So I think that day trading has a place, but it is not the long-term place.
You know, I went along the same path. When I started out, I had no money. I mean, I think I started with like 5,000 or 10,000, and I blew that up a couple times. But I'm a hypocrite because I'm panning excessive risk. And when I got started, I'd put my whole account 200% long. Back in the day, I could take 300% long margin on equities. Everyone could. And I did it, and I built up a war chest, you know, to get critical mass so I could make really big money. So I can't dissuade others from doing exactly what I did, but I will guarantee you that as you age, like the possibility of me putting my whole account in 4 stocks, 200% long, is never going to happen again in my life. That is never happening again. But that was kind of a routine thing for me in 1980, 88, 89, 90. So I'm a bit of a hypocrite. But again, I had no clue what I was doing back then.
If you could go back in time, Jim, would you do it the same way, or would you change something?
I would take excessive risks, but I would take them in a more prudent fashion. Again, I'm a hypocrite because I believe right now in the bear market, one of the best trades I was making was you'd have a run up in the market in equities, and then you'd have a gap open and it would start to fade. And I just thought that was the best short selling opportunity in the world. And I could put on a pretty big short position and hold it for a day or two. So again, but that's rare. It's not like something I'm doing all the time. I mean, how many times do you have a bull trend for a month or two or a month and then a gap up reversal in a year? You only have 5 or 6 in a whole year, I'm going to guess. So it's not like I'm doing this every single day. I'm not day trading. I'm making day trades in a rare occurrence. So I'm fine tuning what would I do if I was starting over day one and I had $5,000? I would lever that shit up, but I would have way better respect for the drawdown possibilities. But when you're a kid, you're 25 and you're not married, you don't have a house, you don't have any obligations. You're playing Nintendo in the basement of your parents' house. You can blow the 5-10 grand. It's irrelevant.
Yeah,
I would do all over again.
I couldn't agree more. And I did the same thing with excessive risk and blown up accounts and so on and so forth. But I would say everybody watching, there's 2 jobs. Job 1 is to get rich. And then job 2 is to stay rich. You can't stay rich by taking excessive risk and blowing up accounts. If your job is to get rich and you have that tolerance and you have that proclivity to want to push it, that's one thing. But if that's not your nature to push it, don't feel like you have to push it just because a few people have pushed it and made it work. There's lots of other ways to get rich also without having to push it and go crazy and put all that stress and pressure on yourself too. So I don't want people to think like, oh, I've got to go push it just because a few people have pushed it and it's worked. A lot of people pushed it and it doesn't work. So keep that in mind as well.
There's a variable, that psychological variable associated with the two, in the realm that if you're investing your money and living off of it and supporting maybe the families, it's an entirely different entity than if it's somebody else's money. And not that we're cavalier with somebody else's money, but there is a different mindset that increases stress levels that can also derail your thought processes. So constantly strive, and all these gentlemen are alluding to that too. Strive to control your risk. Don't be the gunslingers, because especially if it's your money, it could cause you to bankrupt out of the business. And we don't want that to happen. So, for what it's worth.
All right, I got to say this. I think it's really, it's much more difficult when you're day trading to pay the bills. The pressure is so much greater.
Oh, yeah.
And it's hard to get rich.
Yep.
Yeah. It's hard to get really wealthy when you're taking $100, $500, or $5,000 profits. Yeah. You want to get rich. You want to make millions, tens of millions or more. You need to get in some positions that are going to go up in stocks. A beaten, the definition of a TML is 8 beaten and raised quarters with size. How long do 8 quarters? It's 2 years. You
let them work.
That's how you get rich.
Yeah. And let them work. It's,
to me,
crucial.
I mean, as a futures trader, I agree, because my portfolio, and I manage part of that, that's where majority of the money has made for me over the last decade. The day trading is like, there's certain days where it's been, it's great. And you're like, wow, this is fantastic. But overall, you take that money out, and I'm day trading with such a smaller amount than I am with, trading these stocks. And it's 100% the way. But like you said, day trading has a place, and I just keep saying it, but it's not the ultimate place.
I found personally, now this is just for me, I found it maddening to get into something, and what goes up, day trade, whatever, and I'll take it, and the sucker keeps going up. Now I'm a stock guy, okay, and it keeps going up, and I can't find a way to get back in it. And then finally I freaking capitulate and say, well, I'll buy it. And then it starts to drop again. It just was like, I've got to find a methodology where I can put it in there and let it work as long as it'll work, and ride that trend. I found, again, this is just for me, and I'm just a stock guy. that a good trend will pay more than all the decisions that I'll make going in or out of something. I'll let it work. And I love trends on the 50-day, the 21 exponential, and the 8-period exponential. And Ed Secoda had a profound impact on me with the 8-period exponential. He used the 5, and it was too close for stocks, and I moved to 8, and I love it. But that's just me. And and I guess if you notice, what was the phrase that I used constantly? That's just me. I think it's important, and I listen to these gentlemen talking, finding what fits you. Don't put a square peg in a round hole.
Mhm.
Find what works for you that's viable, okay? And let it work. Let it work and turn off all the noise. Just that's from my heart.
Absolutely. Well, we got a comment from Lad. Cost versus risk management. Your exit level set before entry defines position size. Great points. I think that we've all spoken of that. I want to address Sharon's question. She's asking about the tax implications. Even though I feel as though it's more of a trade management question, but I'm curious to get everybody's thoughts on tax implications and how it might affect your strategy. If you might sell something because of tax implications, or let's get a few thoughts on this one. Who wants to go first?
I just want to mention the future side of things versus the stock, because that's what I do. Future side, when you're trading, it's 60-40. So 60% long-term, 40% of your income is taxed at long-term capital gains versus short-term, right? So it's not with stocks, it's done differently. And so with futures, there are some tax advantages if you are day trading. Just wanted to mention that. The rest of the stuff, I'm not an accountant. I leave that to them.
Mm-hmm.
Yeah, I can't really speak to the American market because I'm based in the UK, but over here it's all capital gains tax. So, when you realize your gain, then you do your tax on it. It's as simple as that, really.
Michael, I'm going to drag us backwards again.
Okay.
I think duration has got a lot to do with awareness. Again, are we just entering a new bull after a 2-year bear? What are the leading growth stocks going to do? They're going to go up 100, 200, 300%. So taking a 20% gain in a new bull market in an absolute monster is the most lack of situational fluency you could have. But again, if you're in a stale bull that's now struggling to stay above the 50-day, a breakout's a trade. So awareness of where you are in the cycle. You always need to know where you are in the cycle. And that's going to help a lot with duration of hold. And again, Anthony, futures market is the place to be, man. I'm flexing huge. I had breakfast with Trader Vic on Friday morning, and he's like, all futures. Victor Sperandio, Trader Vic, and he's like, he's a gentleman, so he doesn't go, what are you doing in stocks? What are you doing living in Illinois? He was stunned to both of those things. But, it's what you make and what you keep. And the future 60-40 is a game changer.
Yeah. Oh, my best year was in 2008. And I was talking to a lot of my stock friends about it. They're like, you only paid how much in taxes? I'm like, yeah, because maybe I just want to say it's 60% long-term, 40% would be like your Schedule C. But yeah, it makes a big difference.
A huge difference.
Huge.
And Michael, this goes to, holding a stock for over a year. You go from basically, 40% to 20%. You pay 50% less tax when you hold for long term. So, and Pat, again, he gets into a monster and he takes a 20% gain and he's like, well, how am I going to re-enter this thing? Where, you only have monster cup and handle bases take months to form. Once you're out of that, everything else is a higher risk entry on a shorter base. So how you get out on up 20%, you want back in that stock, like ANET is a perfect example of that right now. If the market's turned, it's super extended. How are you going to get, if you buy 2 weeks tight, your probability of getting stopped out is way beyond normal. Normal, you're going to get stopped out 6, 7 out of 10. You start buying 2 weeks tight, it's 9 out of 10. So giving up your initial beautiful purchase off a massive base is just going to cause you grief and tax. Causes me grief and taxes. Other guys can do it all they want, but it doesn't suit me.
Yeah, I would say that we're in the business to make money. Paying taxes, I used to look at it as a bad thing. Now it's almost like it's a good thing. It's just the cost of doing business. We all pay taxes. And if I trade to limit my tax implications, it tends to, more often than not, just about every single time, interfere with my ability to do my job, which is make money. So I focus on the goal. It's just my goal is to make money. The more I pay in taxes, I used to be upset at it. Now I'm just happy. It's like, okay, great. I just had what for a tax bill? I just paid it actually the other day. And okay, that's what it is. Thank you, God. I mean, one of those situations where it's like, now it's just gratefulness. I can actually pay that. Thank you.
Adam, you're just a giver.
I try, Jim. I try. I try.
Yeah, I'm right with you. I'm managing when I'm managing a trade. I'm not thinking about the tax implications at all. I'm managing the trade based on my rules, and if it happens to be a long-term capital gain, amazing, right? Like I think I've had maybe one of those over the past couple of years, but it's really just is this trade following my rules? If it is, then it stays, and if not, then it gets kicked out. I look at myself as more the referee in that regard than the player. Yeah, I come up with the rules. I'm the game master. I set the rules, and now this trade walks in, and it's either going to follow the rules or it's not going to follow the rules. If it doesn't, then see you later. That's it, really.
I'm going to admit I'm trying to force my style on everybody, and that's just not okay. It's not one style fits every person. Your disposition, your nature is everyone's got their own, and I'm maligning people, I think.
All right. So we've got about 3 minutes left here. Want to see what questions do we have in the chat that might be a good one to end it here with.
How much do you risk of your portfolio per trade?
How much do you risk? Yeah, I think that's a good one.
I go maximum 1% and less in a bear market, or less when I'm in a drawdown.
All right, and to kind of riff off of Mickey's question here about account size. So like if you had a 10K account or a 50K account or a 100K account, would that position size differ if you're working with a much smaller account versus something that's a little bit bigger, or if you're working with a multi-million-dollar account? Always 1%?
For me, are you asking me specifically? I thought it was
yeah. Oh, yeah.
Yeah, no, I would keep it, for me, I'd keep it 1% if I'm wrong. So this way I can take several losses if I'm very bullish in a good environment. If it's a crummy environment like we've been in now, where most trades are failing and just not working and there's a handful of stocks that got away from me, then I risk much less, 20 basis points, 50 basis points. Just throw some bait in the water, like Jim said, just probe. And if it works, great. And if it doesn't, so be it. But when in a bullish environment, maximum of 1%. A small account, big account. The other big thing that helped me too, I self-sabotaged a lot early on when I started building my money, because I like Jim, I started with less than nothing, and it messed me up in the head. I didn't understand dollars and percentages. So we're all emotionally attached to money, and that impacts our decisions. The whole premise of my book is to teach you how to make rational, not emotional decisions. When I learned to make rational, not emotional decisions, my life changed, because all of a sudden I can remove myself from the equation and just look at things objectively. All right, great. Next is like, okay, you're going to make rational decisions. How are you going to scale? So you made a bunch of money at the beginning. You have a small account, 10,000. You get stopped out. You lose 1% of it. You lose $100. No big deal. You got 10 million. All of a sudden, you just lost a lot of money. So what happened to me when I started growing my account was my losses were just too big for my peanut-sized brain to understand what's going on here. I just lost $5,000 or 10 at the time. Was like, oh my God. So then I started thinking in percentages. And when I switched that like light switch went off, now it's just unemotional. It's like, okay, it's a percent. I lost X percent. Nobody's emotionally attached to a percent, but they're emotionally attached to dollars. So
Mhm.
when I was able to think in percentages, I could scale and I stopped self-sabotaging. And that really helped me change a lot. So the same principles are true for a small account or big account. You got to find out what works well for you and then think in percentages, not dollars, because that just normalizes the playing field. For me, at least.
All right.
I read this years ago. If you're losing sleep over your stocks, you own too much stock, or you own too much of that stock. Listening to the body and control. High emotions and good investing mutually exclusive. So we do things that we can to minimize those emotions, and that helps. At least it's helped me through the years.
I don't trade stocks the way that these guys do, so it's a little bit different for me. I guess I can give Mickey a little bit of thoughts like how I would get into the futures. First of all, with futures markets, it's a leveraged product going into it, so you don't need to put as much money in. So the percentage that you're going to be risking is going to be much higher versus a long-term portfolio. And I wouldn't suggest putting in a boatload of money into a futures account, especially if you're new, because it would be a mistake. Because you're already trading leverage. They're giving you the leverage already because it's futures, right? You don't have pattern day trade rule and all that other stuff. So, but for Mickey's question, it's like for me on the future side, the way I look at most of my trades, and I'm trading a lot of multi-day stuff, and I use a lot of futures on options on futures. The percentages are going to be much higher than 1%, because I am not going to, because the risk in a futures market is so much greater than buying a cash position in a stock, right? So my risks are going to be, I wouldn't say 5-10%, but probably going to be around 5%, which is 500% more than what Adam is saying, so that is a lot bigger. But and he's talking about a clear example. For a lot of the stuff that I do, it's always comes down to the context of the situation. And so right now, Jim talked about gold. I'm actually looking at oil right now as bullish look. So anything that I get near my areas, I'm risking probably around 3 to 5% on a position. And so the size is going to be relatively big, but the stop is going to be relatively tight. So anytime I see that right now, I'm going to size up. And now in S&P, short or long, I'm trading much smaller with a wider stop because I am going back to kind of what Jim's method is. I'm trying to be small, and of course I care about the outcome with these positions, but I'm trying to get a sense of what's happening with the trend because I'm really not convinced that one side or the other is in. So the context of that situation is very different than what I look at. And those positions I'll be risking less than 1% because the context is very different.
So the way that I go about position sizing, I like to position size based off of both capital allocation and maximum amount of risk. So, and I also like to use a concept that's called progressive exposure, where if I'm winning and I'm on a winning streak, then I'll take the profits that I've made and I'll use those profits to finance additional size and additional risk. And if those keep on winning, then I'll take those profits and finance additional risk up to a certain point. I'm not going to just keep on leveraging up. And in this way, I'm trading my biggest when I'm trading my best, and I do it in reverse too. So I'll start cutting the position in half and then a half again if I'm on a losing streak. And that's something that's going to keep me close to equity curve highs. This is a concept that I learned from Mark Minervini, who is going to be speaking with us later on at 5 o'clock. So to give this to a little bit more concrete, what I'll do is if I'm just starting out, I will put on a position that's maximum 6.5% of capital. And I'll risk a maximum of 0.5% of that capital. Often it's a lot less because how I'm looking at the trade, I'm looking at where's my entry, where's my stop, and I want those two things to be as close together as possible because that's part of what's going to give me the asymmetrical reward to risk. So
maximum 0.5% when I'm just starting out, and the part of the position of the capital allocation is 6.5%. Then I get 3 winners in a row, and I'm looking at the market, and the market has started to turn, and other elements are in place where conditions are improving. Great. Then I'll go up to 12.5% of capital allocation and a maximum of 1% of capital risk. And that's, again, it's a maximum. Oftentimes it ends up being maybe about 0.5%, maybe it's about 0.75%. And then the last time that I'll scale up, if I'm in what I call a green condition, like I color code, like green, yellow, and red. If I'm in this green zone where I'm on this streak and the market is trending, right? Because winds tend to trend. Well, what I'll do is I'll up to a maximum of 25% capital risk and 2% of my capital being at risk. So 25% capital allocation, 2% capital being at risk. And oftentimes that too will end up being maybe 1.25%. It's very rare that it ends up being that 2% risk on a trade. And I look to get the risk off as quickly as possible too. So once the trade starts, I'm continuously raising my stop. This is starting to bleed into the trade management, portfolio management section, but I think that we've got just about the same panel on here for that section. So, yeah, guys, if you want to just keep on rolling with this section, we can. If you want to take a quick break, we could do that too.
I have to go, Michael, but I appreciate it. It was very much so being invited to this today. Jim, Stu, Pat, Adam, you guys are fantastic. Thank you guys for including me in this panel. It was great to get to meet all of you, and I'll see you guys. I'll see you guys on Twitter.
Thank you all for. I just wanted to share. Thank you all for sharing your knowledge, your wisdom. It's a good thing. Everybody, we all learn from that. So thank you all very much.
Cheers, everybody. Michael, once again, absolutely fantastic job with this. This was awesome. Thank you.
All right. Yeah. Thank you, Anthony. That it's been a pleasure having you here. One of the great things that I love about this is not just the wisdom and the knowledge that everybody shares, but it's the relationships, the friendships that I've built with each and every one of you. And I think that that's the true gold of all this. And it extends to everybody here that's here watching in the chat, that everybody that's participated here, ultra personable. You reach out to them on their social medias and they answer you and they're friendly, right? Like everybody here is so giving. Just build your relationships. That's the real gold. That's the real treasure here.
That's right. All right, guys. I'll see you later. Bye-bye.
Right. Take care, Anthony.
Michael, can we take a break for a minute?
Yeah, absolutely. So we'll take a quick break. 3 minutes, 5 minutes?
Yeah.
All right. Perfect. Quick break, and we'll be right back.
All right, everybody, welcome back. We're going to get our portfolio management and trade management panel started. For those of you that are just joining us now, welcome everybody. For those of you that have been with us for for the entire day or for most of the day, thanks so much for sticking around, and welcome back. So, well, we're going to do some quick introductions, similar panel to last time here. First, I'm going to bring on Jim Roppel. Jim is a very successful hedge fund manager who has been trading now since 1985. Is that right, Jim?
Well, if you count me trading out of my dorm room, yeah.
Oh my goodness! So I was 6. So blessed to learn from you, man, and I appreciate you taking the time to be here and share your wisdom, share your knowledge with us. Jim has been profiled in multiple books, How Legendary Traders Made Millions, Monster Stocks, both of them written by John Boyk. He has his own service that he's running over on Growth Stock Mentor, so you can learn everything, all these years and wisdom and knowledge from Jim every single week. Go check out growthstockmentor.com and also the lobby, the tradingmindwheel.com/lobby. You could follow Jim's Twitter, find his website there, and all the other speakers are on there as well. I see everybody else logging back in. Let's bring on everybody. We've got Adam Sarhan, who you heard from earlier too. Adam is running FindLeadingStocks.com and SmartMoneyCircle.com. I've known Adam for years, and so many of the beliefs that I have around trade management and particularly portfolio management and portfolio heat are thanks to this man right here, Adam Sarhan. Adam, thanks for coming back. Yeah, you're muted.
Thank you for having me.
Awesome. And we'll bring back Stu. Welcome back, Stu.
Hi, folks.
Stu has been one of the coaches at Mara for the past couple of years. He started out as part of the program, and he came back, and now he's helping to coach and mentor other people in our own Mara Elite mentorship program. He's had 1,000% return since 2020, and he's been trading now for over 15 years. Lots of great influences. Many of the people that we've been influenced by: O'Neill, Minervini, Bella Fiore, Jesse Stein, all those people. And we've got Pat Walker joining us once again. Welcome back, Pat. And Pat runs missionwinners.com. Phenomenal service. Pat is putting out so much value on Twitter. Just follow his Twitter feed and you'll learn an infinite amount on there. The mindset, what he's looking for and why, just pumps out value nonstop. A great follow on Twitter, and I'm glad that we met.
Me too. It's good, Mike.
So let's talk about trade management and portfolio management. And I saw some comments coming in already, some questions coming in from the audience. This question came in from Sharon saying that we touched on it earlier, but can we expand on how you set trailing stops and if you do, and if this is a strategy that works well for you, or how you might set a trailing stop? Let's go around the room. If whoever wants to volunteer can start first.
I could kick off if you like, Mike. I suppose this is one of the things that we coach people about the most. But yeah, I've essentially got 3 exits from any trade, really. So, your initial stop that you'd have that you set when you at the outset, which will hopefully move up to break even as soon as possible. I have a couple of scale outs that I set obviously at the start of a trade, a couple of targets that I'm looking for. And then I leave the last portion of a trade running on some form of trailing stop. My preferred one of choice is the 10-period exponential, and I just kind of track that up. It's mostly growth stocks I'm tracking anyway. So whenever I see a close underneath that 10-period exponential moving average, I will then set a backstop at the low of that candle, if you like, for that day. And if the next day I get taken out, I get taken out. If not, it marches on upwards. I just repeat that process over and over. So that's, over the years, I've found that's the one that works best for me. I used to be more flexible, I guess, with different, I would see which was the kind of dominant moving average in any one stock, but 95% of the time it was the 10-period moving average. So, it works for me, so I'll stick with it. So that's your starter for 10.
Thank you, Stu. Anybody else using trailing stops? If not, I can talk about it a bit as well.
Sure. So I use weekly charts to exit and enter if at all possible or whenever possible. Warren Buffett's got this thing in his annual reports, which I enjoy reading. He talks about the Great American Tailwind. Well, he calls it the American Tailwind. I call it the Great American Tailwind. And he attributes all of Berkshire Hathaway's success to the American Tailwind. So that blew my mind. I'm like, wow, the greatest investor, one of the wealthiest, if not the wealthiest investors of our generation, says this is the Great American Tailwind is huge. So as traders, he's an investor. As traders, there's a whole different time frame. Traders are looking at individual entries and exits, daily charts, intraday charts, and they tend to look at the leaves on the trees or the trees, but they miss the forest. So stepping back, looking at longer term charts and trying to align yourself with those trends has been extremely liberating, rewarding, and powerful in my world. And it's allowed me to look at the forest, look at the trees, but also align myself with those longer term trends. I'm going to have a lot of give back, if you will, or drawdowns, because I'm not going to get out at the exact high, but that's okay. It's part of trend following. And I'm not going to be able to get in at the exact low. I always tell people I'm not trying to pick the top and bottom. My goal is to capture the bulk of the move. And then by doing that, by using weekly charts, downtrend lines, uptrend lines, moving averages, it helps me zoom out a little bit. Most days don't matter. It sounds weird. Like, how could a day not matter? But just most days are irrelevant in the market. Some do, but most don't. So looking at the weeklies and making decisions once a week when markets are closed has really worked well for me, because it allows me to separate myself, do this, for example, instead of staring at the market all day. And I learned this from Nicholas Darvis in his great book, How I Made $2 Million Trading Stocks. When he was away dancing on the other side of the world, he would make a lot of money. He came back to New York, he was in the broker's office, and he got crushed. And then he went to Paris, made a lot of money again. So I'm the very much the same way. I'm really good at big picture stuff, and I'm really lousy at staring at the market and tickositis and looking at every single tick, because it just scrambles my brain like scrambled eggs. But hey, Adam, go north? Sure, no problem. Go south? Sure, no problem. But how to do the that kind of thing. So know your lane, know what your strengths are, and then stay in your lane is how I approach that.
Yeah, very, very interesting. I'm very similar in that way. And Darvis is a trading hero, right? Like, read his book, and learned that, wow, this guy was, using ticker tape and drawing charts by hand, and he was able to trade part-time. Like, we've got it easy. So one of the ways that I use trailing stops, it's not exactly a trailing stop where, like, you're setting it in your broker and it's moving on a percentage basis. That I find that to be ineffective, and it places your stop at weird spots. So what I like to do is to use a concept of danger signals, where there's a variety of danger signals that I'll look at on a trade, and I'll allow the weight of evidence to take me out of the trade. So if I get one or two danger signals, then that's not really a big problem. And well, in doing it this way, like sometimes you could have like a really rough day in the market where a stock like runs up and then it closes near its lows. And it might be like, oh my God, like not only did that trade do that, but several other trades did that. Now I'm scared. Now I'm going to sell. And what would happen is that like that would be premature and the market would be fine after that. So with coming up with this concept of danger signals, would say, okay, that's one danger signal, but what other danger signals are there? And then there's other danger signals that I would look at too. And if I get a certain number of them, then that would prompt an action. And the action could be exit the trade altogether. It could be raise the stop up aggressively. And the decision part and how many danger signals, it really depends upon the point of the trade that I'm in. So I'll look at the trade kind of like a chess game where you have the open, you have the mid game, and then you have the end game. And the objective is different at each part of the game. So during the open, my objective is to get my stop to break even as quickly as possible, get the risk, get the cost down to zero as quickly as possible. Great. Then in the mid game, my objective is to get to my average gain. And I'm tracking my average gain over time. So what my average gain was this month, this quarter, over the past 6 months might be different than it was last month, right? And that's one of the ways that the market is giving me feedback of the environment. Are we early in the bull market and most trades are just continuing to run? Great. I could hold on to that piece longer because my average gain is going up. And I'll sell in stages so that way I still have a piece that's going all that way. Like I'm not comfortable holding the whole thing. To me, that's too much more risk than I'm willing to handle, like the open risk. So I will scale out and allow pieces to go up and capture some of that upside. Great. So that's the mid game. And then the end game, that's where I've already sold out part of the trade at my average. And now I'm trying to hit what's called the high watermark. How far does the trade progress while I'm still in it? And so I want to get to that high watermark and extend that high watermark. So I'll sell another piece when I get to the high watermark over the last month. And then I'll let the final piece, the last quarter of it, go for as far as it's going to go until I get some major sell signals happening. Major sell signals, if you're familiar with O'Neill's work, like a break of the 50 or a parabolic move, things like that.
What are your danger signals?
So there's a variety of danger signals. Oh, it looks like, Pat, I had you muted because there was a little bit of echo. I can unmute you when you're ready. So to answer some of the danger signals, so there's a close, like a close at the daily low. That's one danger signal. A close near the weekly low is a danger signal. If it does it on volume, that's another danger signal, right? So closes at the daily low, closes at the daily low on volume, two separate danger signals. Closes below certain moving averages are danger signals. Something that I started to look at more recently is stochastics. Something that I've noticed in my trades is when a stock starts to break out, the stochastics tend to be turned up, and sometimes they're already in what some people would consider an oversold condition or an overbought condition, I mean. But from going through my journal and seeing how my trades actually worked, they tend to be overbought, and those are the ones that tend to work more. Great. So that's would be something that caused me to buy when they start to roll over and start to move towards the oversold port. Then that's something that's telling me that the trade is starting to lose momentum, and something that will also be another danger signal. Great. So I might have 3-4 danger signals on the trade, and that's not going to prompt me to take a move. The magic number for me is when I get 6 or more danger signals in the open part, right? The open chess match. That's when it's like, okay, just cut the trade. This is not going to be one of your big winners. Later on in the trade, it tends to be 7 or more. But in that initial part, where I'm just trying to get the risk off the table as fast as I can, 6 is the number.
A couple of the tactics that I use, and I'm an equity guy, and I've been doing this since 1986, is I used to day trade, and I got out of that because too much, at least in the stock area in that realm, it was just too much work for too little money for me. And I found through years of study, one of the best things to do is a clean and simple flat base. Doesn't need to be a cup and a handle. If you wait for the cup and a handle, you'll starve to death. And yeah, I was an IBD meetup co-leader for 12 years, and you go, oh, you're committing heresy. No, it's just the cold hard reality. We have to find a couple of other entry tactics, viable chart patterns that work. And again, I don't day trade. That's just me. I don't look at 5-minute charts. I want to try to ride the trend. And if you can pull it up, you could pull up NVIDIA, and you can see the clean and simple flat base breakouts on, you can take these dates down, 112, and then there was another one on 123. Clean and simple flat bases going across in the daily, and it just trends. Now let's talk trend, and this is important. I have 3 very important moving averages that I use to ride trends, and I never argue with them. I will ride these trends until they stop. I don't know how long it is, but I'll ride them. I don't look at stochastics or anything like this. I'm following price and volume and the moving averages. I use the 50-day moving average, the 21-day exponential moving average, and the 8-period exponential moving average. And if you punch up NVIDIA and you take a look at it from January 9th all the way through until February 17th, there's one day it closed a little bit below the 8-day moving average. It just rode the trend. You didn't have to argue with it. It does something very nice. It allows us to ride trends, which leads to far better profits than all the in and out decisions that we can make. Okay, just let the stock work for you. That is so important. We don't impose our will on the stock. We let it tell us what to do. Price and volume, and ride the trends. I'll look at, again, the 50-day, the 21-period exponential, and the 8-period exponential. And there's a couple of years of research in that 8-period exponential research. An individual who had a profound impact on that was Ed Sakota with the 5-period exponential, and I found out it was just too tight for stocks for daily moves. So we tested and back tested with the 10, the 9, the 11, and the 8 seems to work really well. We started using that at the turn of the century. And I will ride trends, and I will not argue with price. I'll let it work as long as it's working. But last key point, I will sell a little bit into strength when it's starting to pause or pierce the 8-day moving average. When I have got a really good profit, I will sell some off. Quantify the statement, I'll sell 20% off. Does 2 things. It guarantees a profit. No matter what happens, the rest of my shares could fall back to my price. I won't let that happen, but I could sell those for break even, and I still made money. Worst case scenario is I'm going to make money. Secondly, by selling some, it alleviates, minimizes stress, and stress derails thought processes. It allows me to let it work longer. And I've had stocks that after I bought them, I've got alerts set, but I don't even have them on my front page anymore. Just let them work. Let them work. A trend will pay more than anything else. But again, that's the methodology I use. And it's worked, and it's worked that way for a while. So I just wanted to share that with you. The 8-period moving average, exponential, and the 21 exponential, and the 50-day simple. Ride them. Last point I'll make, after you've got a good profit, you've locked something in, take the stock and don't put it on your front leap. Take it off your front page and put it on page 2 and let it work. Now that's just my methodology that works for me. So I wanted to share that.
Thanks, Pat. Got a specific question for Jim. This is from Sal. Sal asks, can Jim explain how he uses options to manage a specific position or his portfolio? Jim, can you share?
Yes. First of all, I have to agree with everything, not everything, but nearly everything Pat said. And I think in order to answer the question the gentleman just asked is you have to know the personality of the stock. And
True.
NVIDIA at this minute appears to really respect the 21-day, which is so unique and so statistically improbable Very, very few stocks will do that. I pay attention to the 21-day as a measure of health, but I find it so rare that anything I'm going to be in is going to hold that. You know, my guardrail is the 50-day.
Yeah.
And I'm willing to tolerate a penetration of the 50 predicated on the angle of descent into it.
Yeah.
If it glides smoothly into it like at 3:30 on a clock face,
Yep.
I'm chill. You get 5% below the 50. Now again, I'm trying to sit. All right. Like I'd rather lose 3-4% on a stock than take a 10% gain. So I'm willing to really hang on to these mons. My net worth is predicated on about 6 stocks, and that goes back a million years. Okay, so basically you have to know the temperament of the stock, if it's going to, you have to forget the first breakout, because the first breakout is a character change. So a stock is going to become a lot more extended in its first leg up. So you can't use the level of extension from the basing period as a hedge signal. So you have to kind of estimate and play some guesswork on the first hedging experience after the first breakout. But say it breaks out in the base, it's getting 5% over the 50-day, it pulls back. It breaks out and all of a sudden it goes 25% over, and then it has its first digestion. At that point, I'm going to probably do a lot of hedging, up to 50% of the whole position, every time it gets 22, 23, 25% over. And the more it gets extended over that first breakout level of extension, the more I'm going to hedge. In other words, if it breaks out, it goes up 25%. Now I know it's 25%. When we get up there again, I'm going to try to get 30, 40, 50% extended. If that thing goes up 50% over the 50, I'm going to hedge more and trim more. So again, awareness. That word in your book, dude, it's great, because you have to be aware of what the market is allowing to occur in the level of extension over the general indexes. And you have to understand the nature of the security you're in. And you don't have to say stock, you can just say security. What is the market allowing at this minute? And so when we get into those levels, I'm going to hedge. But in general, this sounds so basic, but I'm going to get out breaking the 50 almost all the time on violence. The magnitude of volume expansion or lack thereof is going to dictate how I handle the 50-day penetration. And I can sit with a stock for 2-3 weeks below the 50 if it holds within 4, 5, 6% of the 50. And again, I can't do that if I don't intimately understand the total addressable market and where its percentage that it already owns is and where it might go. Like with Lululemon a million years ago. Yeah. Again, I'm a little longer term than you guys, but I said they've entered into men's clothing. When 30 or 40% of all of Lulu's clothing is sold to men, that's a signal that they've tapped that market, and now they better come up with something else. Or, so I mean, I was willing to wait years. Again, I wouldn't ride it through a bear market, but assuming we stayed in a bull trend, that's where I was gonna. And now again, I'm still in Lulu from my personal account from a million years ago. So breaking the 50, and then the ideal situation is climax runs. Yeah. And now again, this can be dangerous, because if you're not cognizant and aware, in the 2000 blow off top, there were 13 climax runs, of which I was in several of them, and they were so prevalent, I started to think that was normal. I was so diluted and intoxicated, my mind had melted, and I'm like, oh yeah, just another 30% up move in 4 days. It's just the way it is. And so I sold a bunch of them really well into the climax, but I also started to take a few over the top. And regarding climax runs, don't ever, okay, so you identify you're in it. When it breaks badly, just because your stock is down 10, 20% for the day, or down 20 or 30 or 50 points, hammer that bid, because by the end of the day, it could be down 40% and 100 points.
You got it.
When they break, when you have a climax run and you're many days into it and you have a 20% up move and it goes break even, you slam that bid. I mean, and I don't care if you go, wow, I sold my first 1,000 at down 5 points. It's down 15 now. You hammer that. Now you're doing market orders at E-Trade or wherever you're at. I'm calling a trader and he's like, Jim, there's no bids. I'm like, I don't care. Splash everything. Don't let a big down move after a climax give you pause, because it's most likely some big whale is going to come in and just obliterate the thing. That was a 20-minute answer to your question. I mean, Pat's like really specific on, 6-day exponential, whatever, all that. I'm looking at it and I'm saying, did it break the 50? How did it do it? Is it a climax running? And I'll do everything in the world not to trade. I have to be forced into action. I'm nearly never preemptively taking action unless we're just in a raging trend and it's so probabilities expand massively that it's very near say you're in a rocking bull market and it's a TML is right at a pivot or just under. I'm probably going to race it through myself. I mean, but other than that, me preempting a signal it might not happen for 2 years, but occasionally it does. I mean, there's rules and then there's knowing when to amend the rule, but that's an experience thing. And you're often going to be wrong when you do it. I did something this morning which cost me a fortune based on rules, and sometimes the rules just don't work. But if you follow them consistently over time, they will work in your favor. So anyway, I tore that on a tangent for 6 miles.
No, that was great. You got me real curious. Well, what's this rule?
Not telling. It's too painful to discuss at this minute.
All right, maybe on the next conference.
I'm going to have to hit the treadmill for a couple miles after the close here.
All right. So let's see.
I'll tell you what it was. I hate trading in the first 30 minutes because massive gaps get faded in so many occurrences. And I had a big position in AI this morning. And I'll give you another clue. I called my trading desk. I said, what's the rebate rate on short on AI? And they're like, it's 4%. And I knew there wasn't intense pressure. And I knew that yesterday. But I said, I'll give it I give stocks every opportunity to succeed. So I said, I'm not going to, just bail on that. Mm-hmm. Well, we gapped down this morning and I'm like, it's a short report, 30 minutes to 3 days, 3 hours to 3 days. Maybe it'll recover. Well, by the time we got 30 minutes into trading, I think it was down 10% or something. So I gave back a good gain. And then and then I won't dump the whole position. I'm not an on-off switch. I'm a dimmer switch. So I blow a block out. And unless it goes down 0.5% or more, I'm not going to sell more. And so then I dump another 0.5%, another block out. And so I was my rules totally hosed me this morning. Now, somebody who works with me was really, really smart and blew it all out right on the open. And she did great. And the boss looks like a moron today. So there's the rule. I don't like to trade in the first 30 minutes, and it cost me dearly today.
Mm-hmm. Well, I appreciate you sharing that with us, Jim. The part where you said too that give a trade every opportunity to succeed, that I actually quote you in the book with giving the trade every opportunity to succeed. The way that I'm looking at giving the trade every opportunity to succeed is within our rule set, within whatever parameters we've set.
Anybody I'm sure probably half the audience listening golfs. If you don't get the ball to the hole, you've suffocated it. And if you sell all your new leaders in a brand new bull market up 15, 10, 20%, you're suffocating a possible 500% gain.
That's right.
I don't suffocate anything. I mean, I don't like absolute terms. I try not to suffocate potential life-changing stocks early in a new bull market, which we may be getting very close to. I don't know if we have another leg down or we've already made the low, but if I get tangled up into a winner and I get the right size on, you're going to have to really, really push me out. I'm not preempting anything. Now this is a moment that's rare. I mean, how often do you have a significant bear market, not your garden variety and growth. And we're long in the tooth. We're 200 and some days into this thing or more. The count is huge. We start to turn up here. We're going to see dozens of stocks go up 100 to 500%. So you sell a stock now up 20%. You lost your asymmetry. You've been waiting for a bear market and you're going to sell something up 10%. That's crazy, in my opinion. Don't suffocate them.
Yeah, let them work as long as possible. That is the truth. Amen.
Unless you're trying to pay the bills. You need $1,000 to pay the electric bill or whatever, then you're living for the nickel. But I'm not. I'm living for the big home run.
To me, there's a very important variable there that you're citing, and Jim, it's insightful. Is everybody has different circumstances and has to factor that into their equation thought processes. But the key point Jim's making, it's the truth. Nothing is more maddening than selling something and it keeps going up and you can't find a way to get into it. You're sabotaging yourself. And Jim cited this. If you have to sell a little bit to take some pressure off, okay, but let the thing work as long as you can. That's where the money's made. Just let it trend. We've got a really good one. Take it off your front page. Don't even look at it. Have an alert set. I have stocks that don't even have it on my front page. Let them work, and that'll help you.
I have to, Pat, you and I must follow the same situation because we're talking the same language, but I want to go backwards. Now, this is super rare, but occasionally you're going to get a big position on and it's going to work and it's going to grow to such an enormous percentage of your account. You have to trim because if it gaps down, it could be detrimental to your health. And on NVIDIA's very, very first breakout a million years ago, I mean, no one even knew what NVIDIA was. I put a thunder position on a mind bender and I didn't even know earnings were the next day, or no, the day I bought it, the earnings were that night. And my associate calls me, she's like, hey, blockhead, earnings tonight. I'm like, the volume's too big. I'm holding, and it gapped up and it was fine, but it went on a series of beat and raise quarters and it became so big that I trimmed before every earnings report. And I look back on it and I'm saying, I would have made a lot more money, but Pat was right. The position was too big. I had to let the pressure off. And on the other side of that, I may not have made as much money because I probably would have sold in a big shake in a weaker moment when this is a really big position. So the pressure can be too much and make you do your emotional. Dude, you talk about your emotions in this book 1,000 times. That is the game. And if the pressure is too big, your size is too big. Quick story. A very, very large trader in Chicago lived next door to me. And he says, what's your position in this thing? And I told him how many shares I had. And he was very old and I was very young. And he goes, look, I'm going to tell you. He goes, I don't know how much money you have. He goes, I'll tell you this. He goes, price will hurt you. He goes, but size will kill you. He goes, I'm just going to guess that position's way too big for you. When the position's too big, you can't think clearly. And this whole game is emotion. 5 points, all that's important, but it's up here. Really and if you ramp the pressure on yourself because you have to pay the bills or your position's too big, no one's Superman. You're so make it easy on yourself.
There's wisdom in those statements. It'll keep you profitable and it will help you minimize stress like Jim's talking about, which leads to clear decision making. But that minimizing the stress help you live longer too.
I mean, if you have 20% position, which for me is at a giant position, if you catch 2 of those a year that go up 100%, you're crushing it. You don't need, again, I'm not trying to build a war chest. I'm just trying to grow and compound out for, decades. When I'm building the war chest, I'm going to do some crazy shit. Like, not anymore. Dude, I'm almost 60, man.
I love it.
You don't look at Jim.
I couldn't hear you. I'm sorry.
I said you don't look it.
Oh, I love you, bro.
I love you too. a lot of what we've been talking about too, like I think involves portfolio management and portfolio heat. The person that I learned portfolio heat from is Adam. That's the first time that I heard about this concept of portfolio heat. Adam, if you could say a few words about portfolio heat, and tell us about it.
So yeah, everything that you guys were all saying, I couldn't agree with more. The single most important thing, the concept of portfolio heat, before I talk about the single most important thing, the concept is simple, is you have a portfolio and you're going to have ups and downs. If you trade or if you invest, it's just inevitable. It doesn't matter how good you are, how bad you are. All right, great. The goal is to keep the drawdowns, the down periods, as small as possible, shallow in size and scope, meaning a small percent decline. Keep those drawdowns small, and they don't last a long time. So short in size and short in scope. They're not years and years and years. That's the ideal scenario. Real world is different. And then you want to have this upswings after the drawdowns be as big as possible and last as long as possible. That's the ideal scenario. In reality, we all have to deal with what actually happens. And when you're too stressed out because your position's too big, like what happened to Jim, what happened to me, what happened to Pat and Mike and Stu, I'm sure other people as well, is it blows, you can't sleep, right? It gets too stressful. So what I call portfolio heat is that concept of the drawdowns are just too hot for you to handle. And they cause you to make irrational, just dumb decisions, for lack of a better word. That means the heat's too high. How do you reduce the portfolio heat? A few ways. Number one, understand what the heat actually is, where your entries are, where the market is right now, and then what happens where your stops are. What happens if all of your stops get hit right now to your portfolio? Are you down 2% or are you down 20%? That's the heat. If it's too hot, meaning you're not comfortable losing that kind of money, reduce the position sizing, like what Jim did with NVIDIA on the way up. He's like, listen, it's just too big. I know that if this thing gaps down, because it could, I'm not going to be comfortable. So I need to, it's the prudent thing to do, irrespective of the outcome, by the way, because something called outcome bias. You can't make a decision based on the outcome. That's not a good way of thinking. You got to make a decision based on the facts you have in front of you, because the outcomes are irrelevant. Because if you take that decision 1,000 times, the outcomes are going to change, but you want to know what the best outcomes, plural, will be over that period. So reduce that heat by reducing that position size is super, super, super important. And that's how I look at everything, is from a risk standpoint, because most people go into the markets like, oh, how much money am I going to make? I can get rich if I just buy 1,000 shares of this or 10,000 shares of that, and this thing goes from $1 to $10. I'm going to be rich. I'm going to buy a Ferrari or a car or a house, whatever it is. I don't know one person that goes into the market and be like, okay, right now I'm going to lose 2% or 5%, and I'm okay with that. Everyone looks at the reward side of it. How I want to get rich. I want to get rich fast. That's what everybody wants. So I'm just, okay, when I did that early on also, and I realized it's a losing proposition. So just step back and then flip it. Look at what people don't look at. And that's the risk side of it, and address that heat and make sure you're comfortable sleeping at night, because life is short. Enjoy it. Focus on the relationships, focus on the giving and not taking, and so on and so forth. And how can you make someone else's life better and happy and all this fun stuff, which is the important stuff in life, and put the market where it belongs, and you control it. Don't let it control you. And the single best way I've found to do that is by measuring risk and then keeping that heat down. So it's compartmentalized. It's where it needs to be, and it can't control me. I control it.
Great answer.
There's profound wisdom in that statement. There's more to life than investing. Strive for that balance. That's well said.
Well, everybody's getting a master class here for the entire day. Like, how many hours have you been going so far? Like we're coming on 6 hours of wisdom here. It's really incredible. I want to end it with a question that came up. It's come up a couple of times here. I think that this is the most concise one. How often is one of these large positions? So we're like going back to the larger positions, the big winners. How is it built? Like, is it built over days? Is it built over weeks? Is it built like, do you take a trade in a single shot? Like, how's everybody doing it? Let's go around the room and give a brief answer, and then we'll wrap it up. Who wants to go first?
I mean, I can go first because mine's fairly simple. I just put the whole lot on at once, and then slowly take bits off. And if I'm trading, I use progressive exposure like yourself. So if we're in a good market like we were 2 years ago or whatever, and you put a full size position, sometimes I even oversized positions depending on how I feel about things at the time, and then you get one of those 400-500%ers, then that's how it goes for me, and that will, like that Mara trade that we talked about a long time ago, Mike. So they come out of the blue sometimes when you least expect them. Because one of my things is I never know which trade's going to be my next big winner. So kind of treat them all the same, put them all on, and if it runs, it runs. But yeah, I put it all on at once, and then just trim and trail as it goes up.
Yeah, and I'm doing it the exact same way. So we'll go to the next person. Who wants to go next?
Go ahead. Sure. Go ahead, Jim.
I look at it very much so predicated on the condition of the market. Right now, the market is not providing, in rare instances, is it occurring clean, violent breakouts. So right now, and even in those cases, I'm building a position. It takes days usually to get a monster, or even more. I will go buy a block of stock, and if it pulls back, I might trim off 10, 15% of it, but I'm always trying to hold more than I trim back. But we're in a soft market here, okay? It's not just allowing. There's one stock, there's ON that just came out and it went wild. Now this is a rare situation. Most things are like AXON, where they emerge, and even with ON, it's trying to come out of this incredibly tight position, and I'll buy a little and trim a little back, and buy a little and trim a little back until it comes out, and then I might buy a lot of it, and if it holds and stays up, I might trickle more in. But if you're in a raging bull market like you were in 2020, or the raging of 98, or any of these raging bulls, they break out through the pivot and you have no chance. You've got to buy it all, and you've got to buy it in 30 minutes.
Yeah.
Like you might buy a block of stock, and within 3 minutes later, it's up 1% or 1.5%. You got to jam more on. And there's no pulling back where you have to cut anything out. It just goes. So it's predicated on the environment you're in. And right now, it's not even definitively that we're in a bull market or a bear market. It's possibly some type of transitional market, which if you take just a giant thunder position here, you're going to get smacked. You're going to get chopped to ribbons. So it's built. I am always building. It's just a matter of how fast do I build it, predicated on the market. That was a long answer. Patrick, what are you thinking?
The phrase that to me is so unbelievably profound, and I'm not saying this to patronize you, predicated on the market. This quote has saved me through the years. I'll believe in what I see and not in what I believe. It's a profound quote. I wish it was mine, but it's not. But the idea of getting in line with what is, we can impose our will, but folks, we're not bigger than the market. The market dictates our actions. We let it tell us what to do. I'm speaking from my heart. I mean, I was doing this in 1986. I missed I was out before the crash of 87. All my accounts were flat, thank God. But and you can say why? Because I'm so smart? No, the market was weakening. Everything was starting to drop. I got out. I'll say it again. We don't need to forecast because we don't know the future. By watching what is happening, it helps. And what Jim said to me is really profound. And I'm not saying that to patronize you, but it's the truth.
You can patronize me. It's cool.
I'm going to patronize Jim with I love it. No, you buy a stock and it goes and it's grinding up nice. You buy another one and it's going, and you see other stocks on the list. They're going. It's telling you, hey, things are improving, not just for the day. Okay. Over time, things are improving. We let that thermometer heat up, and it guides us to say, my stocks are working. I've seen stocks that I don't own that are working. It's building my conviction that I can buy more. Not get reckless, but buy more. And always remember this. Opinions don't pay. Forecasts don't pay. One thing pays, and I know I'm repeating myself, price pays. Never argue with it. And if you see something that gets extended in price, okay, it makes a cataclysmic move up really quick, and then it pauses and maybe starts to pull back on a daily chart, you could sell a little bit off, sell off 20%. And the last thing I'm going to say, I'm going to stop right now. This is a lie. This is a big lie on Wall Street. You'll never go broke taking a profit. Yes, you will. If your losses are bigger than your profits, you'll go broke. So it's compulsory to A, keep losses very small, and B, ride trends, at least with some of your shares, ride them as long as possible. Don't limit profits, limit losses, let them work. But by selling just a little bit, 20%. And I don't mean day trading, please. It's up a day, I'm going to sell some. No, you sell some, you've guaranteed yourself a profit, and you've relieved psychological pressure on yourself. You can breathe, which leads to clearer decision making. And again, my situation is different than others at times because I supported a family of 6 and we lived off our investing profits. That was the only source of income I had. So I had to learn. It would drive me nuts to buy something and it goes up. I make good money and I sell it and it keeps going up. I'm going, I'm wrecking my family. I can't do this. I had to fix it. So I just say, learn from my mistakes. Try to ride some. Last point, never let a good profit turn into a loss. Cardinal sin. And I don't mean, oh, I'm up 50 cents. No, I'm talking you're up 10, 20 bucks. Don't let that turn into a loss. That will help you financially, or it will also help you psychologically. I'm sorry if that was a longer answer, but I wanted to really dig a little deeper on it. Thank you.
I think it's a great answer. The way that I would answer it is just what Jim and Pat said, and Stu as well. Listen to the market. I always like to say the market is speaking, and then I ask the question, are you listening? It's our job. Just listen to the market. And as far as scaling in, it just scales in based on if it's working or not. Yeah. That's simple. If it's working, do more. If it's not working, get out of the way and do less. So it's just, you don't have to force it. You don't have to go all in at once. If you want to buy 100 shares, you could buy 50, test it, another 25, another 25. If it goes up, let's say 2%, another 2%. Or you could buy 70, 30. Or you can, any other way you want. There's no quote unquote rules to say, I have to go 100 all in all at once right this second. Scale into it and let the market prove that it's working and earn its right to get more of my money. That's how I look at it.
Yep. Earn. That's a good word.
Yep.
Thank you.
Absolutely. We're all following the same playbook when it comes to moving incrementally and using some form of progressive exposure along the way. So, wow.
I did find this guy, by the way.
How I made $2 million. Yeah, that's one of my favorites. How I made $2 million in the stock market by Nicholas Darvis. Yeah, totally get that one.
True story. Oh, can I share this? Decades ago, I'm going way back. You can go back. He's just an old dog. Anyway, decades ago, reminiscent of a stock operator, right? Reading that book, and I thought, you know what I'm going to do? This is before the internet, okay? I'm going to try to call Jesse Livermore, okay? Yeah, I know he's dead. So I try to call. This is the truth. I call and I'm, tracking. Finally, I get hold of the guy. And I said, can I talk to Mr. Livermore? And he goes, I'm sorry, he's dead. But it was his publicist from the book. Oh, wow. So I got to talk to him for a while. That was a long time ago. You can say, how long ago was it? I had hair, so it's going way back when. But it's kind of fun. Gotta have fun.
Oh my God, that's great. Well, we'll end it with that, guys. This has been phenomenal. I appreciate each one of you being here and being a part of this and really making this event special. And it is. How often do all of us get into a room and talk? Right? Absolutely sensational. I appreciate all of you guys. And I look forward to doing this again with you at some point down the line. But thank you all from the bottom of my heart. Thank you.
Thank you, Jim. Excuse me. Thank you also. We appreciate it. And everybody here that's in here, it's a pleasure meeting all of you. This is a good quote. I've got all these quotes stuck in my head, hence the hair loss, but we're not going to talk about it. But I like this mindset. Maybe you can take it with you wherever you go. Strangers or friends you haven't met yet.
Love it.
Makes the world a better place. Just wanted to share it.
Thank you, Pat.
Michael, can I say one thing?
Yeah, go for it.
I had a brutal day. I was really transparent and I talked about it, but it's a process. It's not one day. You know, you want to get seriously rich, compound your money out at 10, 15% a year for decades. You don't have to make these monster killings. I mean, I hope you do make them. But if you just compound for 15% a year for 30, 40 years, you're going to be crazy rich. And O'Neill told us exactly how to do it. And who said America bias or America in your sales, or who said
yeah, Buffett, the American Tailwind. Buffett.
Dude, the golden goose of capitalism is the Buffett factor there, you know, the American. And so unless the golden goose of capitalism is suffocated by socialism, the wind is just going to keep pumping out all these monster trends. So don't sweat these. Don't try to get rich quick, I think is what I'm trying to say. I'm done. I'm finished.
You know what's exciting? What you said, America, capitalism, innovation. There will be another Google coming. There will be another Amazon coming. There will be, I guarantee it. And you'll know what to look for, and you can get involved with it. And I love that.
Well, things started working for me. Well, when I dropped the let's try to double my money overnight and started to just focus on letting the process work. I think that's true for pretty much everybody.
Yeah. All right. Thanks, guys.
Totally.
All right.
Thank you.
All right.
Thank you all. We'll take a short break. Maybe about a moment or two. I've got to visit the powder room, and then we'll be right back with testing, forward testing, back testing, and factor modeling for our next panel. Be right back. See you soon. All right, everybody, welcome back. We are going to start talking about testing. Well, the final skill in the trading mind wheel, the skill of testing. And well, the way that I view testing is to look at it in three different ways. I look at it as factor modeling, as forward testing, and as back testing. And we'll get into all three of those things. But first, I'd like to welcome our panelists. First, I'd like to welcome Akil Stokes. Welcome back, Akil. Akil, to read your bio, Akil is an investor, Forex trader, and trading coach. He's the co-founder of Tier 1 Trading, and he has been featured in Forbes as one of the leaders in trading education. He is the host of the Trading Coach podcast and track coach at Millersville, and proud husband and father. So welcome, Akil.
Great to be back. Great to be back. It's a long day, but it's going quick, man. Good information.
Yeah, it sure is. Well, we've been going strong for 6 hours now.
I know. It's like it reminds me of one of those those donation marathons I used to watch like when I was a little kid, where it's just like these marathons of trying to raise money. It's just like I would kill for this as a new trader, man. I'd be soaking all of this up. So you guys this is great what you're doing, man.
I appreciate it, and I appreciate you being here and being a part of it all. So let's get into this panel here. I'm going through the questions here. Tell us first about the different kinds of testing, right? So there's, I look at it as factor modeling, back testing, forward testing. Do you look at it in the same way?
Yeah, similar. It's at the end of the day, it's testing inside the bigger bubble, and then there's different aspects to break down into it. But yeah, I'll typically break it down into kind of factor modeling is the bigger thing, but a back testing, a forward testing, and then I like to throw in a pre-back testing phase as well, and that's something I've learned off of my personal journey and long list of mistakes that I've made as a trader, kind of growing up in this industry.
Pre-back testing. Tell us more about pre-back testing. I'm not familiar with this. Well, what do you consider pre-back testing?
So I'll tell you a story, right? So when I first started trading, and well, not first started trading, after I kind of first got on the right track with trading, I had a mentor, a coach, and they told me about the whole, you got to develop something with an edge. You have to test it to, develop your reticular activating systems, your pattern recognition skill. You have to acquire your data and your figures to make sure that your edge actually works. You can't just kind of go into the market and do whatever. And at the time, right, admittedly, I had kind of I wasn't looking to learn how to trade. I was looking to learn what to trade. So in my mind, I was like, just give me the thing that works, right? If you give me the thing that works, I'll go through this back testing phase because I have to. But I was really just looking for a strategy that someone said was profitable, and I wanted to trade it right away. So I was given this strategy, and I tested it only in one way. I tested it. I went through historical data for years and years and years, and I tested only the exact way that my coach and mentor gave it to me. And what happened was I would get like halfway through and I would start noticing stuff. And I'd be like, well, that looks interesting. Every time this happens, I notice that. And I would start over and do it again. And then I'd go through the process, hours and hours and hours. I was unemployed at the time, so I was investing like 18 hours of chart time a day. And that's not even a lie, like 12 to 18 a day. And I would keep going through this process of like testing, seeing something, restarting, testing, seeing something, restarting. And in hindsight, that was a gift and a curse. In hindsight, I wasted so much time kind of testing and restarting. The gift was that it really helped my eyes develop. So, I can recognize patterns and read price action really, really good because of all those reps in the chart. But it taught me to spend time before the back testing phase doing a pre-back testing phase. So if you think of your back testing phase as kind of like your journey of data collection, you're collecting data on what you're working on, and you're seeing if it works and how it works and what's the best way to do it. Before you do that, spend some time in just like a creative mode. I like to say like a kid in a playroom or a sandbox. Spend some time kind of doing an eyeball test on what you're looking to eventually test. and just allow yourself to be creative, right? We are our best selves as traders when we're creative. When we have a strict kind of process to follow, we often get blinded because we're looking at a chart and there's so much stuff happening out there. You know it. We're only focused on a single thing. But if we can take time to just say, hey, I'm just going to spend 30 minutes just looking at stuff and admiring it and looking for different tendencies, things will start to pop out that we might have not noticed before. And those could be crucial things that you add to your strategy. It could be a filter that stops you from getting in. It could be a filter that allows you to get in. It could be a different way of placing a stop loss. It could be a different way of placing a target profit, right? There's so many moving pieces in there. And in my opinion, before we start our serious round of back testing, because it is time consuming and it's a hate or love experience, we want to know exactly what we want to test. So when I go through this pre-back testing phase, I want to acquire a list of like, hey, these are all the possibilities of how I may trade this strategy or how I may look to do this. And then when I go through my back testing phase, I'm collecting data on all of them. And then when I'm done, I can compare. Well, the A way of doing it was okay, but the B way worked better. This way had a better win rate, but this way was more profitable. Or, hey, only taking target ones is more profitable than taking target one and holding on for a higher one, like whatever it may be. Or this risk management strategy, if I trail this closely, I get stopped out more. But if I trail too loose, right, the market comes back and does whatever. But having that pre-phase where we're basically trying to discover what we want to backtest before we actually backtest is going to save you a lot of time, because now you have kind of every or the majority of situations accounted for instead of just being blinded by one thing and potentially having to, I don't want to say the word waste time, but use time to go back and do it again every time you get curious.
Yeah, I totally agree. And so the coming up with a hypothesis that you want to test first before it helps add so much clarity to what it is that we're actually going to be looking for, and to know if we're getting closer to a result, either positive or negative, right?
Yeah.
Like we might do a test and find out that we don't want to do X, right? Like that's great. But we might want to figure out something and then go off and do more of it. So an example, a personal example, is I wanted to see if I should start to increase my size, right? And I started to figure out, well, what would have happened if I had increased my position size by X amount, right? Like, so if I took my size from risking 0.5% to risking a full percent, or risking 1.5% on all my trades during a certain period, right? So the way that I like to go back and test is to test it not just on winners or losers, but to like look how it would affect every single one of these things. So that way I know the true outcome. And it's interesting that sometimes we do a test and we find out what we were doing originally was the right way to do it, that it produced the best outcome.
Yeah.
And when we start to think of beliefs, right, because of so much of this conference and everything has to do with beliefs, if we question the belief and we find out, what, the original way that we're doing it is working better, then that gives us that much more confidence in our system and going off and executing and being like, oh yeah, you know what, the market's doing whatever, but I have confidence because I've done all this back testing, I've done all the pre-back tests, and I've done all this work. Now I could go off and execute, and I know what's going to happen after 100 flips of this coin.
Yeah, the belief is key, and that is, belief and confidence. And throughout the conference, we've been talking about psychology and how, the 6 inches between our ears, that's the most important part of trading. If you don't have that belief, like you said, you're open, you're more likely to make those psychological mistakes, right? You talk a lot about mind state and whatnot. Like, you need to be in a fully confident mind state as traders and investors. We need to think of ourselves like professional athletes, where if you look at any professional athlete, they are fully confident. They could be the worst person in the team or the match or the game. It doesn't matter. They are fully confident in their ability, and having that full confidence allows them to kind of go out there and do what needs to be done without hesitation. As traders, if we're ever to hesitate or second guess or, do something like that, we can miss out on the move that we need to take. And we do that enough times, that's going to throw off our entire edge. So I'm like you, I love testing. And it's not even about getting the right answer, right? It hurts a little bit. Yes, obviously we're human to spend time doing something and have something that doesn't work. But now you know what doesn't work. And it's like any type of kind of, invention, right? You spend 99 times figuring out what doesn't work. It just puts you one step closer to figuring out what does work. It's funny. I just started actually 2 days ago. What's today? Tuesday, Monday, trading a new strategy that I developed. And I had no intentions of kind of creating it the way that I did, right? This is from years of other failed strategies where I was testing strategies. I wanted a specific thing and it just didn't work. But each time there was something within that strategy that did work. So maybe the overall strategy wasn't profitable enough to my liking, but there was a stop loss method I used, or there was a trail stop method I used. There was a target taking method that I used that did work within that. And eventually, if you're taking notes, right, when you're doing something, you kind of pull from your little notebook and say, okay, well, let me test some of these things that worked in the past on this. And I was able to put a few of those things and came together and again, ended up with a strategy that I had no intentions of using. And that's all because of the failed strategies, or I guess finding the positives or the gems within the failed strategies from before. So it's important to understand that just because a strategy fails, it doesn't mean the entire thing fails. There could be good parts of it. It's important to keep those notes because you never know when you're going to use them in the future.
Yeah, totally. And like, that it kind of speaks to one of the earlier panels where we're talking about journaling and post analysis. If we're journaling well, this factor modeling and backtesting, like, it becomes so much easier and so much more relevant because we could go back and look at the trades that we've taken, right? Assuming that we've got a system and we're executing that system and that we believe that this thing works and we're taking what we perceive at the time as the best trades, well, then that gives us something concrete that we could go back and test. Well, if I did this, how would it have responded? Right? Rather than, picking something out of a hat or going back and using somebody else's work, when we're using our own work, it can make it that much more real. Well, one of the things that I back tested too, and that actually ended up resulting in 20 to 40% difference. Right? So if I'm in a drawdown, it's 20 to 40% less. If I'm doing well, then it's going to be 20 to 40% more. Was going back and looking at all my losing trades and started to figure out, well, where could I cut this thing faster without getting stopped out of the big winner, right? And so I did this test, and it turns out that on my trade, so like everybody, if I'm going to share what I actually do, but everybody that's listening, you've got to go and test it out on your own trades and do the back test to see, like, well, how would this have worked on mine? Maybe it works well for you. Maybe it doesn't. You have to verify it. That's the whole point. So what worked so well for me was progressively raising my stop to break even while keeping it below these three things. All three need to be checked off. So below the 10-day exponential moving average, below a whole or a half number, right? So if it's trading at $100 to raise the stop to $99.90. Mm-hmm. And also to keep it below at least the prior day's low. When each of those three things are in place, then it's safe to raise a stop, and I wouldn't get stopped out of the trades that ended up being the big winners in, I believe it was 95 or 96% of the time. There were a couple of cases where I would have been tagged and the trade would have ran off without me. But to cut the losses, to cut so many extra losses,
that much faster, we're shifting the equity curve, we're shifting the distributions of wins and losses to, we've got this is the 0 mark. If we have a loss that's over here versus a loss that's over here, it's so much easier for the wins to lift the ones that are closer to 0 than the ones that are even over 3%, 4%. If we're able to take smaller and smaller losses, it's the wins end up counting for a lot more, and that's what the results of this test did for me.
Yeah, that's brilliant. I think one of the things that a lot of newer traders get caught up on is win percentage, and that being kind of the quick fix, where if my strategy isn't producing what I wanted to produce, I just need to win more. And understanding that winning more isn't always the key. Yes, it feels good to win. We'd all like to win more, don't get me wrong, but I love what you said about attacking different ways. And one of the first things I do in any type of strategy development or back testing is I look for those 3 key areas, right? I have what I call my baseline test, which is kind of like the generic bare bones test of the strategy. And then I get to work on it. And I try to target 3 different areas when I get to work on it. One would be, is there anything that I can add to win more or lose less, right? So, win percentage, right? Is there some type of filter, something I can use that's going to get me more wins or keep me out of more losses? The other 2 is there anything I can do? And this is kind of like the maximum favorable excursion that you talked about. Is there anything I can do to kind of cap my wins higher to that max level? So how can I increase my average win? The third thing is, how can I decrease my average loss? And if you just look at the numbers, and if you have a set risk reward and you increase your win percentage overall, boom, you're going to increase your profits. If you have your kind of baseline test and you increase your risk reward, meaning you win a little bit more on each of your wins and keep your losses the same, boom, you're going to be in more profit. If you look at your baseline test and your wins are the same, your win percentage is the same, but you decrease your average loss, boom, you're going to be more profit. So and of course, if you can find a way to do all 3, then boom, that's magical. But it's not all about win percentage, right? Losing less, whether it's losing less percentage wise or losing less from an actual like monetary risk perspective, is the same thing as a win. And that goes for even like Austin said earlier, if I can get out for a break-even trade, that if I can stop a loss and turn it into a break-even trade or a small loss, that is essentially a win because you didn't lose as much. And that's the mindset that we need to have as traders. It's not all about winning more. Sometimes it's about losing less.
Yeah, absolutely. Absolutely. There's a question that came in from Matt. Matt's asking about platforms available for backtesting. How do you do your backtesting? Are you doing it through a platform like software? Are you doing it manually? Well, what's your preferred method?
I'm old school. I got a stone and a chisel and I carve it in. I'm like Pat, right? I got an old soul. I believe in manual backtesting. Now I think it does depend on the type of system or strategy that you're trading. And I do think maybe sometimes a blend is appropriate. The reason I like manual backtesting, and it's not great from a time perspective, but it's good from a psychological perspective. I like manual backtesting because so much of backtesting, like we mentioned earlier, is about developing a belief. So to answer the question, first and foremost, I backtest on the same charting platform that I use. So there's no software. It's just old school, going back in the time machine and doing a replay mode or clicking through one candle at a time, literally. But I want to simulate as closely as possible what it feels like to actually trade this. Because again, there's one thing to have the numbers and know that it works. There's another thing to manage our mind state and say, can I actually trade this? So if I'm backtesting something, right, I just don't want the numbers that say, hey, you won this much, here's your profit factor, all that fun stuff. I want to feel it. Like I want to feel what happens if I take 10 losers in a row, because if that doesn't feel good in backtesting, how the heck am I going to handle it in real life? Like I'm not. But I want to go through that process also and see that, hey, maybe I took 10 losing trades in a row at some point, just throwing out random numbers, but then I recovered from that and I made new equity highs, right? I need to experience that, because if I'm going to trade it live, and if I'm going to have the ability to stomach that drawdown and have confidence that, hey, this is normal. This has happened before. It's not the end of the world. I don't need to panic. I don't need to system hop. That I just need to trade through, weather this storm, tread water until the next extension comes, right? That is going to help me. So for me, the main point of backtesting is data collection and whatnot. But from a psychological perspective, it is the only way that I can gain belief in what I'm doing before I'm actually doing it. And it's not going to be the same as trading live. It's not going to be the same as demo trading. So there are people out there where it's like, well, what's the point of demo trading or back testing? You can't simulate the live kind of feeling that we feel when money is on the line. And that's true. You can't. But this is the closest possible thing that we can get. It's the same thing as like, yes, past results aren't predictive, or, past results won't tell you what the future results are, right? No, technically they don't. We never know what the future holds, but it's the closest thing we can get. So we want to use it. So I'm good old fashioned manual back testing. I do think there is a place for automated back testing, especially if, let's say I've back tested on a certain asset and I know that something works and I want to expand my portfolio. Now I can maybe go to something else and run a simulator or whatever like that and have it spew out the numbers after I've already gained that belief. And that's going to kill me a lot of time. But I think when you're first going through it, if you're trading like a brand new strategy or something of that sort, I think you got to manually back test it first to get that feel and experience. And then once you have confidence and you're looking to grow, then you can automate it using a software or something like that.
Yeah, I'm the same way as you. I prefer the stone and the chisel, and really the spreadsheet of going through one trade at a time, and yeah, that tangible feel, man. There's and then to speak to too, when you're going through the back test and then you're starting to do the forward test, right? Like so I look at it in these three stages, right? Like so you've got your factor model, so you started to figure out, well, this is what I want to test and why. Now I'm actually going back and doing the work in the spreadsheet or the stone and the chisel and figuring out how this actually works. And now that I've proven to myself, this is something that I actually want to put money into, then the forward testing part starts. And that's where I think that some people can start to think that, oh, well, I tested it. Now it's time to go hog wild and put my whole account. No, like this is where the forward test just starts, right? Like, we want to start out small because then it's like testing in stages. So you're ready to start to put a little bit of capital to work. It's like a friend of mine just studied he's getting his pilot's license. Right? Like the first thing is like you're in your simulator and you're doing that part. Then you're going up with a coach. Like you're not just going up all by yourself. You're not ready yet. Like you have somebody else there and you're getting your hours in. Like I would put that as what forward testing is like. You're testing it out, but not with your whole account. Maybe you're starting to test it with like 10% of your account or whatever the amount is that won't kill you if you lost it all. But it should sting a little bit, enough to where you actually care enough about it, where like it starts to influence. Well, what do you think?
Yeah, I agree. It's funny you talk about skipping that process. Are you familiar with like the Leroy Jenkins video at all? Have you seen that before?
Oh yeah.
Leroy Jenkins. Yeah, it always reminds you of that. If you guys are go Google or YouTube search Leroy Jenkins, but I think they're playing like Warcraft or something like that, and it's a bunch of the players in a huddle and like they're going over this like intentional, deliberate strategy to like win. And then there's like Leroy Jenkins, who is like the impatient trader who's like, man, I'm tired of sitting here. He just runs in. He just goes, Leroy Jenkins. And he runs in to take on everyone. Like, what are you doing? And he gets killed and everyone else gets killed. But yeah, like a lot of traders want to skip past that part. It's like, man, okay, come on. I've got my arsenal. I got this thing that works. Like, I just want to let me go trade it, Leroy, and go in. But you got to go through that process. It's very important, right? You think about, and a lot of traders skip it because of time. We're in a rush, instant gratification. We want to do it as quickly as possible. But I think we can both say this, right? Our journeys have been, and everyone on this panel, our journeys of learning to becoming successful traders has taken a long time. None of us here did it in like a day, a week, a month. It took years. And during that time, it seemed like the longest time in the world. But when you look back in hindsight and you realize, like, so for me personally, I'm on year 16 of trading, and it's like, I don't know how I got to 16 years, but I look back at like the 2-3 years of struggle, which were an eternity back then. Man, it was nothing, and I wish I would have taken, done the right steps then. So it is worth it to take those extra steps that Mike is talking about. It's worth it to make sure you're fully prepared before you go into war like Leroy Jenkins, because the market is fierce. Like, if you are not ready and if you have not earned your right to be there, it will eat you up and destroy you. And for newer traders, in year one, especially year one of live trading, like, if you can just survive without going broke, that's a win, to be honest with you. And it's going to seem weird to say that, but the goal is to survive, and you survive and you learn, and then you kind of earn your right to be in the market, and then you go to those next levels. So if you know that first year is going to be tough, or whatever year is going to be tough, trade small. Trade small, enough so it kind of stings, like Mike said, so you get that psychological feeling and you build that tough skin. But you should trade small enough that you're not worried about blowing an account, that you have enough kind of chips at the table to survive the long game. And most people that can survive that first year of hardship, they go on to be good traders. It's the ones that blow accounts and then bail and switch, and those are the ones that we never see again. So survival is key, and make sure you're positioning yourself as a newer trader who is going to make most of their mistakes in their first few years. Give yourself enough cushion to kind of just tread the water until success comes for you.
So 3 years in, and then you started to turn the corner. How'd you turn the corner? Well, what was it? Well, what helped you?
Process. I can tell you what, I was like many traders. I blamed everyone. I blamed broker. I blamed CNBC. I blamed you, Michael. I blamed everyone. Like, anyone I could think of, I blamed everyone except for myself. And I remember I had poor trading results. It was the end of the year, and I did this audit on myself. And this was basically, I reviewed my trades, and I reviewed what my trades throughout the year would have looked like if I executed them perfectly. And then I compared that to, it's like an A/B split test. I compared that to my results, where I was making all types of dumb mistakes, taking profits early, moving stops back, like entering too late, entering too early, you name it, right? And I noticed that, and I don't know why I did this earlier, I was too busy blaming everyone else. I noticed that if I just would have executed the trades the way I was supposed to, I would have been profitable. And it was at this point in time where I had basically given up on trading, right? I had quit 3 jobs to focus fully on trading, right? I don't recommend anyone doing that. It's not that I was overconfident. I did think it would be easier than it was. But also I needed that urgency to really take it seriously. I know without my back against the wall, that's just knowing myself as a person, I was only going to do enough to like, just do enough. I wasn't going to really go all in. So I had to put myself in that position. And I thought I'd be successful pretty quickly. It took longer. And the nest egg that I had saved by going full time was running out. So I'd pretty much given up on trading. I accepted the fact that, hey, I'm not going to be a full-time trader. This isn't going to work. So I just said, hey, you know what? My mentor, my coach has been telling me process over outcome, just take good trades. We're just going to spend the final 6 months of my trading life just doing it. And I made this goal where instead of focusing on the results, I was going to focus on making less mistakes. So if I made 30 mistakes in January, right, my goal in February was to make no more than 29, just eliminate it by 1, right? Kaizen philosophy, continuous improvement. And I started doing this. I started playing the game where I'm just grading myself on execution, not results, grading myself on execution, not results. And it was funny. It was like I think it was actually around this time I got like my March statement. And the March statement came in. I'm used to seeing like the parentheses at the bottom of the statement, which means you lost money. And this one didn't have them. And I emailed my broker back. I said, hey, man, I think you sent me the wrong statement because, I lose money every month. Like, this is not mine. And they hit me back like, hey, Akil Stokes account number, blah, 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 blah. I'm like, yeah, this is your statement. I'm like, what? And it hit me. I was fully focused and consumed with process, playing this game of eliminating mistakes. And I was down to like 3 or 4 mistakes a month. And it hit me like, man, like doing this, the results worked. And all this backtesting stuff was actually true. I was seeing my results. And I never looked back from there. It was that last bit of belief, actually seeing it, because I was stubborn as hell. I didn't want to believe it. But it took actually seeing it, like what it took, focusing on the process and getting the outcome that I deserved. Game changer for me. Never looked back.
Yeah, wow. So this factor modeling and back testing and forward testing, this skill is a pretty important one.
Yeah, it was right there in front of me, and I just never cared, Mike. I just never cared. I did all the work, but I did it just to check a box, and I never actually paid attention to it. I wanted to make as much money as possible, as quickly as possible, and I was just blinded to everything else. And you feel like such a dummy doing that. Yeah, I mean, learn from my mistakes, guys. Learn from my mistakes, or learn from our mistakes, I should say.
Yeah, totally. Well, why would you say that this skill gets so little attention? I think that it's probably the one that gets the least amount of attention among all the skills that are needed.
Yeah, it's not fun, So I'm a former athlete, right? I still try to pretend to be an athlete every once in a while, but people don't understand this about athletes, right? They see them on match day or game day, whatever, and even you'll notice with marathon training, right? They see the end result, right? They see the tip of the iceberg, but they don't see everything that goes into it. They don't see the practice hours. They don't see the weight room hours. They don't see all the Sunday long runs that you don't want to do, but you're waking up 6 o'clock in the morning because you have to do it before it gets too hot. Like they don't, like, all that stuff isn't sexy. And that's what separates the successful from the non-successful, right? Everyone wants to be successful until you see what it actually takes to be successful, right? And it takes a massive amount of sacrifice, whether it's time, whether it's money, whether it's energy, all of the above, sacrificing with your family, right? Telling your kids like, hey, I can't play right now because I got to get this stuff in. I remember as a younger parent, when my kids didn't know what I was doing, they'd come into my door and like, I'd have to like, hey, you got to get out of here. And they sit there with the puppy dog face, like, why can't you play with me? And like, my heart cracks inside of me, but like, that's part of the sacrifice, and nobody wants that part. So back testing is long, it's tedious, it's annoying. I'm sure, we've all got pictures of ourselves that our partners took of us like passed out on our computer doing a back testing kind of marathon. It's not sexy. And they don't see the connection to how that relates to profit. How does going through historical data, Mike, how does that relate to profit? Can I just find a strategy that works? But this is the practice hours. This is the technique work. This is the nutrition. This is the weight room. This is the long runs, right? This is the stuff that actually builds you into a successful trader or successful in whatever you're doing in life. And it's not fun. Let's just be honest, it's not fun. And because it's not fun, because it's work, and most people don't want to make that investment, they overlook it. They'll find another way. I'll tell you this one more story, and I don't want to rant too much. I spoke to this guy on, I think it was TradingView a long time ago, and he's talking to him about back testing, the importance of all this stuff. And he's like, okay, well, how many hours? Like, well, you got to, plan it out and like give yourself maybe, and take an hour a day. And he's like, well, I work and then I get home and I spend time with the kids. And then if I take an hour a day, I'm not going to have time to play Xbox. And I'm like, yeah, so you don't have time to play Xbox. I used to game too. And guess what? I don't game anymore because I replaced that time with trading. I'm like, you can, and he's like, but he just refused to do it. The value of playing Xbox outweighed the value of back testing. And that's not to knock this dude. Like, he made a decision. It's obvious trading isn't for him. And it's good to figure that out before you get into it, because he saved himself probably a lot of time and money. But the fact is, he had to make that sacrifice. Something that he loved doing, he had to put that aside to fill that time with something that he doesn't want to do, but is eventually going to lead to him having more time. And that's the part I wish he understood. Like, hey, you invest a couple of years of not playing Xbox or limited Xbox play, and you gain freedom of time with trading, or financial freedom and freedom of time with trading. Man, you can play Xbox all day. But no one thinks 5 years, 10 years down the road. We're only thinking like right now. And yeah, that's it.
You made me think of my fantasy baseball days, because I used to play fantasy baseball in this league, and it was a money league, right? And it was where we would bid on players. And this was going way back before I really got serious about trading. And so like some of that mindset and using the, I was a guy that walked in with a laptop and the spreadsheets and all that. So that kind of bled into my trading a little bit, where like the organization part of it. But yeah, I ended up sacrificing the fantasy baseball to focus more on trading, because it's just like, all right, so I'm doing this league, and every year, the guys in the league hated me. So if there's anybody in the league that's watching, I'm sorry, but I would finish in the money every single year, and I barely watched the game. And it was because of the stats, and especially like that kind of organization stuff. But I was looking at that league, and it's just like, if I took the time that I'm doing that, and I still put a good amount of time in that, but if I shifted it over to trading and focusing on building business and all these things, like, how much better would that be? And so I ended up dropping that and going into trading. So the sacrifice. And one other point that I wanted to make, I think that everything is a sacrifice, everything's a trade. So if we could sacrifice our future success, or we could do the thing that we want right now. Right. So either way, there's sacrifice involved. Either way, we're trading off one thing for another. It's just what's the priority? What do we want to do? Well, what's going to produce the best outcomes for us? Whether it's short term, long term, intermediate term, well, what's going to produce the results that we need? And there's a certain balance in there too. One of the things that I mentioned earlier that I also mentioned in the book is I was going so hard on finishing this thing that I was just everything was being sacrificed, like days, nights, weekends, all of it. And I wanted to. I almost didn't go on a trip with my wife, my daughter, and my goddaughter, and my in-laws, because I wanted to get another 30 pages done in the book, and I felt that I hadn't earned it. And I was sitting there, and like my wife was saying that she was going to invite, ask me if I wanted to go, but she was like, yeah, you're probably not going to be able to go. I know that you want to focus on the book. And I'm just like, yeah, you're right. I want to focus on the book. And then I paused, and I started to break down, because I wasn't allowing myself to do anything. And it's just like, well, what's worth more to me right now? The 30 pages today that I might be ahead, or going on this trip? And it was just like for a day. So there needs to be some kind of balance, and it's up to all of us to figure out what that balance is. At a different point in my life, that balance might look very different. Later on, perhaps it's different. For everybody here, it's going to be different, but we need to be cognizant of what balance looks like, and understand too that balance doesn't mean that we're always even Steven. Balance is, we're kind of teeter-tottering back and forth, and sometimes the way to get anything is focused effort, but we need to rest, recharge, and allow ourselves some time.
Yeah, it's funny you mentioned that. A long time ago, I tested this strategy, and I broke it down by I'm in the Forex market, so it's 24 hours, and I found out that the optimal time to trade this strategy was like during the London Open, which is like 2:00 my time here on the East Coast. And back then, it was like, oh, we're gonna, grind hard, all the cliche stuff. And I tried waking up every night, like I think it was like 11 o'clock at night, and then trying to trade from like 11 o'clock to like 5 in the morning, because that was the ideal time to make that money, and just tore mentally, physically was torn apart. I destroyed everything just because my body couldn't operate. And again, you talk about the sacrifices. Some sacrifices aren't worth it, because if you're destroying yourself mentally and physically, what's the point, right? If trading is supposed to give us freedom of time, freedom of money, just freedom in general, where we can do what we want, have a clear mind, and be happy because we're achieving our why. If we're sacrificing our why to do that, what's the point? There's a really good trading book out there, not really talked about. It's called, it's a trading psychology book. I have it behind me. It's called The Winning Edge. And I remember it shared a story of this trader who went so hard in the beginning with his trading, and eventually lost his family. Like, he neglected his family. He took his losses home with him. So if he had a bad day in the market, he'd come home and be angry at his kids, angry with his wife. And one day he came home and they weren't there. And he had this realization that everything he worked for was gone. Like, he was working to do this so he can provide for his family. And in the journey of doing that, his actions got so poor that he lost the thing he was working for. Now he was all alone. And that scared the hell out of me. And that's one of the big stories that made me realize, you have to make sacrifices. You have to remember why you're doing it. You have to have priorities, and those priorities do change over time. But I love that you mentioned balance, because just when it comes to like strategy in general, we need to find balance, risk reward, win percentage, all that fun stuff. The same thing with our life. If we don't find balance in our trading, we're going to lose balance in our life, and that is in turn going to affect our family, and it's also going to affect our trading.
100%. One of the things that I mentioned before too, our trading has to fit our beliefs, our goals, and our ability to execute. Goals is not just money. Goals is lifestyle. Goals is and I don't mean lifestyle like having the mansions and the yachts and the diamond watches. I'm talking about lifestyle as how much time do you want to be in front of the screens? How much time do you want with your family? How much time do you want to be able to go, and how much flexibility do you want? Right, like those things matter too when you're trying to figure out, well, these are my goals. You could have a system that can produce incredible gains, but if your other goals aren't hit, then you're not going to be able to execute that system well. So all things to consider. I want to wrap things up. I'm curious to hear, like, what are some other parting words of wisdom that you could give to people that are in relation to this broader idea of factor modeling, back testing, forward testing, anything that maybe people might want to like common errors that people might want to avoid, or something that like an aha moment along your journey that, you know what, like this really helped. Oh, well, what little tidbit can people get? And then, if they want more, they can find you over on tier1trading.com. And we've got everybody's name and social on the tradingmindwheel.com/lobby. They could go there, read your bio, get your social media links, and connect with you on your podcast and everything. So
yeah, here is, and there's many out there. Here's one that's overlooked, and one that most people don't pay attention to just because they don't know. Understand that when we're testing something, we're developing a strategy, testing a strategy, we have a desired outcome, right? I don't think anyone goes in to test something to prove it doesn't work. We all want it to work. And because we want it to work, we sometimes subconsciously sabotage ourselves in order to get that desired outcome. And especially if you're putting hours and hours and hours of back testing on the chart, right? If you're going to be doing manual back testing, it is a must idea to break it up. You don't want to do these marathon sessions of 5-6 hours, because you keep going, you get stuck into this zone where your eyes get blurry, everything looks repetitive. I mean, if you look at candles for 4 hours straight, right, it gets boring and you miss stuff, so you're not as sharp. But you also start to sabotage yourself, meaning that because you want to see winners, your eyes only start looking for winners. Because you don't want to see losers, you start ignoring losers. And what this does is skew your data. Now your data has a greater expectancy than what it realistically has, because whether you know it or not, and some people do purposely do it, but most people, they're just not aware of it. You're creating more wins and eliminating more losses because you want that outcome. So you're sabotaging yourself. So it's very important, and this is what I always do. I want to look for losers, right? When I back test, I want to find as many losers as I can, because I know that if I purposely go into a chart and I'm trying to find as many losers as I possibly can, I'm even talking borderline trades. So something that maybe just comes 1 pip above the stop loss right there, but doesn't stop it out. Hey, I'm counting that as a loss, right? Maybe I got slipped, the spread, the broker, you know how it goes, right? I'm going to count that as a loss, because I would rather have my back testing show me the worst possible results, right? So anything that's borderline, I want to get the worst possible results, because if I can look for the worst possible results and it's still positive, man, I got something. Man, I got something, right? So look for losers is a good tip, I always say. And you can always double check your work as well, and that's one of the things of doing multiple rounds. Maybe you do it once, and then when you're done, just kind of go through it one more time just to make sure, because our eyes do change, and we're human beings. This is one of the negatives of manual back testing, is that we are humans. We are going to miss stuff. We're going to make errors. You don't get that with the automated stuff, but yeah, look for the losers, and try hard to ensure that you're not self-sabotaging yourself. So you're not saying stuff like, I wouldn't have taken that one because, it was 5 o'clock, and, don't make those excuses. Try to get as many losers as you can, and understand that if you can get the worst and it still performs well, you probably have something that's pretty good.
Akil, that was an amazing answer, and this has been absolutely incredible, man. Thank you so much for being a part of this. Thank you so much for everything all of your kind words that you wrote in the book. Thank you for interviewing me on your show. There it is too.
Read it. Trust me, read it. I've read millions of books in my, not millions, that's embellishing, but a lot of books in my life, as you can see behind you. This is a gem because it covers so many areas. Not to make this a book promo, but it is worth it. And this is someone that's been trading for 16 years. I learned a lot. So it is worth it. It's worth having in your arsenal. It's going to give you a lot of help in a lot of different areas where most books kind of focus on a single area. So it's a good one to have. Like Pat said, Mike didn't pay me to say this, but we love it, man. We love it.
I appreciate it, Akil. Thank you. Yeah, man, it's been real. I appreciate you being here. Thank you so much for all the wisdom and knowledge that you shared and continue to share on your platforms and everything. Everybody go follow Akil. Go check out the tradingmindwheel.com/lobby and give him a like, give him a follow, and engage with him on these social media platforms too, because he's a great guy and he'll answer your questions, and he's there to help, just like everybody else is. We're going to take a quick break, and we'll be bringing on Mark Minervini for a fireside chat. So stay tuned, and we'll see you in a few minutes. Thanks again, Akil.
Appreciate it, man. Appreciate it.
All right, everybody. Welcome back. We are getting ready to bring on a very special guest. This guest was integral in my trading journey, and in fact, I'm not entirely sure we'd even be here if it weren't for this gentleman. Mark Minervini is a two-time U.S. investing champion. He's written multiple best-selling books, and I can't wait to bring him onto the show. Mark, thank you so much for being here. It's such a pleasure. It's such an honor to have you here with us today, and to have you as the forward author on this book. Oh my God! And what you wrote there, I feel like I'm gushing here. Mark, thank you.
Well, it's well deserved. You've worked hard, and I've been around you for over a decade now. I think it's been. I'm not sure, you'd know better than me. We first met in New York City on a whim. You I guess took a shot at seeing if I'd meet you, and I happened to be on Lexington Avenue, and you were nearby, and we met at a juicing place.
Twitter is so great because I actually went back and I went through those Twitter DMs, and well, we were talking a little bit before that. We started to build a little bit of a friendship, and you had said that you were going to be in town, and so on a whim, could we meet? I think you had said that if we could meet up at a bar. When I said it's Lent. I gave up alcohol, and you had said that you don't drink either. So here's a couple of real fun guys getting together on the town. And it was at that point they said, well, how about we get together for a juice? And you appreciated that idea, and so. It led to all this.
I juice every day. I just had a big green juice just about 10 minutes ago. I'm still juicing.
That's awesome. That's awesome. And the what you told me on that day too, right? Like, so we met for 90 minutes. 90 minutes, 2 hours, however long we were there, and to just give you guys that are here that are all tuned in. Mark is world class. He's going he's doing interviews in New York City. He's managing his own accounts. He's writing books, and somewhere in that time, he's able to find a couple hours to meet with me, one-on-one at this place, and you gave me so much belief in what I was doing myself, to be able to take things to the next level, and I'm like trying to fight back tears, man. You've had such an impact. I appreciate everything that you've done. Thank you.
Yeah, well, you're quite welcome. I think I should put on my mindset, my 1/10 of 1% mindset cap for this, because I got to get you a cap, because this is by invite only. You definitely should be a member. It's and basically what it represents is the top 1/10% of people that are passionate, committed, willing, disciplined, all those things. That, matter of fact, I just did a little tweet about it today, about some of those champion characteristics. Or and again, that's when I see somebody that has that, I want to spend time with them. I want to help them, and I want them to help me, and I want us to grow together.
I appreciate that, Mark. Thank you. So a couple of questions that I have written out here. I wanted to ask you, can you tell us about a little bit about your process and how you developed it? But where I'm really going with that is the factor modeling part, right? Because factor modeling has been such a huge theme of your prior works, and it's been a recurring theme throughout this conference too. And factor modeling is such a foreign concept to most people. I'm curious to hear about how you came up with the notion of factor modeling, and what to look at and how to do it, and At one point, because well, you had spoken in your book that at one point you had your current process reversed, right? Like, so you would look at the market and then you would look at the stocks. What was it there that helped you to turn and flip that on its head?
Okay, so first of all, factor modeling isn't my invention or my observation. I didn't come up with factor modeling. Actually, if you go back through the decades of research and stock market, those who have contributed to the stock market body of work, O'Neill, of course, did an amazing factor modeling work, studying leaders. Later on, I came up with what I call the leadership profile, did my own studies sort of on the backs of O'Neill, but O'Neill also did it on the backs of going back to Richard Love, who wrote a book called Super Performance Stocks. That was sort of what O'Neill got inspired by. O'Neill was inspired by William Giller, and Richard Love, and also, like myself, Jesse Livermore and some other great traders that came before us. So now with mindset, I know this conference is about mindset. My book, Mindset Secrets for Winning, is a similar fashion of factor modeling, how we factor model for stocks and go back and take a look at what the biggest winning stocks had in common. Okay, so that's different than back testing. Back testing is when you just try everything and you see what gives you the result. Sort of the means justifies the result. So it doesn't, the result doesn't justify the means. Let's just put it that way, right? So we have to see. Let me put it this way, a better way of putting it. Let's say we're looking at Olympic athletes, right? And we go and we take a look at all the gold medalists and say, well, did they have a similar diet? Did they have a similar exercise routine? Did they think similar thoughts? Did they have some similar mental routines that they went through before they were under pressure situations? And then you find those similarities and you create a model based on that. So same thing with the stocks. I've done in life, and just went and looked at all the successful people. And how do they think? What's their diet? What's their routine? What's their mental state? How do they view things? And that's what really drives everything, because without the mindset, without the proper beliefs, and without the proper mindset, all the techniques, all the coaching, all the teaching, all the tools in the world is going to do you no good in the long term, because you'll self-sabotage.
Yeah. Absolutely, and there's so many things. I've got one of your books right here, Think and Trade Like a Champion. This is one that everybody else, that if you don't have this, you have to get it, and you can see like how much I've gone through this book and have really
my books, what I do to them.
So I would go through the charts that you have in here, and well, what I would do, because I discovered your work a little bit later on. Like, so I discovered O'Neill first, and Marty Zweig, and then and Darvis, and then it was later on that I discovered your work. So I came in with certain mindsets and beliefs, and then I learned more, and it really helped to fine tune so many things. But to help to figure out, well, how can I take Mark's framework and see like how does it overlay well with mine, and what else can I start to see? I started to go through your charts, but on my charts, if that makes sense, to see
Sure.
and that's where I started to see some of my own nuances,
Right,
in there, and how to act, and it's that part that I think helps to drive home some of the beliefs too.
Yeah, well, I mean, I did the same thing. I'm just a sort of a next generation to those guys that you mentioned, and there'll be next generations after me. Mark Ritchie is one who's works with me, and he's been developed as a fantastic trader, and all these fellows that have been winning the U.S. Investing Championship and doing great things. There's going to be people that are going to be better than me and better than all of us. That's what human beings are encoded for, to get better and better, learn from our mistakes, learn from people who came before us, stand on the shoulder of giants, and go even further. So this is just a natural passing of the torch. This is the way it's supposed to happen, and it's a beautiful thing that we can do this. And that's why I love to see someone like yourself having the success that you're having, and to be a small part of it.
big part of it, especially this here. So on pages 59 to 63 over here, you mentioned a couple of things on here in Think and Trade Like a Champion, and it's this here that it starts out with.
Mm-hmm. I get a lot of questions on that chart. that's a
Yeah,
very
well,
popular chart for questions.
I don't know if you could see what I wrote there, but I wrote
can't
major
see.
keys to success, and I highlighted that table, and this whole section here is just filled with gems. So, really, the whole chapter changed my trading life and changed my trading life forever. And understanding the math behind the reward to risk and the percentage gain and the percentage loss and the batting average. Can you speak to that a little bit?
Well, regardless of what, it doesn't matter the method that you're trading. Like this is universal stuff that applies to any strategy. I mean, to Warren Buffett, to Bill Miller, that they're, putting forth value type strategies, to a day trading. You simply have to have your gains outweigh your losses net of batting average. And that can happen where you can have a low batting average and have a very high reward to risk ratio, or you can have a very high batting average and you can have a lower reward to risk ratio. We found that the lower batting average, the best is to have a high batting average, obviously with a high reward to risk ratio, but the reward to risk ratio is more important than the batting average, because the batting average you can't control. You can't control how many times you're right, and there's going to be times, no matter what strategy that you're using, that you're going to have a streak, a losing streak, and that risk of ruin will rear its head. So what you can control is your risk, and sort of think of it as a pace car behind reward. So if reward is running in front of you, if you're on a racetrack and the reward race car is running at 130 miles an hour, you can run at 130 miles an hour behind it. But if it slows down, obviously you've got to slow down, you'll crash into it. So same thing with the reward to risk ratio. You've got to stay at a certain distance behind that reward, and you can control that. You can't control a lot of other things. So that's the holy grail. And it doesn't matter what strategy you're using. A day trader, those numbers are going to be very small. Your average gain is going to be very small. You're going to have lots and lots of turnover, just like a factory that produces bubble gum, and they sell millions and millions and millions of them, versus a factory that produces Ferraris, and sell a lot less, but it's a much higher price, higher profit margin. So whether you're a long-term investor, you've got the higher profit margins, you're going to do less turnover. If you're a short-term trader, you're going to have the lower profit margins, you're going to turn it over more. But it all comes down to your profitable trades times your batting average divided by your unprofitable trades times batting average. That's the holy grail.
How about the streaks? Well, do you track your streaks? And one of the things that we found was that you could do a calculation to try to understand what the streaks that you could expect, either a winning streak or a losing streak, given your batting average.
Well, when you start getting into prediction, you have to be careful, because, we don't know how long a losing streak's going to go, and we don't know how long a winning streak's going to go. What we do know is they do happen, and it's not purely random. It's not like a random generator where you're just, heads, tails, heads, tails. You can go a long period of time with a losing streak, and that's the risk of ruin, where now you get, even though you manage your risk, you lose because you get death by 1,000 cuts. So trading happens, and traction happens in bunches, and losses happen in bunches. So, and this is why a term that I've coined and has gotten popular called progressive exposure is so important, because with any strategy, the key that you want to make absolutely certain that you build into your strategy is that you're guaranteed to be trading your largest when you're trading your best, and your smallest when you're trading your worst. And the only way to do that is to progressively expose in the direction of your traction or lack thereof. If you do it any other way, if you say, well, I'm losing and now I'm going to double up, well, now you're trading your largest potentially when you're trading your worst, and then you can blow your account up. But if you pyramid up and you trade larger when you're trading well, and you pyramid down when you're not trading so well, well, then you're gonna phase yourself out into a bear market, and you're gonna phase yourself in a bull market, and you'll be trading very large and very aggressive during the best of times. So that's just sort of a fundamental, basic element that needs to be built in to any strategy if you want to be consistent and you want to get superior results.
Yeah, that's somebody had just said in the chat that there's so many gold nuggets in there. I think that if you could weigh that comment in gold, it'd be about 1,000 pounds.
Well, again, there's a mindset behind this too. I know. I mean, we're talking about a lot of tactical stuff here. I actually thought we were going to talk more about mindset, but I'll go wherever you want.
Well, sure.
Yeah, but there is a mindset behind this. Okay, and that mindset is of being a caboose and bending with the market and not trying to guess and predict and Monday morning quarterbacking. This is a big part of the mindset, because we can always go in there and it's like the market trading is like playing poker, and you always see the card, like what would have happened. You ever play, if some people play poker, and that guy always wants to see the card, like what would have happened. Can I see the card? Can I see the river card? It doesn't really matter, because you're making your decision on the information that you have at that point. And what would have happened doesn't change the probabilities. So with the stock market, we always get to see the river card. We always get to see the next cards. And so it naturally leans on our Achilles heel to Monday morning quarterback and say, oh, I should have done this, because now you start having the result starts to justify the means. And that's the mindset that you have to reverse, where you have to think in probabilities and realize that it doesn't, just because you lost with aces doesn't mean you stop playing aces. And just because you win with a pair of twos doesn't mean you made a good decision and that you should be doing that. So, and that's where, you really have to be objective and change your mindset to be more abnormal than the average thinking.
So let's talk a little bit about the beliefs. I look at beliefs as everything, right? So we have beliefs about risk management, we have beliefs about trade management, we have beliefs about all these things. And so what allows us to operate is really the beliefs of the software that's going to allow us to take an action or not take an action. So I'm curious to hear if there's any beliefs that you've had over the last, say, 5-10 years that have perhaps evolved since then. Is anything that's changed? Like, I know that there's nothing really new under the sun, but have you thought about something in one way and then started to think about it, or has your belief evolved in some way?
Well, my beliefs have completely changed 100%. If I had the beliefs that I started with, I'd have a tin cup in my hand begging on the streets of Manhattan, probably. So, I certainly would not be successful. I did not start off with a great set of beliefs or role models or conditions. So now, just like I said before about the factor modeling, we started off with factor modeling. Yep. Beliefs are the same way. So when I started looking at great traders and modeling what they were doing, I first, just like everyone, I went and I looked at the strategy and tried to emulate what they were doing, buying at the same point, selling at the same point, and I wanted the tools. But then I didn't get any success. 4 or 5 years went by, and I wasn't getting any success. And I realized that actually what needed to change was my thinking. And so, and I say this all the time, you don't become a Buddhist monk without thinking like a Buddhist monk, any more than you become a boxer without thinking like a boxer. You have to, in order to truly emulate, if you want to emulate Michael Jordan, you got to think like Michael Jordan. You're not going to play like Michael Jordan and handle the pressure situations and make decisions unless the mindset's there. So what I started to do is I started to really study how these people think and what their beliefs were, and what their core values were. And then what I did was I came up with sort of a list of the values that I wanted to live by, and then I contrasted them with the way I was living. and looked for that incongruence. And there was a lot of incongruence because I grew up in poverty. I grew up in a very difficult environment, a lot of violence in my home, just typical impoverished environment. And of course I left school at age 15. I had no education, no way to get a good job, a good paying job. So I looked at the stock market as a place where there was no prejudice against me, and that if I was great at it, then I'd get rewarded. The problem was I had no money, so I had to start very small, and it took a long time. I had to just put things together a little at a time, but compounding's an amazing thing over time. So the beliefs, again, if you're going to model, great traders, you have to realize that you may model try to model their moves and their techniques and their tactics, and it's still not working. Then you got to dig deeper. And that's why I wrote my own mindset book, was because I realized that, okay, I gave everybody these tools, and I do talk a lot about mindset, and there is a lot of psychology, mixed in with the trading books, but the mindset book really goes deep and really gets to the root of how to perform under pressure and to think like a champion and get that champion mindset, which is the most important thing out of everything for trading.
Yeah, absolutely.
Or any success, anything, succeeding in anything.
100%. And something that you go into a lot, and I think the same way. It's like focused effort and not just practicing, but perfect practice. Can you speak a little bit about perfect practice?
Well, one thing that this dawned upon me many years ago, it's actually decades ago. I had a client, and he had a partner that was trading. He was an older gentleman. I was still in maybe my late 20s, early 30s. And this guy always knew everything. Like he had an answer for everything. He appeared to be very successful. Come to find out, he was constantly lost money in the market, lost his client's money. And when I asked my client, I said, how long has this guy been trading? He's been trading for like 40 years. He was like 60 years old. And I said, wow, after 60 years, he's still losing money. He's not doing well. He says, no, that's just, he's not good, And I realized, I said, wow, practice doesn't make perfect. You could be practicing this stuff for 40 years and still be doing horrible. That was very discouraging. I said, okay, so, what does make perfect? So it's not just doing it over and over. Some people get in there and they just figure, open a trading account and trade, and I'll get this after a while. When in actuality, all you're doing is just creating bad habits. You're pounding them into your nervous system, and you're creating it making it 10 times more difficult for you to be trading effectively, because now you've got to unlearn the bad habits as well. So having a clean slate, trying to get the right coaching, the right tactics and techniques right up front is really important. So again, I might have digressed off your question, but
yeah, no, I wish that we had met sooner. It would have saved me even more time. I had struggled for 10 years before I even began to turn the corner with any of this, and pounding in bad beliefs, limiting beliefs, not even knowing that there's all these other beliefs that are just running in the background, that needing to bring them to the conscious, writing them all out and figuring out, well, what's helping me get to my goal, what isn't. All that is critical.
Yeah.
Absolutely critical. So with this in mind, like there's a lot of people that are newer traders that just got started during COVID, that all they knew is that stocks move in one direction up, and they learned the hard way, especially over the last year and a half now, that stocks don't just move in one direction. So what advice would you give to those people who have actually stuck around through that process and haven't given up and want to get great at this?
Yeah, well, we all learn the hard way in the stock market. There is no easy way. There's no you don't. The stock market is just like boxing. Like, it's impossible to be a boxer and not get beat up, not get some bruises. Yeah, it's you're gonna have to go through that, and you have to embrace it. It's a part of it. It's a natural part of it. In the beginning, hopefully you're trading smaller. You don't have a lot of money, and if you do, and there's much more risk. Of course, I was fortunate to start off poor, so when I first started and I had all my losses, although it was everything that I had at the time, and it was disastrous, and I was extremely demoralized and was scared to death, it was still an amount of money that I could work, save, and replace. If I were to if I were to have the results that I had in my first few years now, it would be life changing. It took my whole life to get to where I am now. So again, you need to embrace these setbacks and use them as teachers, and go back and take a look at what happened and study and realize that even another cycle or two, you may not get there. It may take a few more. People underestimate what they can do in 5 or 10 years and overestimate what they can do in 1, 2, 3 years. So you got to think in decades, not in months or years. Definitely first base in this business is 5 to 10 years. Okay. Maybe you won't feel that way at the time, but after you're doing this for 40 years, you'll look back and go, and oh my God, at 10 years into this, I didn't know anything at all. So again, but it's well worth it. Especially if you're young and just starting, if you put 10 years into something that pays you for a lifetime and is life-changing income or wealth, then it's well worth the investment.
Yeah, I agree 100%. That the time frame of 5 to 10 years, is that 5 to 10 years learning the right way, right? Like learning with a coach, mentor, somebody that like yourself, that's world class, that knows what they're doing.
However you get there, if you can get there on your own, great. I mean, I didn't have the benefit of having what we have today. So that might be why it took me so long, because, there was no YouTube. There were the books that were written on the stock market back then. Most of them were terrible until O'Neill came out with his book and a few books that, I got turned on to, like Jesse Livermore's book and Darvis and a few books. Most of the books were outdated, and they were written on strategies that never worked in the first place. Even today, most books are written on things that don't work. Most people that are on YouTube or on the TV or have newsletters or whatever are people that have never had big success. Meanwhile, everybody listens to them and takes their advice and then wonders why they're not champion traders. So you've got to have a good guidance system first. You've got to decide on what your guidance system is going to be and who your coach is going to be, what your strategy is going to be. And then you have to make a commitment to it. Once you find something that's worked well, you have a great strategy or technique, you're not going to go to a top coach or a top school and get on a basketball team or a lacrosse team or a pro football team and go in there and think that you're not going to stick to the coach's plan and fully commit to that way. And so you've got to make a commitment. It doesn't matter. It's not a matter of whether you do my style or, my way is not the only way. There's other ways to do things. Yeah. Mine's not the only way to be successful in the stock market. It just happens to be the way that I've committed my entire life to. And I know inside out, I know everything about my style. I don't know anything about anybody else's, but I know everything about mine. And that's what you need to get to, is where you know everything about the style that you're doing, you're using. And that takes time, that takes commitment, to commit to a particular strategy, coaching system, whatever it is, and really make a long-term commitment to it.
Yeah, absolutely. And well, what about the person that's trying to find the right coach for them, the right mentoring, the right system, and there's so much stuff out there. How do you know if this is right? Like, if I'm listening to the right thing, and if I'm kind of new to this and I don't know.
Yeah. The problem we have now, see, when I first started, there was no information. Now we have too much information. We have information overload. So now you've got to sort through all the BS. First, my very first litmus test is, has the person achieved what you want to achieve? And so that's my first test, is this person actually achieved what and some people say, well, there's great coaches that weren't great basketball players. Yes, but I already want them to prove that they've coached champions. If I'm going to put my team into this coach's hands and say, take me to the championship, I want to know that they've already taken a team to the championship, even though maybe they can't play the game themselves. So maybe you don't have a coach that is a great trader and he won the U.S. Investing Championship, or he's made tens or hundreds of millions of dollars trading, but he's coached a lot of successful traders and he's got a track record of a lot of successful traders coming out of his stable, if you will. So that would be one way. And then it's got to make sense to you, and it's got to be something that you can believe in and is simpatico with your personality. You might be, some people just can't go through the volatility and hold through losses. So that long-term strategies and going through large pullbacks or value strategies where you buy stocks that are out of favor is just off the table for them. I happen to be one of those. I'm not going to go through that. I work too hard for my money, and I don't want to sit there and watch my wealth evaporate by 50% and put my faith in a little piece of paper called a stock certificate. That's not for me. Some people that they can go through that, but so you have to pick a strategy that fits your personality and that you feel comfortable with and you can live with and sleep with at night.
Yeah, totally agree, and it's one of the reasons why when I found your work, it really helped to solidify what I had learned from O'Neill and Darvis and the entire IBD program, because what I was trying to do initially was to try to be more intermediate to longer term and hold through bases and things like that. I found out the hard way that I'm not wired that way. And so when I learned about your style of management, it really helped a whole lot.
My style can be applied to a longer term hold period. What I say is that short-term trade your losses, long-term trade your profits. So if you want to hold for the longer term, that's fine. If you want to give some leash, give the leash on the upside, but not on the downside, and create that asymmetric leverage. That's what you're trying to create, asymmetric leverage. It's all about asymmetric leverage, all asymmetric risk, where your reward outweighs your risk, and you constantly maintain that, even after you're in a profitable position. And that could be a whole entire show just on its own. But But that's the goal.
One of the things that I remember you telling me early on too, like you get to your profit target, sell half, right? Like if you sell half and it keeps on going up, then thank God you held on to half. If it comes back in on you, then thank God you sold half up here. And either way, it's a win-win.
It's a win-win psychologically. So that's getting into mindset again. So now we're talking about mindset where, if you're indecisive, I mean, how many of you have been in a stock and it goes up and you go, oh man, what do I do here? I got a great profit. And you look at this dollar profit that you have, whether it's 1,000, 5,000, 10,000, however many dollars it is that make that make you really excited and happy and you don't want to lose. And then that thing starts going against you and you're at an indecision. You're at this point of indecision of what should I do? What should I do? And then of course, you sell it goes higher and you say, oh my God, I should have never done that. Or you hold it goes all the way back down. You're saying, oh, you're kicking yourself. I wish I sold it when it was up. And now you're all confused. You're all confused. You don't know what to do. And you create all this turmoil. And that's because there's a lack of rules and there's a lack of understanding on how to not only manage the trade, but to manage your own emotions and confidence. So a psychological win-win is, if you're at an indecision, as Mike, as you're saying, is that you sell half. It only works with half. If you sell any other percentage, then you're more right than you're wrong, or more wrong than you're right. So if you sell half, the stock goes higher. Yeah, you say, wow, thank God I held half. If it goes lower, you can say, boy, good thing I held on to half. So it's a psychological win-win.
Outstanding. Mark, I know that your time is limited with us, and I want to be respectful of it. Well, we've been on here for a half an hour getting all these gems. Is there any parting words that you want to leave with the people that are perhaps on the newer side, or someone that's struggling that wants to try to make this work?
Yeah. Well, are we? We're wrapping it up because I'm actually scheduled for a little bit longer.
Oh yeah.
Yeah. I mean,
Uh,
I thought we were going for 45 minutes or an hour, so it's up to you.
Oh my goodness! Yeah, no, I don't want to. If we could get another half an hour of Mark Minervini, then I'll take it.
Yeah. I've got till 6. That's what I was scheduled for. So it's up to you. But let's
All right,
let's go in
let's
reverse.
keep
We'll
going.
start with parting words, and then we'll give additional parting words later.
All right.
I mean, if you're starting off, you should be, very excited. You should be excited about the future. For me, trading is kind of boring now. I've been doing it for 40 years, and it's kind of like riding a bike. I was much more excited and had when I knew nothing, to be honest with you. So it's in a very exciting time. It's a sign of where you're going to be unsure of yourself. Of course, I'm much more sure of myself now, and maybe that's why it's not as exciting. There's not that risk factor, on the edge of your seat. But the bottom line is that the one thing you have to not succumb to is the negative news and those people out there that will tell you that it's different this time, and oh yeah, well, that was easy back then, but now it's different. The economy's terrible, the world's terrible, the world's coming to an end. It's all nonsense. It's all nonsense. You'll be 10 years from now, 20 years from now, you'll be looking at the Dow at 100,000. People be saying the same thing, just as they did when the Dow was at 100, and then when it was at 1,000, and so forth. When I first started, I had a very good friend of mine. I won't mention his name, but he was the most negative person on the economy. All I ever heard was, it was the end of the world. We were going to go into a depression. When I first started, the Dow was trading a little over 1,000. A little over 1,000, and he told me all the reasons why, along with other people in my family, why I shouldn't be trading, why it's not a good business, not a good to bet on America for the long term, and the stock market, it's risky and it's gambling. And then, of course, decades later, the Dow's at 35,000, and to this day, I'm still friends with him, and he tells me the same thing to this day. And I say to him, really, man, I've made tens of millions of dollars since you still told me that, and you're still singing that same song. Yeah, but it's different. That's right. You got lucky, the last 40 years, I've been lucky for 40 years. O'Neill got lucky, Darvis got lucky. Everybody got lucky, So anyway, the main thing is to just believe that there's great opportunity that will come, but you have to be prepared for it. You got to spend the time when things are lousy and everybody's talking about the end of the world, and that's when you got to hit the books, study, and prepare, because that pitch is going to be coming across the plate. But if you're not prepared for it, then you're just going to be watching it, and you're going to be chasing the tail.
Agree 100%. And I forget who had said this, but the more prepared I am, the luckier I get. Right. So
yeah, Arnold Palmer, Gary Player. There's a bunch of people who said it, but I think it's attributed to Arnold Palmer or Gary Player.
Yeah, and they certainly works out well for trading stocks too. Well, one of the things that I've learned to do is screen for stocks that meet a certain technical or fundamental criteria that and I'll call that a universe. And I'm kind of curious to hear your thoughts on how you manage it, because you have and I've heard you talk about this in your book and on other places where you'll monitor the stocks that are passing your trend template in MarketSmith. And by the way, this is such a useful tool in MarketSmith, where you could just click a button and you could see the stocks that are passing this trend template, and it's showing you everything that's in an uptrend, everything that's even worth looking at. And so
right. That's in
Market
MarketSmith, of course. Yeah, there's several trend templates. So that's what I call a qualifier. And so my qualifiers are in MarketSmith. They're hard coded in there, and you can use those screens, and you can use it as a starting universe. And then you can overlay additional criteria over that. But what it does is it narrows it down to the names that are in what I would call a confirmed uptrend. It also has when they're one that's called an early turn. It's a 1 month uptrend template, which gives you sort of a heads up on the ones that are just starting to turn up. I know David Ryan says he looks at that every week. So the thing is that, and when you get bear markets, all of a sudden everybody starts trying to bottom fish, and usually they bottom fish the old leaders. And you might get some here and there, like Nvidia is doing really well off the lows, but usually that looking in the rearview mirror doesn't work very well going forward. And you got to look for new leaders, and those new leaders are usually, when the market's correcting, they're turning into uptrends even before the market bottoms. So I'm looking for the strength. I'm always looking for strength in the market. I want to buy the strongest stocks, not the weakest stocks that got beat up the most. So the trend template is something that, or qualifying a stock and making sure that it's in an uptrend before I buy it, is just standard operating procedure for the last 40 years that I've been trading, and it's never changed, and it never will, because that's where you're going to find the better names and the leading names. And this isn't just based on my own anecdotal evidence, which I have 4 decades of and proven success with, but it's also, when we go back, we look at all the biggest winning stocks. Here's the real thing to remember. The biggest winning names, going back all the way back to the late 1800s, if you go back and look at them all, the average stock was, before it went and made a big move, was already up over 300%, and 98% of them were in a stage 2 uptrend, which would be my trend template. So 98% of the big winners met my trend template criteria prior to them making the big move. So my question is always the same to people. Would you like to have a 2% probability or a 98% probability of finding a big winner? It's a pretty easy answer.
Yeah, I totally agree. And I've ended up finding so many big winners myself based on following everything that you've laid out here. It's more people. You don't. You need to trade in the way that's going to serve you and your beliefs, your goals, your ability to execute. But this is one of those ways that just works.
It works. Yeah, it doesn't work always. No, there's no strategy that works in perpetuity always.
No.
You're not going to hit lotto every week. But it doesn't have to work always. It has to work over time. Okay, not every time. It has to work over time and consistently. So that's you're going to have periods where you're out of favor. That's when you are laying the groundwork for the opportunities that are coming forth. That's when this is something that I always quote from O'Neill that I learned when I met him in person several times. One time he said to me, and I think he also says it in his book, or maybe paraphrased, he said, while you're doing nothing and you're sitting out and you're studying, the undisciplined, the traders that aren't as disciplined as you, aren't as skilled as you, are laying the foundation for your success. They are laying the groundwork. And it's your job to prepare during that time and be prepared for what gets laid out, and then that opportunity when it comes across the plate. I took that to heart and really and made an entire career on that. So right now is one of those periods where you need to be studying, getting ready for the next bull market.
Yeah, sit out power, right?
Sit out power is what I call it.
So how did you develop sit out power? How could everybody here learn to develop sit out power?
Well, so for some it's difficult because they want the action. They want the action. They want to be in there. They want to be a trader. And when we first start doing this, we want. When I first started, I wanted 25 screens around my head. I wanted, I had that picture of a stock trader. You want to be Gordon Gekko. You want to be that guy that's, you're in the cockpit of a 747 and you're making all these trades. As you trade over the years, you start realizing that it's the sitting out and it's the boring times. Well, actually, trading is boring most of the time, and you realize that action only happens in certain times of the year, and it comes in bunches, and that the rest of the time is a very risky environment that you want to avoid. So you start understanding that the real key is to avoid risk. So you want to be in the market at the least amount possible. I mean, if you told me, look, I want to make 30% this year, if I can make it in one day, well, that's a lot That's a lot less risky than if I make it in 3 days, right? And it'd be even more risky if I had to be in the market for 10 days, or if I had to be in the market for 6 months. So the less you're in the market, the less you're at risk. So I want to make my return in the shortest period of time and be out of the market as long as I possibly can. That's the exact opposite of what standard conventional wisdom would say. You're out of the market, you're at risk, you're missing opportunity. No, you're not. You're at risk. You're at risk of loss. Yes, there may be opportunity, but there is definitely risk. You're at risk. When you take a trade, it's all risk. You have no profit, it's all downside. You're taking risk. All right. So I want to take those risks, very calculated, and I only want to be trading large and taking big risks when I've already had some success. And that's where we get into the progressive exposure. But that, that's just a general guideline.
Yeah, so much of the time is really spent in the prep. I kind of think of it like painting, right? Like painting a wall. Like for anybody that's painted a room or anything, you could take your bucket of paint and you just slapping it on. Paint's going everywhere. Yeah, you might get done quicker, but you've got this mess, and it's going to take you even longer to clean up all that and everything. But if you're spending more time on the prep work, and you tape in the wall really nice, and you're spending time to plan all this out, then it makes the painting nice and easy, but it's because of all the time that went into the prep work.
Yeah. And again, there's opportunities in the market where if you time your trade, another conventional wisdom is that you can't time the market. Timing the overall market is difficult because it's very random. But when you get into individual stocks, they're much, and especially if you get into small and mid cap names, there's a lot of inefficiently priced securities because you just can't simply have every security followed efficiently. So you get these moves where you see these very big, fast moves that happen. You can compound your money very rapidly. That's what you want to shoot for. You want to shoot for those velocity moves and make as much as you can in the shortest period of time that you can. Now you're taking full advantage of your time, of your time value. Now there's 4 phases in the market. You're either losing time, in the 4 phases of an uptrend, where you're either moving sideways, up, topping, or down, bottoming, advancing, topping, down. There's only one phase that you really want to be in, because every other phase, you're either losing time or value. If you're bottoming and you're moving sideways, you're losing time. If you're topping and you're moving sideways, you're losing time. If you're falling, you're in stage 4 out of the 4 stages, you're losing value and time. Only in stage 2, which of course, once again, this goes back to the trend template, where 98% of stocks were in when they made their big move. Only in stage 2 are you taking advantage and getting the best use of time and gaining value very rapidly. So that's why that's the only stage that you ever want to be trading in.
Well, we had a question come in from Kevin here. If you could explain hard penny or easy dollar market environment, and well, where are we now? I think I can guess your answer, but I'll let you answer that.
So hard penny versus easy dollar is something that I've termed, and I think it actually goes back to maybe Jimmy Rogers. I think Jimmy Rogers, many years ago, I heard him say he wanted to wait until there was money just sitting there and pick it up off the ground. I think, I can't remember, but I turned it into a hard penny versus easy dollar, meaning that, and what I've learned over the years is that there's times where money is made very easily. And that's what, if you're new and you get sucked into, you get into a new bull market, and like we just saw, like you said, a lot of people never saw the other side of the coin. You say, wow, this is easy. And that happened to me. That happened to me in the beginning. My first stock, I bought Chalmers. It was a maker of forklifts and tractors. And I bought it at 4 1/8, and it shot up to like $8 in just in a month or so. When I remember, it went up to 6, and I was like, holy cow. And then up to 7, it was up to 8 change. And I sold it and made like 100% in a matter of just a couple months. And I was like, wow, this is for me. why would I ever work when I could just do this, and or put my money in a bank and get interest. And sure enough, I was buying Chalmers at a 52-week low. It was beaten down, and I just got lucky. I just happened to be in the right place at the right time, and I developed a bad habit. And then that very tactic blew me up later on. I thought it was real easy, you know. So, but there are times where money is made very easy, and you're feeling very little heat or pressure on your portfolio. And those are those low vol times where you want to be in the market, be very aggressive. And then there's the hard penny where you work your butt off, you trade like crazy, and you get nowhere or you lose money. And that's absolutely in a bear market, and even in markets that are bull markets, but you get into the later stage and it gets very difficult and the volatility picks up. And I'm not talking about just the VIX. I'm talking about the volatility in the individual stocks around breakout levels and so forth. And it just becomes, you're just battling. And when you have that reward, or I should say aggravation to reward ratio is very high, that's a market that I don't want to be in, or I don't want to be aggressive in. That's a hard penny environment. I'm working really hard for pennies. I want to work very little and gain dollars. So differentiating those two is a key. We actually have a model. We call it a STEM model, stock trading environment model, that we grade the environment and then report that model reading to indicate whether we're in hard penny or we're in an easy dollar. Right now, we were in a hard penny. We just upgraded it to what we would call an orange. There's green, orange, and red. And orange is a selective environment where it's still a cautious environment. It's not an easy dollar, but it is an environment that you can selectively trade in. So that's where we feel we are right now. We haven't yet moved into that easy dollar yet. That would be really kind of a confirmed bull market where things are really going well, and I don't think we've gotten to that just yet.
Here's another question. How can you avoid FOMO when some of the when the Nasdaq is kind of choppy, when the indexes are moving in a certain way? If you're getting higher moves on the indexes, but you're not finding follow through on the stocks, how do you avoid FOMO?
Well, number one, with rules, and number two, with anchoring yourself in some common sense. Do you think that you're never going to miss stocks, and you're not going to be sitting there watching? You're going to be in everything, and you're going to time the market so perfectly that you're never watching the market go higher and you're not in it? I mean, that's going to happen. That's going to happen way more times than it's not. So that's just part of it. But you have to manage the risk, and you have to manage things in real time. So rules are going to keep you grounded. Rules create discipline. Discipline creates it develops in a strategy, and a strategy is where it gives you the consistency. You have to have the discipline to apply to the strategy. You'll get the consistency. But there's a big word that everybody has a hard time with. When you have a strategy and you make a commitment to a discipline, sacrifice. You have to sacrifice everything else. So now that means if I'm buying stock breakouts, well, then the stock that's trading off a 52-week low and goes blasting off, maybe we can use Nvidia, for instance, it's up over 100% off the lows. Well, you got to give that up. And now if you're doing something the opposite, it's going to be inverse to that, right? You're going to give up something. So you can't be everything. You can't use every strategy. And you certainly, if you're just chasing stocks that are going up all the time, and with no rhyme or reason, just because you missed it, well, then that doesn't sound like a strategy or a discipline to me. That sounds like gambling. So that basically the market's only going to pay you well over time consistently is if you have a consistent application of discipline. Otherwise, you might as well just go to Vegas, because you got better odds on the roulette wheel. And that's the brutal truth.
There's so much in there. I'm glad that we're recording this, because to go back and dissect so many of these gems here and pull them out. We are coming close to the hour mark here. So, well, what are the final messages that you'd like to give to people, and any final bits of advice for everyone?
Well, the main thing, and getting back to mindset, is that you really don't ever want to compromise your personal power, and that is the power of choice. And And the way you do that, I'll just give you a quick little story. I do photography as a hobby. And with pretty much with everything I do, I use this sort of formula. I want to remove all the excuses. I want to make sure that I take personal responsibility, and it's on me, because that's what I can control. I can control my own choices that I make. So with photography, for instance, I went out and I got the best camera. I got the best lenses. I went and got a great coach. And then my photography still sucked. and I realized that it's me. I just don't know how to use those tools yet. I'm not using the coach is giving me the coaching, and the tools are there. I have to. Now, it's very easy. If I had a crappy camera, I could blame the camera. If I didn't have, I could say, well, that guy has all the great lenses. I mean, that's how it started. It started where I look at people's photography, say, it must be the lens. What lens are they using? And then I check, and then I get that lens. And so, well, what camera they use? So I buy a couple different cameras, and wow, I still can't get the results, but it's like giving, I give you a paintbrush, I'm a great artist, and I give you a paintbrush and a canvas. Just because you have the paintbrush and the canvas doesn't mean you're going to produce the same results. So you open a brokerage account, you're not going to produce the same results as me, right? So you want to take that. Now, that you don't want to turn it into where you feel disempowered and you suck at this. We all suck at it in the beginning. You would have to. You're not going to be good at something that you don't have experience with and haven't been taught and don't know the proper rules. So removing the excuses is like the biggest step. And that has to do with also not buying into it's different this time, or, you can't win. There's manipulation. The market's rigged. It's all nonsense. It's all nonsense. Meanwhile, with this rigged market, there's somebody out there making millions of dollars, making a fortune consistently year after year after year. But, you're buying into the notion that this game is rigged. Those are the type of things that I see cripple people. And because what happens, you run into difficulty, and then nobody likes to take that personal responsibility. So they start looking for blame. It's like a hot potato. You don't want to hold it. So you try to toss it, right? You want to get rid of that hot potato. So you start looking for blame and to assigning blame. So, well, it must be, if I just knew Mark Minervini's screen, if I just knew what indicators he looks at, if I just knew, how he buys. Well, I wrote books on this. I delineated every single thing. 99.9% of everything I do is in my books. I do a master trader program a week, teach everybody, everything from A to Z. And you still have people that fail and they can't do it. And then you have other people that do great. Why? Well, because some apply the rules, apply the discipline, and they work at it. They stay with it, and they commit, and they learn from their mistakes. And the other group makes excuses, blames the strategy, blames the market. They try something else. They never become great at anything. They become a jack of all trades, and they end up with a bunch of excuses, and they quit. So that's what's going to make you quit. If you buy into the excuses and you don't remove the excuses and take personal responsibility, you'll eventually quit. That's it. You learn, the stock market is you learn or burn. That's it. There's only two ways. You're gonna learn it, and you're gonna as Kevin Hart says, you're gonna learn today, and you're gonna learn every day. And if you don't learn, you will burn, and you'll quit. And that's the bottom line.
Mark, this has been eye-opening, outstanding. I've been following your work for more than a decade, and I'm still learning more every time you open your mouth.
And I learn Mark, every time anybody opens their mouth. I listen very carefully too.
Yeah, I'm writing fast and furious. Like I've got a page of notes over here as you're talking here, and I'm gonna go back and re-listen to this, and I recommend everybody does the same and get all the gold nuggets from this. But Mark, from the bottom of my heart, I appreciate everything that you've done for me, everything that you've done for everyone here, sharing your knowledge and wisdom so generously to everybody. And you can follow Mark on Twitter. You have Minervini.com right there. If you're going over to tradingmindwheel.com/lobby, we've got the links to all the panelists today all of the social media links, and reach out to everybody. Reach out to Mark. Reach out to everybody else that's spoken, because this group of people is so extraordinarily generous with their time and just are there to help build relationships. That's what a lot of this enrichment and wealth is about. It's not just about being wealthy financially. It's being wealth spiritually and having a wealthy lifestyle is not just what's in the bank account, but the people in your life.
Well, let me just say, I see you had a great panel of guests here. I didn't get a chance to hear them. I wish I did, but some of them are my friends. I just want to say hello to everyone, and I hope you had a great event. I'm very proud of you. You've done a great job. Keep up the good work. I'm happy to be part of it, and press on here. And great work, Mike.
Thanks so much, Mark.
I hope my babbling off the top of my head has given you guys some insights and something good that you can take from it.
There might be one or two good things in there.
Mark,
so. Thanks a million.
Okay, take care, guys.
You too.
Bye-bye.
All right, everybody. That concludes the show. That concludes the Trading Mindwheel virtual conference. Thank you all so much for coming. If you haven't gotten the book already, the book is available right now everywhere: Amazon, Barnes & Noble, Target, Walmart. It's all over. So go grab a copy of the book. Make sure that you go to tradingmindwheel.com and put your receipt in, because the receipts are going to unlock all the different bonuses that we have. There's different levels of bonuses too. I saw a whole bunch of questions coming in as well. We've had over 1,000 people cycle through here throughout the day. We've been going strong now for about 8 hours. Now, and it's impossible to get to all those questions live, but I promise you that I'm going to go through all the other questions that came in and answer questions by the end of the week. So check your email for the answers to those questions. I'll finish off by saying if you really want to do this, you absolutely can. I struggled for so many years, and I'm here. So if somebody that's was a failure for 10 years, or failed for so long, was finally able to make it out to the other side, you can too. And one of the ways that you're going to be able to do it, it's all the things that are spoken inside the book, with mindset and the skill building, but it's also, and I talk about this in the mindset chapters too, it's building your environment. And your environment is more than just the four walls around you. It's what you're feeding your brain. So it's what you watch, what you read, what you listen to, and most importantly, the people that you surround yourself with. We've had a great panel of everybody here. Surround yourself with those people. Reach out to them. Build relationships with them. And well, we all want to see you succeed. So I'll finish there. Thank you again so much for joining me today. And I look forward to seeing your successful journey, everybody. Take care. Much love. Peace out.